Ladies and gentlemen, welcome to V&C Global. My name is Hugo Dupont, and I have the immense pleasure and honor of serving as your host for this exciting two-day virtual conference. We're delighted to see so many familiar faces and many new ones, spanning time zones, nations, and industries. Today marks a significant milestone for Wholesale Investor, the organizing body behind this event. Founded in Australia 13 years ago with the prime aim of nourishing the global investment ecosystem, Wholesale Investor made a leap 2 years ago and set foot on European soil with its first office in London. Today's event stands testament to that bold move, as it represents the largest effort yet by our UK and Europe team. During these 2 days, we are set to traverse the wide landscape of investment opportunities across multiple sectors. This includes SaaS, Fintech, AI, and many more. We have an exciting lineup featuring distinguished panel discussions and keynotes from industry pioneers. You'll also witness pitches from over 45 innovative private companies, each promising in its potential to revolutionize industries and the investment landscape. Our gathering today is indeed a global one. We have the privilege and honor of welcoming 1,200 of you, hailing from 54 countries and representing many organizations. You, dear attendees, represent a vast and diverse array of expertise, interest, and influence. Our common thread is our shared passion for investment, innovation, and creating opportunities. Our roster of speakers is one we take immense pride in. Eminent personalities from esteemed organizations such as Intel, Partech, and Forbes, and many more will enlighten us with their experiences, insights, and wisdom. While we may not be able to meet face-to-face, the power of technology allows us to come together and forge connections, share knowledge, and create synergies across the globe. Whether you're joining us from your home office in Sydney, your room in New York, or your office in Paris, or anywhere else in the world, you are an integral part of our global investment community. Now, allow me to introduce you to an exciting feature that we've developed very recently. Our very own in-house built conferencing software, the platform through which you're joining us right now. We've specifically designed this to bridge the virtual divide, allowing us to connect, communicate, and collaborate effortlessly no matter where we are in the world. At the top of your screens, you'll find our dedicated networking zone. This digital gathering space will be your go-to destination for building relationships throughout this event. It's here so that you can engage with our esteemed speakers, interact with our founders, and connect with your fellow attendees. But our commitment to fostering a vibrant global investment community doesn't end when the event does. We're pleased to announce that the networking zone will remain live and active for a full 2 months, starting today and stretching all the way through till September. That's right, you'll get access to 8 weeks of uninterrupted networking, knowledge sharing, and relationship building. And there's more. Your access to this platform will not only encompass today's event, but also grants you exclusive admission to our upcoming V&C Australia and Singapore events. These will be held both in person and virtually. Just imagine the wealth of global insights and diverse perspectives you can tap into, right from the comfort of your own home or office, or for those of you that are lucky enough to be on holiday, maybe by the beach. So as we kickstart our journey through the V&C Global, don't forget to explore and make full use of our networking zone. Let's embrace this unique opportunity to connect, learn, and grow together. So, having said this, let's dive into these 2 days of insightful dialogues and engaging discussions. Let's listen, learn, network, and contribute to shaping the future of investing. Here's to a rewarding and successful conference. Thank you for being here with us today. Enjoy V&C Global. We will be back on shortly with our first keynote speaker, Markus Bohl of Intel Ignite.
All right. Good morning, everyone, and thank you all for joining us on this exciting day. We are truly privileged to have a distinguished guest with us for today's keynote session and the first of V&C Global. It's an honor to introduce Markus Bohl, the managing director at Ignite Europe. He is a serial entrepreneur with an impressive track record. Markus has successfully built and scaled numerous tech companies, including an innovative AI startup. His ventures have garnered significant backing from both VC and corporate investors. Markus has experienced the thrilling ups and downs of the entrepreneurial journey, from the rush of a successful exit to the tension of nearly running out of cash and all the twists and turns in between. He is someone who not only understands the challenges that founders face, but also has firsthand knowledge of how to overcome them. With a deep commitment to sharing his hard-earned knowledge and insights, Markus plays a crucial role in helping other founders succeed with their startups. His role at Ignite Europe has made him a valuable connector, linking aspiring entrepreneurs with a global community of mentors and investors. Without any further ado, let's warmly welcome Markus Bohl to the virtual stage. Over to you, Markus.
Thank you, Hugo. Yeah, good morning, everybody, or whatever time it may be from where you join us. Today, I'd like to talk a bit about breakthrough innovation. And I'll give you three topics why it's really important. First is, I think the world really needs breakthrough innovation. I will elaborate a bit on that later. I would like to make the very short, brief case why it's a real investment case, especially in Europe. I will also show you briefly how Ignite can contribute to that. And afterwards, I'm happy to discuss with you or answer any questions you may have. But before we start, let's go back 2 days. July 3rd, this Monday, was actually the hottest day of this year. Not only of this year, it was the hottest day of this decade. It was the hottest day of this century. It was the hottest day of this millennium. In fact, it was the hottest day in the history of mankind. The whole world was suffering from heat waves, sizzling on the heat waves in the US, in China, temperatures north of 35 degrees. Africa almost reached 50 degrees. So really a heat wave going through all over the world. Also in the Antarctica, temperatures were recorded at 9 degrees or almost 9 degrees, which is definitely too high for that. Be a bit more specific. This is how it's measured. So it's measured at 2-meter altitude, the air temperature globally. And if you look at it, we surpassed for the first time in history 17 degrees as a global average. And that already brings us close to this 1.5 degree target almost all nations have agreed on, that we should limit the global warming to. So, and if you have any doubts where this is coming from, well, here you have your answer. This is from NASA. They track live the carboxide concentration in the air, in the atmosphere. And as you can see, it's coming from us. It's coming from the global north. And I think it's also on us to start working on that. Because if we don't do that, this could well be the coldest summer for the rest of your life. So as Hugo mentioned, I've been in tech and I've been building tech companies for almost all my life. But when I think back for the last 15, 20 years, and when I look what we achieved with technology and what has been built, all that comes to my mind is faster pizza delivery or electro scooters or tokens or NFTs for that matter. And while there's nothing wrong with that, I think we have bigger fish to fry. We have more important problems to solve than to get the pizza in 5 minutes faster. So why is it important? Well, if you look on global scale, what's required to achieve the emission savings to get to net zero in the next few years, then there's 3 categories to look at. One is the behavioral changes in green. It is the technologies that are on the market to achieve these emission savings. And then there's the technologies under development. And if you look at 2030, you can see the behavioral changes don't matter so much. What we need to do to achieve the emissions and the emission savings required go up over time. we need to deploy existing technologies, but we also need to bring some technologies to life that are still under development. But if you look at 2050, the picture is even different. The behavioral changes, as important as they may be, do not really move the needle here. The thing that really moves the needle is the stuff in red, and this is what we call breakthrough innovation. This is not only true for climate tech or for climate emission savings. This is also true in many other industries and aspects. Just one example. This is the curve of the labor workforce in Germany, how it develops over time. Meaning, in the next 12 years, which is really literally around the corner, Germany will lose a workforce or labor force of 7.5 million people. Just by 2030, so in the next 6.5 years, we will have to replace 5 million, we will lose 5 million workers. This is basically true for every Western civilization. This is not true for Germany. And if you look at these numbers, it is clear that automation will become critical to just even maintain the quality of life. So, and we could make the case for many other things, for the energy transition, for healthcare markets. All of that has the same requirement. It needs breakthrough innovation. It needs real new technology to overcome these challenges. So is the old famous saying from A16Z, software is eating the world, still true? Well, I think there's more to that. Maybe software was just the breakfast. I think it requires everything. It requires hardware, it requires sensors, it requires data, it requires algorithms, it requires, of course, also AI. But if you look at it, there's hope. Yeah, there's a crack in everything, and there's not only this challenge, there's also a massive opportunity related to the things, be it climate change, be it automation, be it health, be it energy tech. And this is true especially for Europe, and I'm representing Intel Ignite for Europe, so that's why I like to make the case why this is a huge opportunity, especially in Europe, and why the time to invest in these things and to build these things is just right now. So let's go back a step and look at the talent, so the assets, if you like. And to sum it up, the talent in Europe, be it Germany, France, doesn't matter, is really there. We have twice the production of STEM graduates, so science, technology, engineering, mathematics, compared to the US, if you calibrate it against the total population. And Europe is producing twice as many PhDs as the US in total numbers. So that's good. And that also translates, or this stems from cutting edge academia in Europe. So it's not a surprise that several European top colleges or universities rank amongst the top 20 universities in the world when it comes to engineering. A bit more surprising maybe is that they also do that when it comes to computer science. And this also translates into, if you look at where the most AI founders, just to take one of the verticals out of it, stem from, I think the European universities and the European ecosystems are not far behind on that perspective. And for me, a very surprising fact, Europe also represents one third of the global developer workforce. So I would not have assumed that, and it's growing. So this is a really interesting fact about the ecosystem in Europe, which is in fact not a single European ecosystem. It's of course, like everything in Europe, dotted all over the place, but it also makes it very diverse and very resilient and very strong and very differentiated in terms of technologies and things that are leveraged here. So the assets are there. Of course, there was a big setback in the last 1.5, 2 years when it comes to valuation and the funding climate. Yeah, let's have a brief look at that. All the data is from Atomico. To sum it up, the private market valuations have been reset to their long-term average. Yeah, doesn't matter if you look at seed rounds, Series A's or Series B's. The valuations are back on a normal trajectory, I would say, maybe a healthy trajectory, some would also say. But what you can also see, there's still around 50% below the US medians. So the valuations in Europe in general are still half of what we see in the US, which is an opportunity also, of course. What's also good news is that the European ecosystem in the first half year of 2023, despite the crisis, stabilized at around 3 trillion of valuation. As you can see in the private markets, the green bars, it even got a slightly bump, just a slight one, but this, in face of the crisis and all the challenges out there, this is really good news. What's more good news is that the trajectory for the next decade is even better. So it took us quite a while to get to ecosystem valuation of 1 trillion. It took half the time to get from 1 trillion to 3 trillion. Then it took us from half a trillion to get to 1 trillion. And now we're also poised to go up to whatever projection you may believe in. But it's clear that tech, and especially deep tech in Europe, will add trillions of value on the continent over the next decade. And this is even more so true if you look at valuations. So Europe still is punching under its weight, or under its weight class, if you like. Even if we assume that we can never reach the same valuation levels as in the US for various structural reasons, even if we assume that there is this factor 2 valuation, US versus Europe, for these structural reasons still in place, we have a huge, massive upside potential in Europe just to catch up to these markets. And this is data from 2021. I think in spite or in the face of the crisis, this has even increased. Okay. What's good news is that the early stage rounds have been really resilient. Yeah, if you compare the first half of 2023 with the 2022 numbers and also the previous years, which have of course been a bit outlier on skewed to larger rounds, this is really encouraging news. And we see not only that it is resilient, but we also see that especially when it comes to early stage rounds, so anything sub $5 million, Europe is catching up. Europe is really becoming a force there, and it's filling the pipeline, if you like, for future exits, future M&A. And I think there's a lot of very, very interesting investment opportunities coming up. And if you look at it, deep tech, especially where Europe is potentially even stronger than in normal tech rounds, is eventually paying off. Yeah. So if you look at that, deep tech rounds or deep tech startups in general, they need significantly more time to develop their stuff and to raise the rounds they need to raise. But when they get to this level, then they top out conventional tech rounds, both in size and in valuation, and making a real great opportunity for investors. So, like I said, the assets are there, the talent is there, the IP is there, everything's in place. The opportunity is huge. What is holding us back? Yeah. Well, the problem is deep tech is really hard. So this is a definition from a deep tech report from Deal Room together with Lakestar and Walden Catalyst. They defined 5 criteria to compare conventional tech rounds, regular tech as they call it, versus deep tech rounds. And as you can see, it takes longer. We also saw that on the previous chart. It has more capex intensity, so that's why many investors were a bit reluctant in the past. And of course, it has a greater technology risk. But on the other hand, we see that the competition risk and the opportunity to exploit this technology once you get it to a certain level is much lower, and hence the opportunity is much bigger. So, but as I said, deep tech is hard, or you could also say the deep in deep tech is for deep problems. So you're probably not going to be able to solve these things just in your garage, as you may have done it in the past with a SaaS startup or with an app startup, or 30, 40, 50 years back in the Valley. I think the complexity and the challenges coming with these technologies and with deep tech is much bigger, much more challenging than it was in the past. So what do? You bring in the 800-pound gorilla, yeah? And I work for one of these 800-pound gorillas. And the secret is, how can you make this 800-pound gorilla dance? How can you make this 800-pound gorilla get to work? And you could also say, it's not only an 800-pound gorilla, Intel is also supposed to be one of the mothers of all startups, yeah? And as I can tell you, this is quite a challenging task to bring this huge 800-pound gorilla to work together with startups. But I think we found a very cool way and a very good working way to do that. And that's what I'd like to elaborate now a bit on, to introduce you to Intel Ignite and how we work together with groundbreaking startups, helping them, accelerating them on breakthrough innovation. So like I said, at Ignite, everything is about acceleration. So we made it our mission, and I myself also made it a mission to help our teams to get to product market fit faster, to help them build better teams, to build better companies faster. We help them to find more, bigger, better clients faster. And of course, we also help them to raise at higher valuations early in their journey, so faster also, yeah. But how do you do that? How can we make sure that this works? So if you look at acceleration, it's defined as force over mass, yeah. So you want to have a big force and a small mass, yeah, that you apply on a small mass. If you look at the mass, we keep it intentionally small. That doesn't mean we don't engage with many startups out there, but the way we work together with the selected startups is very, very focused and very narrow. So in general, we focus on just 3 things. We only do early stage. So early stage is for us anything between pre-seed and Series A. This is where we can help these startups, these disruptors of tomorrow, best, where we have the biggest impact on them and where we can really accelerate their journey. The second thing is we only focus on deep tech. We've defined 8 categories, whereas AI is not even a singular category. I would say it even goes across all the 8 tech streams. And we focus only on these things. And we only focus on breakthrough innovation. So not the application of an existing technology, which could be a great business and which could be super relevant. But for us, this is not disruptive enough. This is not where we also drive learnings for us and where we can also contribute the insights of a global giant as Intel. So, like I said, we need to keep the mass small, but on the other hand, we want to see as much of the market as possible. So what we do is the whole thing is not set up as a marketing operation, a data scraping operation, whatever. It is highly curated. So most of our applications we get are referrals from VCs, from alumni, from the Intel ecosystem, but also from the wider ecosystem. So for each batch, so we do 2 cohorts per year with just 10 startups per location. I'll come to that in a second. To get there, we look at these 200 to 300 highly curated referred applications. Then we do a lot of technical deep dives, much more than a normal investor would do, because for us, the technology part is the interesting part, right? So we look really deep into that. We can pull in all the resources from any business unit within Intel, but also from industry partners and experts. And out of that, we condense that to 18 teams we invite to a selection day. And out of these 18, we select the 10 best startups per batch. And we do that whole operation twice per year. So it's hard to get in, but hopefully it's even harder to get out because of the value you get out of the program. Like I said, referrals are key for us to get to this application. And that's why we work with VCs on both ends of the funnel. So we work with them to get the deal flow, but also we work with them to do the next funding round. And this is just an example of participants in our last selection day. So this is not even complete. but this is how we work. So we keep the mass really focused, really small, that we can apply maximum impact on these teams. But how do you get the force big? Yeah, you want big force over small mass. The way we do it is, of course, we set it up as a global program. Like I said, Munich is responsible for Europe. There's London for the UK. There's Tel Aviv for the whole Israel ecosystem. And we are in Boston for North America. The good thing is we have a really, really keen sponsor, I would even say, within Intel who drives this. This is the global CTO of Intel, so the #1 technical person at Intel who drives this program, who we report to. And he has set it up in the really right way from my point of view. It's about open innovation. It's about open ecosystems. It's a strategic tool, though there's no business case behind in the sense that we need to earn money from the startups or we invest in the startups, but I'll come to that in a second. So really nicely set up. And we're also able now, meanwhile, to leverage the synergies of this global network for our founders, for the investors in our companies, and of course also for Intel. What makes us different? Well, 3 or maybe 4 things. The most important thing is it's from founders for founders. So everybody in the program understands this journey that a startup goes through, especially a deep tech startup that has a quite long journey and a quite hard journey. So it's founder-led, it's founder-driven, and all the mentors and all the experts we bring in also have the same mindset. A bit more specifically, first of all, we're non-dilutive. So we don't take equity. We also don't invest financially into the teams, meaning it becomes quite attractive for the teams because, they don't have to give away a stake in the cap table. It also becomes quite interesting for VCs or investors in general because there's no competition, And we opted to do that because we really want to have the best deal flow. We want to really select the best companies out there. And this cannot be achieved by writing small checks or taking a percentage in your cap table. So we're non-dilutive, really founder-friendly. The #2 is the North Star. Our metric, we measure ourselves against the success of the startups. So I don't have an Intel metric. I don't have a KPI that I need to achieve for Intel. Our North Star is the success of the startups. We strive when they strive. As a proxy, of course, we measure funding success. So we look at the companies, what funding do they have when they come into the program, and what do they have as funding 18, 24 months after the program, okay? And maybe the most important part is the mentors. Like I said, we have this from founders for founders mentality, meaning that all the mentors we have in the program are either world-class experts in a certain domain, can be Intel mentors, can be external mentors, or they have built startups themselves. So they have walked the walk, not only talked the talk. They know what they're talking about, and they're all here to give back. So we don't pay any of our mentors. We don't even reimburse travel costs. All of them are here to pay back to the ecosystem, or maybe to pay it forward to the ecosystem. And that, I think, makes it really special and really also attractive for not only founders, but also for investors. So, like I said, acceleration is defined as force over mass. We try to increase the force as much as we can and keep the mass as focused and small as we can. Looking at the numbers, we're still also early. This is now the 3rd year in operation. So far, we have accelerated 120 startups, so 118, and 30 are going through our current batch. We've brought in more than 200 mentors from Intel, 120 industry experts and founders. So the founders of Lilium, the founders of Connexon, people who really build large tech companies successfully. They work on a daily basis with our teams. And the team's really highly evaluated. It's we have an NPS of 94. And the trajectory also shows that it really works. All of the teams have raised after the program. Typically, they come into the program with 3, 4, 5 million, depending on the geography. But what's really key is the growth after the program, how much funding they can raise. And of course, we also like to validate within Intel. So far, and this is a cohort view you need to apply, 40 POCs is a lot just within Intel. We also drive POCs with other corporate partners or larger enterprises. One company has been acquired by Intel, and we're very happy that 95% of all our alumni are still thriving and growing quite fast. But again, the key metric for us is the growth. We look at that number. How successful do our teams become after the program? And if you want to have a look at our portfolio, also look at our website if you like. This is just an example of the companies we had in our program so far. This is growing very fast. Meanwhile, 80 new companies per year because of the 4 locations. So if you want to be connected to that community of these deep tech disruptors, if you're investing in that space, or if you're a company yourself building some real breakthrough innovation, talk to me right afterwards. I think Intel Ignite is the place to be for that.
Thank you very much, Markus. That was very, very, very insightful. And as Markus just mentioned, if you want more contact, you can reach out to him. But also, we will be sending out an email to all attendees with his details and the website. Just conscious of time, we have about 15 minutes left. So I'm just going to have a few questions ready. You talk a lot about the force. Does Intel Ignite have planned to increase that force over maybe the next few years?
Yeah, first thing is bringing in more mentors, more speakers, more coaches. And I think the cohorts of successfully exited companies also helps us. So in Europe, there's an accelerating community of founders who sold their companies successfully and who are willing to give back to that. 10 years ago, this would have been totally different. So we try to expand on that network and always improve. So we measure every session, we get feedback from every session. And this is also how we drive or try to drive value for the teams, for our investors, and also for ourselves. And we don't shy away of also filtering out and constantly renewing that stuff. That's one thing. The other thing is, we're ever expanding our network to investors. And like I said, also bringing together the synergies, investors from the US, looking at European teams, investors from Israel, now looking into European teams, and vice versa. So that is also an important part of our work to strengthen the relationship, the network there. And of course, also to prove our value to these investors. In the end, it's about acceleration, is also about compressing time, making most use of the time. This is not only true for the startups, this is also true for investors, so we don't want to waste their time. So when the teams come out of the program, this should be like a quality stamp for them. And number 3, and we're about to mount this in a few weeks' time, we're going to set up a board, a council of large enterprise C-level executives, so CIOs, CTOs, SVP engineering, whatever you have. So people who can write a check, but who also understand startup and how to work with startup and also provide technical expertise. We will mount that circle in New York City, actually, on the 26th of July. And we're going to increase that because in the end, what do the teams need? Okay, product market fit and all that. In the end, they need clients, they need the first customers, and then funding is more like a logical consequence of that. So we're doubling down on that and helping them to create value there. On top of that, of course, there's also support from Intel, going to trade fairs together with them, showing up at conferences, promoting activities, whatever. But I think the 3 first ones are the most important ones.
Fantastic. Thank you for that. I guess moving on, you've seen a lot of startups, as you just mentioned on one of the last slides. What do you believe are the most essential traits, if you can pinpoint maybe them, that an entrepreneur should possess to succeed in the tech startup industry, and specifically deep tech?
Yeah, so we find, or where do these companies come from? Yeah, they normally come from a research, from a scientific background. So this all happens at universities, at research institutions, where the foundational work for that is done. Yeah, nobody comes up around the corner and says, I have an idea and I built this. Yeah, so this is always based on real science, on research. Yeah, but being a researcher or a good scientist doesn't mean you're a good entrepreneur. Yeah, so this is one of the key traits we look for. Is I mean, they're all smart, they're super smart, and I'm always the dumbest person in the room, that's for sure. But we try to educate them on several key things you need to consider. So how to manage your cap table, what is important to build in the culture of your company, these foundational things. And for that, we look a lot into coachability. Yeah. So typically, as I said, the companies are referred to us by VCs or by investors. So there is a certain pre-selection already, but still we look at that. And I would say the greatest founders are those who are coachable and who manage to hire better than themselves. So the key trait for me would be, how good are you at bringing people that are even more smarter and better at certain tasks than yourself? So that's maybe the key thing.
Fantastic, thank you. And you just mentioned culture, right? So what kind of culture do you coach on, or what type of culture do you like to see in a deep tech startup?
I'll start with the most challenging one, and that's diversity. Yeah, if you look at universities, if you look at research, this is still highly skewed or biased towards male founders. Yeah, and this is stemming from even back to school. Yeah, students in mathematics on a higher percentage male, in engineering, in science, and all these things. This is very male driven. So, and it's very difficult for the teams if they don't design intentionally and from the beginning to have a diverse setup. And that's not only male, female, that's also intercultural and bringing in different perspectives. If you don't bring that in the very first place, it's very hard to set this up later or to change it later. So this is one thing we look at. But our options there are limited. We can design a bit and help with that. But of course, this has deeper roots that need to be solved. The other things in terms of culture is maybe two things. It's good to make mistakes. It's even required to make mistakes. You need this failure culture, and especially in Europe, in Germany, but also in Eastern Europe, for example, this is something that is still culturally not really anchored in the society, I would say. Yeah, it's seen as a failure. I always tell my founders, or also told my employees, make any mistake you want to make it fast, and make sure it's not a mistake that kills the company, but embrace the failure and have this learning culture. What can you drive out of it? Yeah, do not stop experimenting. Yeah, you don't know what you don't know yet in these kind of projects and these kind of technologies. So you need to double down on the learnings and how you can use that. And maybe a third thing is, we always tell them, strive for simplicity. These things are so complicated. Yeah. So we always tell them, fight for simplicity. Yeah. Make it as simple as possible, focus on very few things, and then become an issue resolving machine. Yeah. So issues will occur on a daily basis, big or small, and you need to have a culture as a company to get rid of these issues. Address them, tackle them, decide, even if it's the wrong decision, but fast. Yeah. Move on. Don't defer, don't deflect, don't delay decisions. Become an issue solving machine. And this is easier if it's very focused and it's really designed for simplicity.
Great. Thank you very much for that. I think a lot of the founders out there watching us right now will probably get a lot from that. And I guess we have time for one last question. I think this is a question I've been asking a lot. If you had one tip for founders right now, maybe considering the landscape, what would your tip be?
Oh, there's so many tips. I would say dare to think big. I think this is for many European founders, especially, still one of the things they want to build. They're in love with their technology. They're sometimes also in love with their product, but they don't realize how big the opportunity could be and what it takes to seize this opportunity. So really, we look at contrarian views. We love people who want to take a moonshot, even if it fails. And that's a good thing of being neutral, not taking equity. We can afford to do that, yeah. So I would really say dare to fail, but also dare to be successful, yeah.
Fantastic. Well, thank you very much, Markus, for joining us today. As I mentioned earlier, we will be sending out an email with Markus' details, websites, and if you want to get in contact with him, I'm sure you can also join us on the networking zone. But yeah, thank you very much, Markus. It was a pleasure having you today.
Thank you, Hugo. Thank you, everybody, for listening. Bye-bye.
Thank you. All right, good morning, everyone, and welcome back. We are delighted to have you joining us from various corners of the globe, and I'm very pleased to introduce this early stage investment panel. Today, we have assembled a distinguished panel of experts who are intimately involved in the early stage investing landscape. They will share with us their experience, strategies, and insights that can help us better navigate this exciting and ever-evolving investment space. Firstly, we have Mr. Nenad Marovac, founder and managing partner at DN Capital, a leading venture capital and growth investor operating from London, Berlin, and Silicon Valley. Nenad brings over 25 years of venture capital and private equity investment experience in technology and media sectors and boasts an impressive investment portfolio with numerous successful exits. Our second panelist, Chris Smith, serves as a managing partner at Playfair Capital. He focuses his investing activities on pre-seed opportunities in the UK, Europe, and Israel, with particular interest in autonomous transportation, business and industrial automation, health tech, and B2B SaaS. Prior to his time at Playfair, Chris was an operator at Plan.com and held several senior roles. Lastly, we are pleased to welcome Daniel Socko, the CEO of ShipShape VC, a free investor search engine. ShipShape VC is helping redefine how investors and investments are searched and matched, utilizing an innovative approach that significantly reduces research time and improves the chances of a successful match between investor and startup. Today, we will engage in a structured discussion for about 40 minutes. We'll begin by addressing some general questions related to early stage investing. So just to begin, maybe Chris, you can answer this first one. How has the landscape of early stage investing evolved in the past 5 years, and where do you see it heading in the future?
Yeah, so I think the first thing to say is that let's take 2021 and forget about it, because it was an anomaly, right? Like the level of investment, the way VCs were behaving, frankly, quite irrationally, it is not normal. So we've kind of reverted to what was actually a normal, quite healthy trend. So over the past 5 years, I think we've seen, particularly in Europe, we've seen more funds, we've generally seen more capital, and we've seen a maturing of the ecosystem. So maybe the two things I'd really sort of point out is, one, angels have become far more active, and they've been enabled by different platforms and SPVs so that the check sizes come down. That's super healthy for the ecosystem. So the cap tables I see now have, 20, 30 people around the table, all adding value to the company. And we're also seeing in Europe a sort of maturing, which is, I guess, what makes Silicon Valley so successful, which is that you've got founders who have built successful companies who are then coming back into the ecosystem, both as angels and mentors. So for me, the last 5 years have actually been really positive if we put 2021 to one side. And going forward, I'm pretty positive as well. I think we'll talk later about some trends. I think the main pitfall is actually to fall into hype rather than trends. But I don't want to go too much into that now. But I'm really positive. I think macro, I think we've actually got a really strong ecosystem. We've got some fantastic new players coming in, and I'm super positive.
Great. And I guess on the flip side, maybe Daniel, you see maybe with this data with ShipShape, do you see what Chris is saying, or are you seeing something different?
Yeah, I think it's worth highlighting. Yeah, that what Chris said actually, I think, like, pairs up. And actually that health in the ecosystem we see coming through in the types of searches that are being run by entrepreneurs, by startups, and indeed by investors, where actually you've got lots of startups across a broad swathe of technologies and industries. Like, we're becoming a lot more diversified, even though if you follow hype, like where hype is, it feels like we're only moving from one technology to the other. Actually, if you look at what's bubbling beneath the surface, you've got thousands of different types of technologies being developed. I think it's really healthy for the ecosystem, and indeed for investors too.
Okay, great. Then, do you have anything to add in terms of the last 5 years or something?
Sure.
What's coming up in the future?
I fully agree with Chris. I think 2021 was like 1999. They only happen every 20 years. I wouldn't say they're all negative, because 2021 was a great time to sell. If you're an entrepreneur who'd been building their business for a long time, 2021 was an amazing time to sell your company or go public. A lot of unicorns were created in Europe during this period. If you look at the map, there's now over 239 unicorns. When I started DN in 2000, there were 0 unicorns in Europe. And if you look at the map from 2005 up to today, it's growing at a very, very fast exponential rate. And that's what's creating such a buzz in Europe. And I think if you look at, the venture returns in Europe the last 5 years, they've been comparable, and in some years actually better than Silicon Valley. And so I'm very, very excited about what's happening in Europe. Also, not just Western Europe, but also Eastern Europe. My Slavic sisters and brothers are creating some great companies like UiPath, like Infobip, et cetera. So I think Eastern Europe and Europe, and I think that now that technology is so easy to create companies. When I started in DN in 2000, setting up a software company required, a lot of money. Whereas today you can set up a software company super cheap. And so this talent will come from everywhere. And I think if you look at the map of where all the unicorns are in Europe, unlike the US, where probably 75, 80% of them are in Silicon Valley, in Europe, they're really spread out. Berlin, Madrid, Estonia, Bulgaria, Zagreb, Croatia, Bucharest. So I think it's really interesting. I think it's just the beginning. And let's make sure that we all keep thinking globally and don't put up too many borders, et cetera.
Fantastic. And I guess then just touching on that, why do you think that's the case in Europe compared maybe to the US, where it's concentrated in one area?
That's largely history. It's also, if you go to Sand Hill Road, 3000 Sand Hill Road has more venture capital than probably the entire European ecosystem. So it's just a very concentrated area. It's worked well, especially for deep tech, where you need like super experienced scientists that can do certain things. The whole, semiconductor industry came out of Silicon Valley. So I don't think Silicon Valley is going anywhere. And I think all these rumors about people moving away, but I hear everyone's moving back. I think Silicon Valley is still the mecca for technology globally.
Fantastic. I guess, Chris, now coming to you, Playfair has kind of a contrarian approach to pre-seed tech investing. Can you maybe share an example of when this approach led to a successful investment?
Yeah, of course. So, I mean, just to be clear, I suppose what we mean by contrarian to start with. So like most funds investing at this really early stages of pre-seed will write 20, 30, 40 checks a year. And they're looking to spread their risk and they're looking to index the market. And that is a completely valid strategy. Our approach is different. So we only do 6 to 8 investments a year. We almost take a sort of Series A level of rigor to what we're doing. So we go deep on the company, we write 30, 40 page investment memos, and we really build conviction in what we're doing. I think one specific example actually is a business called AeroCloud. So they're verticalized SaaS for airport operations. And I think it's contrarian for a few reasons. So first of all, we invested in the midst of the pandemic where no planes were flying. And we kind of took the view to come back to sort of hype versus trends. We knew the pandemic would end. We're not smart enough to know when, we just knew that it would. And we knew if we capitalized this company adequately, there was a good opportunity to build something. And the second reason was because actually they needed to raise their initial round of capital and they kind of got halfway to Series A, which we see happening quite a lot. And because of the work we've done and because of the way we're set up, we were able to then lead an internal kind of C+ round, which then got them to a successful Series A, which they recently announced. So I think that's a pretty good example. We invested in travel during the pandemic, and then we're able to really double down, do that C+ round and get them to a successful Series A.
Great, thank you. I guess now general question again is, and maybe starting with Nenad, what are some common pitfalls in early stage investing and how would you navigate them?
Well, I think we've read about them lately with certain investors and certain deals, and not doing due diligence. And I think, come back to Chris's point, I mean, my background is private equity. And so actually that training that I got was really helpful. We use a private equity investment process, believe it or not, at DN Capital. So we do quite a lot of due diligence. We're known for that. And I think it's important. So sometimes we've looked at companies and dug down and realized that the unit economics didn't work or were negative. And then 3 months later, we saw like one of our competitors go into a big round and we're like, what did we not see or what did they not look at? And sure enough, 18 months later, the company went bust. And so I think, it really is important to dig down and make sure the business model works. Obviously, at the super early stage, that's not possible because there's no traction. And so you have to, take a leap of faith, like Chris was saying. But then still, we would still look at a deal the same way we look at every deal. So we look at the market, we look at the team, look at the product, velocity, and price. Last thing we look at is price. Because if the first 4 stack up, you should be willing to pay a high price for the company.
Absolutely. And I guess flipping this on its head from a founder's perspective, Daniel, what are some common pitfalls that you've seen when maybe raising early rounds, or maybe, you know, with the ecosystem that you have? I know you've spoken to founders, a lot of them. What are you seeing from that space?
Yeah, so we capture some really interesting data on companies as they come in to use the search engine. So only 2/3 of the companies that are planning to raise and are now currently outreaching to investors have a financial model ready, which is is really, really surprising. There's a certain level of readiness and maturity that you would expect a company at whatever stage, even if you're only raising a few $100K, you need to have done that level of diligence because into your own company, because you're looking to de-risk this for investors, regardless of what stage those investors are investing at. We see a similar sort of similar numbers for business plans as well. You can argue that a financial model might well represent a business plan, but putting some words on paper is also necessary. There are other areas in which I think it's perhaps slightly less surprising and perhaps isn't required for a first round or maybe even a second round if you're only looking at angels. But yeah, that there aren't that many businesses that have insurance, like directors and officers or like key person insurance. These are often required by investors at the completion of a round, but actually it's remarkable the number of companies that are looking at sort of a small Series A check, but actually they don't have these elements in place. And then I think the last point that I'd like to make here is you still see, I think quite rightly, you see investors complaining about untargeted outreach. And if you're a founder and you're being targeted by a generic software development company or HR tech, not that there's anything wrong with HR or software, people need these services, but if it's untargeted outreach, actually you're never going to say yes because there's something wrong with the approach. So I think one of the pitfalls that's made by early stage founders in reaching out to investors is still not doing research. Because even if you research someone and it ends up being the wrong person, the fact that you've gone about it in the right way usually means that even if it's the wrong answer from that individual, they're usually much more likely to help you in your journey with finding relevant investors afterwards.
Great, thank you. I think you know, there's a lot of founders watching us right now. I think a lot of that they will probably echo with, but also, you know, some of this insurance stuff that you just mentioned, I think a lot of them maybe, especially the ones pre-seed and seed, might not realize that they might need that. Maybe they do, maybe they don't. But coming on to you, Chris, did you have anything else to add to that, or do you agree, disagree?
Yeah, I just think it's important for founders to understand what's really happening in 2023. So, you know, funds are active and writing checks. I'd include us, and I'm sure an ad, you're writing checks as well. But what we're seeing is just risk appetites have just pulled back. And so that means as a founder, you have to be emotionally prepared for longer processes, more in-depth questioning, and really, really be prepared for it to take a lot longer than you anticipate. So we always tell our founders it's going to take you 6 months to get a round close. We've even seen some taking a little bit longer. And to give just one example, we had you know, one of our founders talking to an unnamed Series A fund. They're not on this call, of course. They ended up doing around 50 pages of back and forth Q&A with the fund before the fund then passed. It also went to IC several times. So I think you just have to be emotionally ready for like these really elongated processes to happen. I think you can still get there, right? Rounds are still happening, but it's just there's a lot more rigor from every fund in the market.
Okay, thank you very much. I guess now the next question, and I think, you know, this with all the recent developments, can you maybe Nena discuss how technology such as AI, machine learning, big data is influencing your investment strategies and decision-making process?
I mean, a lot of big buzz on this in the market right now. And of course, I think you got to separate the two. I mean, ML and AI have been around for a long time, and all of our companies have been using this for a long time. I mean, Shazam is a company I invested in 2004, and they were using machine learning back then. So it's not like a new concept, and let's not get carried away here. I do think the regenerative AI, which has come out in the last 6 to 12 months, is super interesting. And I think we're all trying to figure out, you know, how to use this and what are going to be the best applications. So our team is looking at this quite extensively. In fact, we just put a term sheet yesterday on a deal in the space. So it is very interesting. And then obviously all of our portfolio companies are trying to figure out how to, or whether regenerative AI makes sense in what they're doing. Like, for instance, we have an investment in a company called Happen, which is a dating site in France. It's the 3rd largest dating site in the world. that could be a very good application for regenerative AI. Also, we have a company called GoStudent out of Austria. And I think education, especially tutoring, using maybe even a robot, because tutoring is quite expensive, right? I mean, if you have a live person tutoring your child per hour, especially in the UK, it can get is like up to £75 an hour, right? So if you could have a robot, then maybe it's not 100% as good, but if it could be 75 or 60% as good, then that's interesting, not just here, but also on a global basis for countries and emerging markets where they just don't even have access to this type of education. So we see a lot of really interesting opportunities in the space, and I think this is just the beginning.
Fantastic. I guess coming on to you, Chris, in terms of that, trend versus hype that you talked about earlier, how are you taking that into account in your process when looking at these and maybe avoiding the FOMO, but also taking smart decisions?
Yeah, look, I think you need to think long term. I don't think we're very good at doing that as humans, and even the mainstream media, right, wants us to have the next sort of dopamine hit. So we're quite bad at seeing what's going to happen in 5 or 10 years. I think we're pretty skeptical on the space for several reasons. One is I think that the technology is going to be adopted by everybody. So you're going to have this sort of commoditization effect happening with the technology. So there needs to still be a really significant problem you're trying to solve and a really good solution that you're building. And I've said to a few people, like, Gen AI is not a business. It's a piece of technology you deploy to make your business more effective at solving the problem for your customers. So there are definitely interesting companies out there, but I think my concern, probably from a founder point of view, is the barriers to entry are pretty low. And to pick just one example, we have seen now, I think, 8 companies doing like sales pipeline optimization using Gen AI. Like, the barriers to entry are super low. There are going to be lots of companies doing the same. And I think particularly for us, only writing 6 to 8 checks, we just can't go into that space. I think if you're writing loads of checks and you can kind of pick the winner just by having a bet with every company that's doing something, that's fine. But we can't do that. So we're generally pretty skeptical. We also see here a different type of incumbent. So I think a lot of founders are underestimating the incumbents and the distribution advantage they have. So to use that kind of sales pipeline optimization example, I mean, Salesforce, HubSpot, etc., they're pretty good tech companies, right? They're pretty nimble. And so for them to introduce this type of technology into their platform is not that hard. It's not like your incumbent's 50 years old, using technology, never going to change. So we're cautious, but equally, I think, excited about the potential in the longer term.
Okay. Great, thank you. I think, Daniel, from your perspective, I think even when there's a new trend, for example, the large language models, do you see startups reacting to that differently with the data you have access to? And what are investors outside of that trend looking for?
Yeah, I think actually, I think just adding on to Chris's point, which I think is spot on. Like, we would actually probably put ourselves in. We weren't pioneers of this type of technology. We were early adopters of embedding these types of technologies into the way that we work. So, a couple of years ago, we were building, relatively advanced classifiers for like looking through funding news events, but we aren't necessarily building like the underlying infrastructure or technology. I think just to add on as well, one of the things that we're really excited about is that with relatively little knowledge of coding, the barrier to entry and the cost of testing out a new service or idea at a very basic level has just dropped significantly. So we built the first version of what we did in Excel. You don't need to do that necessarily anymore with some of what's available off the shelf. So I think you're going to see a lot more founders experimenting with solving a lot more problems, because actually those problems are now within financial reach of many more sort of brilliant minds around the world. So we're really excited about that. To the question around sort of how hype or indeed trends then influence what is being built, I think it takes a long time for the market to actually react between what's currently trending in let me say what there's hype around, and then what startups are necessarily building. So if I look through what people are looking for, and we've categorized the types of searches that startups and tech founders are running, at the moment, one of the highest, I think it's the second highest actually, sort of category of search that's being run is around clean tech and green tech. Now, if you go back 5 years, the market was only just starting to talk about that, but actually it's become pervasive. Like from the LP down, in terms of capital allocation, it's known that green tech and clean tech is really important. And we're starting to see a response from the market in terms of where founders are now building. And I think it's still going to take some time for like the currents of Gen AI, or indeed what's being built on AI and LLMs at the moment. It's going to take some time for the market to truly respond to this new infrastructure, because it's only just sort of being released and coming into reach of tech businesses. I do think that response time is going to reduce, but yeah, ultimately what startup founders are looking for actually doesn't change that much based upon there's currently hype around, because actually that you've got a lag and a lead time between where do people currently say that they want to allocate, and unless you're one of the lucky ones that's been building in that space already, actually there's going to be a lag between that hype and where people then start to build.
Okay, great. I guess coming on to you, Nenad, on a more personal one, is you've been part of numerous successful investments across various sectors. In your opinion, which industry or technology is currently the most undervalued or overlooked when it comes to early stage investments?
Sure. I think we talked about this before. I mean, we like consumer, and consumer doesn't seem to be the flavor of the month right now. So we're looking at a lot of areas in that space, travel, etc. But also, more importantly, actually, is the entrepreneurs are the ones that come up with the great ideas, right? So, when we came across Shazam, we weren't sitting there thinking, oh, we want to find a company that does music recognition, right? It was only like meeting with, Chris and Avery that we said, wow, that could be a huge market. So I think, we look at deals in two ways, right? We sort of like, we market map areas we think are interesting by sector. So software, fintech, marketplace, consumer internet. And then we, everyone, we go to a lot of events and we meet people there. And then really it's about, meeting entrepreneurs and hearing what they think is interesting. Because I think, the entrepreneurs are also out there at the forefront, especially the good ones, coming up with really interesting ideas. I mean, Auto One, marketplace for selling used cars. So that was pioneered actually out of Germany. So the US guys copied that model. So it was something we weren't thinking about, but when we saw the numbers on the first few branches and the unit economics, we were so excited. So, and I guess just coming back also to the point about the market and really just the advice to the entrepreneurs. Capital scarce, it might even get scarcer over the next 12, 24 months. And so I think it's a market where people really need to try to stay on top of their skis and not like go over their skis and excessive burn, and really work with their boards to have business plans and agree on milestones. And if you hit the milestones, then your investors should give you more money, and to have those, because getting new investors right now can be difficult unless you're really killing it and it's obvious. So I think just having good investors that are known for do your due diligence on your investors, or whether these people will stick with you also if you miss something, but everything else is looking good. And I think that's going to be an important time. Also, I think it's a great time to invest. Valuations are down big time, on average 50% or more. There's far fewer players. Everyone and their mother wanted to be a VC the last 5 years. And now I think people are realizing it's not an easy way to make money. It's actually, now is a time when VCs earn their management fees and work very closely with their portfolio companies. I mean, I can tell you one thing, not every board meeting is rosy these days, right? There's some tough stuff going on, and the VCs and the entrepreneurs are working together to make their business plans viable and making sure that they can get through with the capital they have, rather than being forced to raise money in a market like today, because you could get really hurt. And we've already seen a lot of casualties in the market.
Great. Chris, did you have from your perspective, for the time being, what do you feel is the most undervalued or overlooked industry in the space from your perspective?
Yeah, I mean, I think to pick up to what Nenad said, I think actually we really care about what the founders think. We're full-time investors, right? We're not building full-time. And so I unexpectedly this year has been spending a lot of time with robotics. I think both the cost of the production of the actual physical robot falling significantly and lots of the parts becoming commoditized, and then more focus on the OS layer and the operations layer is a very interesting time. It feels like we're probably at a little bit of an inflection point in that market. we also like it because lots of other VCs don't. So it's hard to scale. There's a lot of technical challenge along the way. So that is definitely an area that we're leaning into, and I think is relatively overlooked by other investors.
Okay, great. Now coming on to you, Daniel, with ShipShape, what led you to create it, and how has its unique search engine model, do you think, influenced the VC landscape?
So we created it because basically I made a mistake in a previous company, and the CEO and founder of that company asked me to go and research which investors were interested in a very niche piece of tax compliance called FATCA and CRS, and they're building software in that space. And I realized that actually the information that's out there that's available to founders to find which investors they should be focusing their time and attention on is really poor, because you've got these sort of investor lists online and on LinkedIn that loads of them are flying around. You've got things like Crunchbase, PitchBook, etc., many of which are actually out of the financial reach of those that really need it. It's mission critical information. And so realize that actually there's a gap in the market there for enabling investors to market their capital in a digital way, rather than over-indexing on good networkers, which to date is still the primary way. And we don't think that we can fully displace that. Human relationships are always going to matter. But actually, if you're building like the next generation of, let's say construction robotics, you might want to focus your time and attention on investors that you know are interested in that space. So if Chris has spent the last year looking at robotics and has penned a few articles on that, we want to make the founder's job a lot easier by saying, actually, Chris might be one of the people that you want to focus your time and attention on because he's got an interest in this space. And so, I don't think we've necessarily influenced the market yet. Like, we're still really early days, but that's actually what we want to be able to do is, so if you're building a construction robotics company or like a compound semiconductor, like chip design, whatever it is that you're building, we want to make sure that you've got the maximum number of interested investors on the other side of the table. Because actually that's the best way of you getting the best capital for your equity. So that's sort of what we're building. And if you're a founder or if you know founders that are fundraising, it's free to use. Go to shipshape.vc.
Fantastic. Thanks, Daniel. I guess touching upon what you said, Nenad, earlier, the fact that maybe board meetings are a bit tense right now, and there's a lot of support coming on from VCs as well. But as technological advances continue really quickly, how do you ensure that your portfolio companies remain at the cutting edge, and how do you support their continuous innovation at DN Capital?
Yeah, I mean, that's well, for one, making sure we have the right CTO. And just an example, our company Job and Talent just hired a new CTO, and this guy's just amazing. He was the CTO of Booking.com before, and is really just taking the company to a new level. So it's working with the existing teams. I'm not a CTO myself, but we have quite a few people in our network that are, and so we will introduce them to people in our network. And so if it's for instance, every software or technology is different, so we try to bring the right people to those companies and help them out. It's always good if you can. It's not easy to get through, but you can have like a really good, strong product person on the board. I find that really helpful in portfolio companies. A lot of people don't want to have non-execs on the board. I really like it. I think it's super good. I mean, at the end of the day, a VC sparring with the CTO on a technical matter is a bit of a joke if the VC is not technical, right? And some people, really, if you peel the onion, you realize they don't have shit. And so putting someone that really has done something from a product technical perspective on a board or as an advisor can really help the company. And that person can then spar with the CTO and the product guys, and then it makes sense.
Yeah, great. And maybe Chris, on to you. What kind of maybe support do you provide to your portfolio companies in general?
Yeah, I think actually one of the most important things we do is create connections directly between our founders. So we do that through basic things, right? There's a couple of dinners every year, but we're also very careful to introduce the right people. So Nenad's example of like a CTO of a pre-seed or a seed company, we connect them with the CTO of a Series A or B company so they can have a really strong kind of mentoring relationship. So our job is often to make those connections and just get out of the way. I think that's super important. So that, and I think otherwise we just focus on the areas that we know what we're talking about. We don't try and do everything. So we particularly sort of focus on sales and go to market. We focus a lot on the financing side. And actually, one thing I'm surprised about, we really lean into the fundraising process. So like to raise money in this market, you need like 150 VCs at the top of your funnel. You need to be really, really well structured, batch all your calls. So we actually run that alongside or kind of for our founders. That's another big piece. And then we get stuck in with the sort of people side and the marketing side as well. But we kind of know what we think we're good at. We try and help with that. And then if we don't know, we connect them to the right people.
Okay, great. And sticking to you based on, your high conviction, maybe low volume approach that you have, whereas we see maybe other VCs do a lot of tickets and that balances the risk. But how do you balance the risk and reward of investing in fewer companies?
Yeah, it's a really good question. So, I mean, I think first of all, we kind of trust our process. We were talking about it earlier, but we do a lot of DD, right? We get really deep into the companies. We really try and understand them inside out. I think a few founders maybe think that's off-putting because it's going to take a lot of time or be a drag on their resources. We've done it in 8 days before. I mean, I never want to do that again, but we did. So we can do this process really quickly. So we do that. I think also our capital allocation model. So we hold back a lot of capital for subsequent rounds, because we know that you don't go from pre-seed to seed to A smoothly. It just doesn't happen, right? There's a seed plus, there's a bridge round, whatever it is. So we have enough capital allocated to support the companies to get to that Series A. And I think it's those two things combined. It's the conviction we've managed to build through the process, plus having enough capital means that we can give every company the best shot of getting to Series A. And that is actually what we measure. That's kind of our North Star metric, because the feedback loop in venture is so long. We need to have something in the shorter term, and that is how many companies we can graduate to Series A. Right now, we're about 75%. I think the industry average is about 20%. So something's working, and we're just going to keep doing the same.
Right. And I think, Daniel, now, with your experience, kind of touching on what Chris said in terms of it's not always smooth sailing to get from seed to Series A and pre-seed. What's your experience of that? What have you seen, or maybe your personal experience?
Yeah. So if I just look at the numbers from where we're being told that people want to raise, the vast majority of the 1,500 tech businesses that have used us to identify investors are looking to raise less than 2 million. So that already gives an indication, even though it's only like a snapshot in time. But it's not that long since September when this launched. It actually tells us there's a pretty high drop-off rate, and that's kind of what you'd expect to see. What's then really interesting though is if you look at where there's the total demand for capital. Actually, the total demand for capital that we're observing where it's highest is actually around the sort of the £5 million mark. If you're looking at a sub 20 million range, and that's really interesting. So it means that actually there is a really good space for picking stocks essentially at like a very early stage. So if you're looking at pre-seed or seed, that's actually a great space to be playing. You've got lots of choice. Whereas actually if you're starting off at like a Series A, actually whilst you might have like notionally better businesses at that point in time, there's far fewer to choose from, therefore much more competition between funds at that point in time. So that's I think really interesting. We've seen a couple of people actually, we don't at the moment collect data actively on those that have used us and then go on to successfully raise. We don't actually have like a direct workflow where we see deals happen once contact has been made. But we've got like a good half dozen instances where we've had founders reach out to us and say, hey, you helped us find this VC that we never knew existed. We've now completed a raise. And that actually chimes with our own experience. So we haven't done an institutional round yet, but we have actually used our search engine on ourselves. So we actually, the director of data science over at Greycroft, we reached out to using our own search engine to see who was interested in data science and venture. We used our search engine, and then he wrote a personal angel check into the company. So we want to make sure that we're eating our own dog food, even though we're not necessarily that widely covering angels right now. That was a good experience.
Great, thanks. Moving on to you, Ninad, and I think we have time for another question after this one. The traditional model, and I think you touched upon it earlier, right, is of growth at all costs has faced considerable maybe setbacks in recent years, with more emphasis on sustainable and ethical growth. As an investor, how do you reconcile the pressure for rapid scaling and profitability with the need for responsible and sustainable business practices? Is there a need to rethink the success metrics for early stage companies in general?
Great question. There's no one answer for that, unfortunately. It depends on the company, depends on the velocity, depends on the unit economics. So in general, we'd want to see companies raise money to survive for like 18 months without having, because if the management's fundraising all the time, it's very disruptive for the business, right? So 18 months or 24 months is a great period of time so they can build and get more new product iterations, get to certain milestones in terms of sales, in terms of team. So I think that metric kind of still holds out for us. And then it's really important that we co-invest with other investors. We like to co-invest, who also have enough capital to make the next rounds, and also have a similar mindset. Because you can always change the CEO, you can't change your co-investor. Not that we do. If we're changing CEOs, it's usually a big problem.
Right.
It's usually we love to have the founders go all the way through with us to exit. That's usually our best successes have always been that.
Okay, great. And Chris, maybe do you have anything to add to that? In terms of rethinking the success metrics for early stage companies, especially, if we take 2021 out as an anomaly, maybe giving some insights on that.
Yeah, I think as founders, you have to be pretty cautious. You're going to get lots of advice about preserving your capital and your burn ratios and everything else. But at the end of the day, it's harder to raise now. And so to raise, you need to have really strong metrics. So there's this natural tension between some of the advice you're going to get, which is be careful, slow down, don't spend as much, but you might pay actually a pretty big cost when you go out and raise again. So I think as a founder, you have to, as with a lot of things, take your advice with a pinch of salt, draw your own conclusions about how you want to build your business, because if you want to go on and raise the next round, you have to be going really fast. And you have to be in the top whatever, 10%, 15% to go and raise.
Yeah, can I add just one point? Chris raises a great point. I mean, if you're a super early stage company, you need to be growing like 100 to 300% per year to even get looked at. I mean, if you're flat growth and small, I mean, it's not going to go anywhere. So you have to be growing fast in the early stage. He's right.
Okay.
And just to add a question to that. So how much do you think, Chris, of that is influenced by GP LP dynamics? Because to me, that's a lot of advice that I see being given out by general partners at VC funds seems to be influenced by conversations that they're having with people who fund them.
Yes, I mean, it depends. I guess every GP-LP relationship is different. I guess one of the things that may be motivating that, burn less cash, be more conservative, is because then you don't have a complete write-down of a company and you can keep them alive longer. That would be a super cynical way of looking at it, but it is possible. As I said, but ultimately, I think what GPs and LPs are actually aligned, because they want outlier successes in their portfolio because it drives returns. And to do that, you have to grow fast. So I think actually one of the biggest mistakes I've seen recently when founders pitch us is that they've not been able to raise the amount of money that they wanted. They've cut the round size. They've also cut their runway. And so I had several calls recently where we're going to raise 8 months runway, and then we're going to go and raise again. It's just not going to work, because in reality, you need 6 months to do your process. So you're basically saying, I've got 2 months to build and go raise again. So I totally agree with that. 18 months is an absolute minimum you need to raise. And if you can't, then I think you need a plan B, whatever that is, whether you bootstrap, whether you do something else, but you need that amount of capital.
Thank you. Well, so I wish we could continue this discussion for a bit longer. I think we're tight on time. So I think one last question for each of you. What's the single biggest tip, and I know you probably have a dozen in your head, that you'd give to founders right now that are looking to raise capital? I know we've touched upon a lot of things. So Chris, maybe you'd like to start.
This is going to sound really trite, but be patient, because the processes have elongated. It's really easy to get disheartened, and you need to go into every interaction with an investor on the front foot, confident and energized. And so every process is going to have the passes come first. So you're going to get pass. And if you get downhearted, investors will pick up on that and it'll feel like a really negative thing. So manage your emotions, stay confident, stay upbeat, and you've got a better chance of getting it done.
Great. Daniel?
I'd say probably, and again, like I don't see as many founders pitching as either Nenad or Chris, but do your research. If you're time pressed, you want to be focusing on people who are most likely to give you money and understand your business. So you can invest a lot more time by focusing on like a couple of dozen investors that really understand what it is that you're doing. And that, I think, if you look at the time that you allocate to a fundraising, actually, if you can allocate more of that time in building genuine relationships with those people, actually, that's really where we believe actually you're going to see much more success as a founder who needs to raise capital.
Great. And last but not least, Nenad?
Sure. I'd say be bold, be resilient, but also be true to yourself. And is the company or the product you're offering really needed out there? And just make sure you're going after a market where there is really demand, or where innovation, where something you're creating doesn't have demand today, but you think will be amazing, and just be true to yourself, because otherwise, I know everybody wants to be an entrepreneur because it's fun and everything like that in some ways, but it's also a very, very tough job, and everyone knows that on this call. And so be true to yourself, and also if you've already started something, at some point you can see if it's working or if it's not working. If it's not working, it's not the end of the world. Say no and just switch and do something else, or even go work for another company for a while until you have a better idea and then go do something. But a lot of people hang on and spend all their savings and their wife's savings and everything. So you got to be really mature in this market and make sure you think that this thing is viable.
Great. Well, I'd like to thank each and every single one of you. Thank you for joining us today. And just for everyone watching us, just stay with us. We'll have a short break and then we'll have our first session of company pitches. And then later on, we'll have our FinTech panel. But thank you, Daniel. Thank you, Chris. Thank you, Nenad. It's been a pleasure.
Thanks for having us. Bye.
Thank you.
Thanks.
Chris, an associate here at Wholesale Investor. For the rest of the day, I have the joy of introducing our speakers. Over the past few months, I've had the pleasure of speaking with and learning more about our upcoming companies presenting today. I've learned what about them gives their competitive edge over others in their market, and hopefully you'll find them as insightful as I have. Now, as nice as it would be, I'm sure you didn't come here to listen to me, so let me introduce our first company. Peazi, CEO Niels Nielsen. Now, Peazi's self-ordering solution helps hospitality venues improve guest experience while increasing sales and profitability. So I'll hand over to you, Niels.
Hi, I'm Niels Nielsen, CEO and co-founder of Peazi. Prior to setting up Peazi, I've spent 30 years supplying and consulting to the hospitality industry on tech solutions that were helping to improve operational efficiency and bringing consistency across multi-site operations. Peazi is on our mission to help 100,000 hospitality venues around the world to give customers the experience that they want using AI-assisted software. We're a business-to-business application, AI-powered SaaS platform, and we're currently looking for seed funding. So what's the problem? So people go into hospitality venues to enjoy themselves. They tend to go in with friends, family, or business colleagues so that they can socialise. What people don't like to do is to queue up at a counter or queue up at a bar or alternatively, if having table service, have to wait to be served, or worse still, try and flag down serving staff as they walk around a busy restaurant. And they certainly don't like to wait to pay the bill. For hospitality operators, it's always been difficult managing peaks and troughs of services. And it's a case of when it comes to the current market, there's a shortage of labour staff. This is international throughout not just Europe, but also the US. The impact of this is during busy times, staff get stressed, service levels drop, people get frustrated, they don't tip, the staff morale goes down, and it just causes a lot of problems, and that leads to bad reviews and no return visits. So what's the solution? We've created Peazi, an AI-assisted hospitality software platform that helps venues to save money, make money, and deliver killer customer experiences using cutting-edge technology. Peazi is driven by our AI-powered menus. Now, whether that's a case of using traditional members of the team using table-side ordering pads, or alternatively counter-serving terminals like traditional EPOS terminals, but more intuitive, or better still, as in 68% of cases, letting guests place their own orders, which, given the choice, more than 68% of people would rather order themselves than wait to be served. So guests can help themselves to service using either their mobile phone or alternatively on a local kiosk. The menus will actually talk them through, and the thing about our electronic digital menus, they are interactive. They only show current items that are available to buy at this moment in time. If something's out of stock, it will immediately disappear. If there are long wait times, it will inform them. If there are special offers or new products that they should try, it will help them to find those items, and it will help them avoid any allergens and things like that. In general, it just gives a better service. So the impact for our venues that have implemented this technology is they've seen numerous improvements within the business, whether that's 480% increase in tips, 22% increases in sales, they've got increased GPs, even reporting huge improvements in turnover as operational efficiencies have improved, and the number of customers they can serve in short space at a time massively increases, and huge reductions in labour costs. And most compelling thing of all is that customers get far better service and return more frequently. So Peazi is proven. We've processed more than £35 million through the platform, 2.5 million transactions, captured lots of behavioural data that's helping us to build out our AI model. We've got 100% 5-star reviews, and now having carefully onboarded a large number of clients throughout different areas of the hospitality market, we're now targeting our key growth areas and building out our marketing funnel to increase sales. The size of the hospitality market has got over 2.5 million venues in Europe and 660,000 venues in the USA. Our overall objective is to onboard over 100,000, but our shorter term objective is over the next 4 years is to get to 20,000 customers that will give us over £70 million annual recurring revenue. We currently earn our revenues through monthly subscription fees along with transaction fees, occasionally service and setup fees along with hardware sales. We've got future potential earning coming from the licensing of our AI as a service to other hospitality platforms, and also for the opportunities of product sponsorship. So we're currently raising £500,000, and that's to help us to bring Peazi to more clients. We've got our market fit developed well. We're now at a point where we are having built out our new website, got the marketing engine all geared up for the pay-per-click and so on, it's now about helping us to gear that up and get closer to our £1 million annual recurring revenue, which we're expected to hit early next year. And then take that onwards to the 20,000 sites over the next 4 years. We're currently already investment backed with the British Investment Bank, Syndicate Room, SFC Capital and some other angels. We've got a really strong team, as well as myself with my experience in hospitality. My co-founder, Dave Pickering, is a really experienced CTO who's been focusing on cloud computing for the last 15 years of his career, and also AI technology. Then we've got a great product manager with over 10 years experience and a really talented and passionate team who are helping us take Peazi and deliver great services. In summary, Peazi's got a large hospitality community. We've got a strong product. We've got a very, very low churn rate, a lot of success and testimonials, some great raving fans who love the product. And then it's a case of a high growth and high return opportunity in an emerging market, and the option of licensing our AI in the future, and utilizing all the behavioral insights that we've gathered to date. So if this sounds like something you'd be interested in, then please do reach out to us. I'm Nils Nilsson, I'm the CEO, and please get in touch, and I look forward to hearing from you. Thank you very much for your time.
Now we have Kikapay Limited. Kika's direct from bank payment solutions enable merchants to collect payments in a fair, fast, and secure way from their customers. So here's Chris Moore to tell you a little bit more about that.
Hi everyone, my name is Chris Moore, and I'm here today to talk about Kika, our payment solution. We are bringing innovation to the payments market, and this is something that governments and regulators around the world are pushing for in almost every country. What I'd like to do is share my screen with you, and just to talk a little bit more about what we're offering. So Kikapay was set up by myself and Philip Godden. I have a background in payments for the last 15 years, leading advising governments and industry on payments and payments innovation. Philip comes with a background of designing and implementing finance systems and integrating solutions to those. Together, we want to bring fair, fast, and secure payments to the market. So we saw a real problem in the market for payments, in that the cost of accepting payments by card were borne by the merchant and passed on in higher prices to the consumer. These higher prices came from a 1 to 4% charge on the average transaction of the value. Merchants also have to wait 3 to 5 days to receive the money from the customer's bank, and they're also prone to fraud, like chargebacks, and liable for fraud like chargebacks. That's why governments around the world are looking to mandate banks to enable payments like Kika, and we are well positioned to take advantage of this. The problem with card payments is that the infrastructure is old and there are many players involved in the infrastructure. This means that it's slow and it's expensive and it's prone to fraud. Our solution, Kika, resolves these problems. Kika uses a QR code or a link that enables the customer to be redirected to their online or mobile banking app, and it's from there that they make the payment directly to the merchant. The payment is fast, and because Kika is not involved in the transaction flow, it means that we can price it competitively, and it's also super secure, far more secure than a card payment. The paying experience is better than a card as well. The customer, there's no app to download for the customer, and the customer is familiar with their mobile and online banking. On the very last slide of this presentation, there's a QR code where you can try a payment for yourself by making a donation to a worthy cause. Please get your mobile phones out to scan the QR code and try it for yourself. There are so many opportunities that we could go after in terms of replacing card payments with Kicker payments. We wanted to remain focused on sector. We use 3 criteria for choosing which sectors to focus on. The first was the value of the transactions. The higher the value of the transaction of the payment, the greater the value we could deliver to the merchant. The second is the type of merchant that we choose. Our payment solution is better for where services have already been delivered and the merchant are now seeking payment for those services. And then the third criteria is the value that we can deliver to the merchant has to be meaningful. Tight margin business is where the savings that we can deliver are meaningful, prioritizes our project above others. This led us to focus on 3 sectors: bill and mandatory payments like utility bills or fines, for charities for collecting donations, or for account top-ups of prepaid accounts or for money transfer accounts. There are 540 billion card payments worldwide and 100 billion direct debits, all of which are called pull payments. Every economy is looking to move to all of these payments to push payments across the next 20 years. And we are at the forefront of that change. In the UK alone, there are 12 billion payments each year in our sectors, and we're looking to capture 4% of that market by 2025. We have fully launched in the UK with revenue clients like Northumbria Water and MasterCard. We have a number of other small and medium-sized clients taking payments using Kicker, and our pipeline is strong as well that we'd like to discuss with you separately. But to deliver this pipeline, we need investment, and we also would like you to come on this journey with us. Please get in touch with us to learn more. We're different as well to other companies in our market. We offer fair pricing based to existing payment services and to our future payment services. We have a number of different integration solutions enabling us to bring these fast payments to the market. And we have focused on sectors that are super secure, like utilities, meaning that we offer the most secure payment solutions in the marketplace. We have a strong leadership team with experience in payments, as well as a strong network across business and the payments industry. We're also aligned on our motivation to bring fair and faster payments, and this is reflected also in our pipeline, bringing future products like enabling households to more easily pay utility bills and household bills. Thank you for your attention, and if you'd like to get in touch, please reach out to us on the details below. You can also try a payment using the QR code on this final screen. This charity, which is a client of ours, is helping Syrian and Ukrainian refugees, and it's a worthy cause. Thank you.
And up next, we have ClearMacro, presented by Niall Boland. ClearMacro is a sat-nav for the wealth industry, helping clients leapfrog a generation of institutionalizing their investment process.
Hello, I'm Mike Simcock, founder of ClearMacro, an early-stage revenue-generating wealth tech company that addresses a critical problem for subscale investors and advisors, namely that they often lack the capabilities to dynamically identify what a constantly evolving macro and market environment means for their big picture investment views and their asset allocation decisions. This capability gap is a big problem because a large body of research indicates that asset allocation decisions account for over 90% of the variance in portfolio return outcomes. Instead, investors and advisors typically spend most of their time on stock picking or fund selection, probably because there are plenty of tools out there to do that. And it's often easier to create client narratives around these well-known companies and fund managers. But it's not what the research tells us actually matters for returns. Investment process challenges are present in nearly all investment firms, but they're compounded when firms are subscale. Structural capacity constraints often lead to real pain points, suboptimal performance outcomes for clients, high cost bases for firms, low client transparency, all of which ultimately leads to challenges in growing and scaling a client business. ClearMacro addresses these structural challenges by doing much of the heavy lifting, providing an off-the-shelf tech solution for advisors or investors who either have no existing asset allocation capabilities or they want to strengthen their existing processes and or broaden their investment opportunity coverage. To clarify, ClearMacro does not sell the end investment or fund, but instead we provide the keys to your own asset allocation decision-making processes that you drive. Typically, we're part of a tech stack that an advisor has in their toolbox to achieve several investment process objectives. The asset allocation piece that ClearMacro provides links most directly with the outputs that comes from an advisor's risk profiling service. And then ClearMacro's outputs essentially interface most directly with the investor or the advisor's actual implementation decisions, funds, ETFs, or directs, and using their choice of screening tool. So our SaaS service is most relevant to firms who want to enhance their asset allocation process and decision-making capabilities at a fraction of the total cost and time that it would take to build them internally, or to firms who want a route map to differentiate versus their competitors. For example, being seen by their clients as being on a multi-year evolution of introducing data science, tech, and quant into their investment processes. To firms who want their stakeholders to have better experiences. For example, one feedback we hear over and over is that advisor-client interactions are overly stressful. We think that with the right tools and messaging in place, these meetings and calls will be less reactive and much more structured. To firms who want to build client confidence and trust and increase the probability that end clients will experience better financial outcomes. And in the process, increasing the chance that the firm can grow its AUM, its fees, and win new clients. To firms who want to reduce their key man risks, which is particularly important in smaller, more subscale firms. And finally, to firms who want to bring new strategies or funds to market much more quickly. A good example of this is a UK wealth client of ClearMacro's that recently launched a suite of active asset allocation ETF portfolios powered by ClearMacro. The end-to-end process and launch took just under 4 months. So a good analogy to what we do is the sat-nav, helping you to get to your preferred investment destination quicker, more safely, and with less stress. And in this new digital CIO product space, we want to fill the very large gap that exists between naive robo-advisors and the expensive and challenging to onboard BlackRock Aladdin. So what do we actually do? Well, in short, we collect millions of data points every day. We turn the data into actionable insights that offer forward-looking perspectives on the investment outlook and clients' portfolios. Our outputs and our tools help inform a client's investment decisions, providing them with a North Star strategic asset allocation and the capabilities, should they choose to use them, to make better informed and judicious tactical portfolio tilts and portfolio rebalancing decisions. Here are a couple of interfaces of ClearMacros that are used by clients. First up, a portfolio diagnostic that provides real-time analysis of the forward-looking prospects of a client's portfolio with nudge suggestions of changes in the portfolio that the client might want to consider, all of which are linked to investment view dashboards with click-throughs to explainability, which we think is critical for advisor narratives. So we're increasingly asked how we use AI at ClearMacro. We believe that AI can be incredibly accretive to an asset allocation process, but only if it's judiciously applied. So we use AI where there's either too much data to analyze or too many pathways and iterations required to solve a particular problem. We typically would not use blanket AI to drive final conclusions, mainly because we think it suffers from explainability and transparency problems. So we believe that solutions to complex investment problems require hybrid skill sets. And so we've complemented our management team, all senior leaders from sovereign wealth and hedge funds, with highly credentialed experts from academia and Silicon Valley. At the end of 2019, we received a strategic investment from BCI, the Canadian pension fund, and this jumbo seed round enabled us to complete both the upgrade of our data pipeline architecture to bring it to the industrial grade level, and also to complete our recent proof of concepts in the family office and the wealth segments. Having steered the business through this rebuild, we now have live customers in multiple segments and geographies, including a large Japanese asset manager, Nissay Asset Management, who recently won the 2022 Celent Award for their new digital investment platform, which is powered by ClearMacro. So after raising £8 million to date, we're now raising an additional £4.5 million spread over 2 tranches. The capital will cover our operations through to break even, which we'll achieve through a commercial scale-up. So thank you for your time today. As an early player in the burgeoning digital CIO space, we believe that ClearMacro offers a game-changing opportunity and a lucrative opportunity to investors. Please do contact us if you have questions, both through the network or either through the networking tools on the conference app or directly at the email address shown on this page. Again, thank you very much for your time today.
Now we have Pulse.io. Pulse is a machine learning AI analytics tool for marketing agencies that predicts the outcome of creative content before publishing. So over to you, Joe. Looking forward to hearing your insights.
Marketing agencies are at present not using any sort of technology to identify how their creative is likely to perform. Pulse is the first machine learning AI that is able to predict how people are likely to react to a piece of content before it even goes live. The benefit this can provide to marketing agency campaigns is maximizing return on investment. Campaigns are split into 2 sections, the creative and the strategy. By maximizing the efficacy of the creative, you maximize the return on investment derived from a high-quality strategy. This is where Pulse enters the market and becomes incredibly valuable as an asset for marketing agencies. Our main competitors in the space at the moment are Brandwatch and Talkwalker, both of whom are leveraging technologies from 2008 and 2012 respectively. That outdated technology means that all they are able to do is identify retroactively how people have felt about subject matters on a sentiment basis. We're identifying how people feel on an emotional basis, giving more contextual insight and understanding into how people will react to content within specific audience segments and with specific hobbies and interests to really niche down and target audience campaigns and maximize return on ad spend. The average marketing agency in the UK worth their salt achieves somewhere between 6 and 7x ROAS. By leveraging Pulse at my agency, Encore, we have been seeing something in the region of 12 to 13x ROAS consistently. This has been by leveraging big data analytics and machine learning AI to predict how people are likely to react to content before they even see it. Our intuitive user interface enables marketing agencies to go from start to finish through the entire development and execution process of any campaign, all the way from ideation through to reporting, meaning that an agency can not only come up with the idea that they are trying to produce, identify how audiences feel about the related subject matters, script and identify how they are then going to react to the creative produce, schedule and post that content, and then report on everything all in one place. We've published a paper in IEEE showing that our machine learning AI operates at 96% accuracy, far superior to any other product currently on the market. Our predictive AI analytics is able to identify with 96% accuracy which audiences are going to feel which emotions at which point in time based on petabytes of real-world data. In addition to the paper that we've already published, we have a number of papers that are pending review at present and will be published over the course of the coming 3 to 6 months. Pulse as a concept came naturally to me as an agency owner of a multi-million-pound multinational marketing agency group with north of 15 million a year in revenue at present, scaling to a 1,500-person marketing agency group over the course of the coming 18 months. I've been featured in Forbes 30 Under 30, and I've enabled our agency to scale massively within a very short space of time by leveraging big data insights. I know what the appetite is for this product and what the demand will be. Notwithstanding the fact that we've already had 31 agencies subscribe to be part of our founder member community. In addition to this, we also have a number of large institutions that will be engaging on an enterprise basis with our SaaS model business platform. Our machine learning team is second to none, with lecturers from MIT, machine learning experts who are also working on projects including the Large Hadron Collider, as well as a number of other individuals across the entire business, with north of 15 employees in total producing the Pulse product at present. Our business model operates on a SaaS basis with 3 core tier subscription plans. This enables marketing agencies of any size to engage with our product, as well as enterprise-grade entities. We are also able to accept small to medium-sized enterprises by providing an access that will cost no more than £6,000 per year, billed at £500 per month. No one else in the industry of sentiment analysis is doing this. Our operational margins are significant, meaning that we are able to make large amounts of profit and reinvest capital back into research and development over the course of the coming years to remain competitive and scale the business model so that we can reach additional audiences, additional business sectors, and additional sized clientele. We are seeking to raise £2.5 million against a valuation of £15 million based on the intellectual property value of the business. Our valuation presently does not include the forecasted future revenue of the business, in spite of the fact that our current future monthly recurring revenue forecast is showing a minimum of £500,000 per month from 7 months from now. Notwithstanding the fact that we've also had an offer for $25 million in the middle of last year to acquire the business, purely based on its intellectual property value. The capital raised from this investment will be used for us to scale the team, reinvest more capital into R&D, hold cash at bank for fluctuations in cash flow over the foreseeable 6 months, while we're enabling founder agencies to join and to become part of our community. It will also be used for additional advertising. It will be used to scale the business model and to reinvest into new UI UX design for the platform and expand its capabilities. We are also pending on an SEIS EIS tax relief application, meaning that some portion of our investment fund will also be eligible for SEIS EIS relief. Our initial forecasts for year 1 of trading were £5 million. We are now forecasting closer to £8.5 million year 1 from platform go live. In addition to this, we are also expanding into the US in 2024, providing a larger audience base from the 25,000 agencies in the UK to the 250,000 agencies currently operating in the US. For more information, please get in touch today.
Next is Justin Sycamore. to tell us more about Arcfina's new generation of hedge fund technology focused on credit strategies to exploit the impending adoption of tokenized securities.
Hello to everyone at the Venture and Capital Europe Conference 2023. My name is Justin Sycamore, and today I'm going to talk to you about Arcfina, a capital markets-based technology platform that is addressing a problem facing hedge funds that trade credit strategies. More about that in a moment, though. First of all, I'd like to tell you a little bit more about myself and the team. I've been working in fintech since 1996. I originally trained as a software engineer. I moved up through sales leadership, and most recently as senior management within some of the largest industry vendors. This is not the first startup that I've founded. In 2008, I created a SaaS-based firm that I grew to over 1,500 clients, over 500,000 users, and I sold for profit in 2016. I've been working on this project self-funded since October 2021. I'm joined by Muriel, who I've worked on the project for the last 18 months full-time. He is a seasoned CTO. He's run teams and built development teams. He's also a hands-on coder, which is essential at this stage of the business. Further down the line, we'll be joined by a CCO. He's currently at another industry vendor, but I've worked with him for several years, and he has a strong network of contacts and a proven sales track record. Now I'd like to tell you a little bit more about the market that we're addressing and credit hedge funds. So credit hedge funds are a segment of the overall investment management industry. They focus on very specific instruments: bonds, loans, repurchase agreements, also known as repos, and also derivative asset classes such as credit default swaps, interest rate swaps, and total return swaps. They combine them together and trade them in strategies, and they need to see the analytics associated with the individual instruments and the strategies combined together. They also need to have the workflows that are supportive for them, and they need to have a platform that supports their compliance with the mandates of the fund. The industry is also one that's growing. So the credits are in particular with current interest rates that are high, and also political uncertainty and market uncertainty means that a lot of institutional investors are pushing their funds towards credit strategies. I'd now like to talk a little bit about the product itself. So as you can see, an investment management system has a number of different components to it, as you can see in this diagram here. The one that is not done well by the existing vendors is credit portfolio management. So many firms will have an existing solution, or they will have attempted to build one themselves, and they will patch it up using Excel or Power BI, or even, as I said, develop around it themselves a little bit. This is a great cost and also great risk. But why is that? Why do these firms have to do that? The reason is that the existing vendors, as I've seen firsthand myself, are all now very large companies, which broadly puts them into two categories. Either they do have a solution that does this, but they only service the very top two tiers of the asset management industry. And that represents about 200 firms out of 28,000. So a very, very top layer. Or they're the type of firm that does service the smaller to medium-sized firms, but they are also part of much larger conglomerates. So they are at the cash cow stage of their life cycle, which means that their development teams are focused on very short-term revenues between the 12 to 18-month range. So they're no longer entrepreneurial, and they no longer focus on this space of the market, which obviously provides a major opportunity. This is a complex solution as well, and that protects us from new entrants coming into the market at the same time. In addition, there's a greater opportunity on the horizon relating to the advent of shared ledger or distributed ledger for use within the capital markets operating infrastructure. The current infrastructure is out of date and very archaic. Most funds will maintain their own independent database of the trades and the portfolios that they hold, and they'll have to reconcile that every single day with all the other market participants, whether that's the administrators of the fund, their trading partners, or indeed the market regulators. This costs the industry huge amounts, and it also brings in a lot of risk due to errors that may occur during the reconciliation process. Moving on to shared or distributed ledger means that there's significant opportunity to implement a golden source for the source of trading and portfolio management. Arcfina has been built from the ground up using a ledger system that supports this future world. So to summarize what Arcfina is, it's an investment management platform that is specifically geared towards the analytic and workflow requirements of credit hedge funds. It's also been built ready for a future world that is based upon shared ledger in terms of capital markets infrastructure. And thirdly, it's been built with a clean sheet design to allow us to really take on the markets beyond just credit hedge funds in the years to come. I'd like to talk briefly about the size of the market as well. As you can see from this chart, the total market size is $6.3 billion a year. That's the amount of money that hedge funds and asset managers spend on their investment management system each year. Our focus to start with is the vertical on the left-hand side, the credit boutiques. There are about 3,000 firms globally of those, and we're seeing more and more open up each year. They represent about $450 million worth of revenue. On top of that, there's about 13,000 asset managers who have credit teams. That's another segment for us to go after, where we can sell a product that the credit teams can use in conjunction with their existing investment management system. That's, as I said, that's about 13,000 firms. So in total, that's about a $1.5 billion market that we have a product for which we have a unique offering that isn't done well by the existing vendors. But of course, beyond that, we have a $6.3 billion adjacent market that we can go after as well once we've established ourselves as a credit fund specialist. So finally, just to talk about the ask and where we are. So we raised pre-seed funding about this time last year of £335,000. That was from 8 angel investors. That allowed us to build the product, launch the MVP, now in production. We have 2 signed clients. We're receiving revenue. We have other active discussions in place with some other clients, but we can't take them on board yet until we get more funding. This round of funding, a £500,000 raise, would allow us to continue to build the product and take us up to between £300,000 and £400,000 worth of revenue, which would be between 5 and 7 clients. As I mentioned, we already have a very good idea of who they would be. And that would then be the platform for us to either continue to grow the business organically or to raise seed funding to allow us to accelerate the size of the sales teams. And then in 2025, that would be a platform for us to look at Series A to launch in the US and Asia Pacific, both of which are large markets as well. That's it from me. I hope that was a good overview of Arcfina. I'd love to talk to you directly if you're interested either as an angel or as a VC. Please do get in touch with me. Here are my contact details. Thank you very much.
everyone. Welcome back to today's session of V&C Global. I have the utmost pleasure of inviting our next panel, the Fintech panel. This is how Fintech is reshaping global transactions. Chris Moore will be moderating, but we also have the pleasure of having three very distinguished guests with us today. But I'll let Chris take over from now on. Thanks for joining, guys.
Yeah, thanks, Hugo. Yeah, for the next 40 minutes, we'll be looking at how Fintech reshapes global transactions and the investor perspective on how fintechs are disrupting these traditional markets. We have on the panel today, we've got David Fiseo, co-founder of Wealth8, empowering communities to build wealth through education. We have Eric Collins, serial entrepreneur and investor, host of Channel 4's The Moneymaker, and CEO of ImpactX Capital Partners, and Eric Mostanicki, fintech investor at Fidelity International Strategic Ventures. What we're going to do is explore a general question of how fintechs are disrupting the market, and allow each of the panelists to give their views of that, together with an introduction of themselves and also the companies they represent. Maybe if I can start with Eric Mostanicki. Being two Erics on the panel, I'll probably have to use your surname, but if you could kick off talking about your background, your company, and a general overview of the market. Thank you.
Sure, definitely. So hi everyone, nice to be here. Thank you very much. So I'll start with my background, and that will kind of lead into the whole discussion. I have ended up in Fidelity 5 years ago, but prior to that, I was for all my sins a founder, a banker, and a strategy consultant, and all of those in the past, more than a decade ago, across areas of fintech before it was called fintech. So that has led me to the kind of the specialization that I'm leading the efforts on, which is primarily investments into companies that have a relevance to the asset management, wealth management, capital market space, as well as the underlying enterprise software that is linking into it. And from a Fidelity standpoint, we tend to focus on companies that are a little bit more mature across their stages. I would say Series B is kind of the sweet spot. And the effort has been going on for the last 5 years, just for our team in particular. We deployed $200+ million, have 18 active portfolio companies, done 4 exits in the last year. But the fintech market has been very active, so a lot more to do there. If we think about a little bit the market and its transitions, obviously over the last 5 years that I've been an investor, it's been going through a massive transformation on the fintech side, and perhaps a lot of investors, as well as generalist investors, started flogging into the hype of the potential of the disruption around core financial services incumbents, whether that's banking, lending, wealth management, asset management, even the capital markets elements to some extent, although those are a little bit more conservative. It has created a massive head rush that, culminated in 2021 being very toppy on valuations. And we know that the economy, as well as the geopolitical space, has transformed on the back of it. And we're still seeing the pressure, in particular in the UK, with the rising interest rates and still the price of pints not going down for those that enjoy a bit of a social setup. So I think that is still visible across the consumer fintech landscape, and some of the projections that our team has been doing is primarily around the consolidation going forward. So you see a lot of business models that got funded in the past that weren't able to create a scale to adjust for the fixed costs and have profitable margins. So we would expect a lot of good innovative companies to rehome themselves back into the incumbents, to put back some of the capabilities that the incumbents are missing out on when it comes to the innovation curve. So that is on the consumer side primarily. And then there's still a lot of opportunity around wealth, the unbroken holy grail of holistic advice, the potential to advise the aging population across disparate markets in Europe hasn't been cracked neither. So I think there's still a lot more things to be done that the newer technology can hopefully enable us to do so.
No, thanks very much for that, Eric. And maybe just The same from Eric Collins, your views.
Thank you for having me also. I'm sorry I'm here at Microsoft Reactor today, but it's good to actually be here. It's a little buzzy around, so I will turn off my mic when I'm not speaking. Thanks for having me. Eric Collins. I started life as right after law school as a strategy consultant. I spent my time in strategy consulting really looking at tech, media and entertainment. That was what our firm focused on. From there, I transitioned to be a operating C-suite executive in 4 fast growth technology companies on both sides of the Atlantic, all of which sold to public US companies after a period of time. The interesting thing about all of them is that although some were in consumer tech, some were in health tech, all were were AI enabled, whether it be natural language processing, so the big language models, or whether it be computer vision, all of them had at their core artificial intelligence. And this is starting about 15, 18 years ago. I then started, along with a group of co-founders, a venture capital firm called ImpactX Capital Partners back in 2018. We invest in underrepresented entrepreneurs in Europe and the UK. We focus there because of an inefficiency in the marketplace. Our belief is that if you follow the crowd, you'll get the same results as the crowd, but that if you follow places where there are inefficiencies, you'll find opportunities to actually be able to deliver a large amount of alpha to your LPs. So we as GPs have been focusing on digital technology, health education, and well-being, and media and entertainment. There are areas across Europe and the UK where women and people of color over-index. As part of digital, we actually have in our portfolio, of the 25 companies in our first fund, we have a large number that are in the fintech space, of course, because that is a space, when you think about Europe, that and probably health tech, are leading areas for the gold standard worldwide. So if we're talking about investing and sort of really focusing on those geographic territories, fintech is a place which tends to deliver well. In our portfolio, for instance, there are 2 interesting organizations. One that was started by a Bangladeshi Brit. It's called Raylo. Raylo is in the sustainability space. It's a circular economy, but it's actually a fintech company when you think about it, because they're taking cell phones and instead of using a purchase model, use a leasing model. And after 2 years, those phones returned, refurbished, and sold on to another market. But the interesting thing is you have to have in place a very sophisticated financial tools and financial structures to be able to fund that intaking of assets, that then leasing of that activity, sort of managing the risks that are associated with it and insuring against it, and then being able to then take that forward into secondary markets and continuing doing that over and over and over again. They are an organization that in the first quarter raised about, during a very tough time for raising, 136 million. And so they are on a good path. We love that kind of an organization because it's not an organization that a lot of people looked at for whatever reason. Another organization, it's a fintech company that's a unicorn and actually was recently named by the Financial Times as the 2nd fastest growing company in Europe, is Marshmallow, started by 2 Black Britons. They are also in our portfolio. We invested when they were 30 million pre-money valuation, and 18 months later, they're 1.2 billion. And they are now reporting that they are cash flow positive and actually moving to profitability. The kind of organization started by 2 Black Brits that you'd like to see. Again, it's a fintech organization because it's in the insurtech space and really disrupting there. What we have found by focusing on both the Venn diagram of both market inefficiency and then where there is a great amount of deep pools of talent, that we have been able to find in the UK a great number, and in Europe a great number of opportunities that then are delivering back to our LPs. The thing that I have noticed though in this particular market is that obviously the market is very, very challenging with interest rates, as Eric was saying before, and some other sort of headwinds that are present in the market. One of the other things that is very much present is that there has always been in the UK and Europe a tendency toward proven business models, and those proven business models and sort of very durable and robust models for business, for your unit economics and sort of building out the right kind of infrastructure to grow businesses as opposed to throwing lots and lots of capital behind it. That sort of investing has been very, very good. But it has meant that we often find organizations that are somewhat segregated into this market, whereas in the United States, they can actually find a great deal more capital to invest behind novel ideas, to actually take lots and lots of risk. We in the capital markets here in the UK, particularly in the venture space, are not as risk absorbing. And so one of the things that we find, and one of the challenges that we find, is that our organizations often have to go to the United States after a few early rounds to be able to find the kind of capital, to be able to continue growing, to be able to compete on a global scale. These are global ideas that have global applicability. However, we still find that in Europe, there's not as much appetite, whether it's because they're underrepresented or whether it's because we're just conservative here in Europe, I'm not sure. But in any case, we find that the only solution seems to be going offshore. I think that would be it from me, Chris. Thanks a lot.
Very good. Thank you. Thank you, Eric. And David, so maybe just a bit of background on yourself as well.
Great, thank you. No, thank you for having me, and looking forward to speaking today. So yes, I'm the co-founder of a fintech called Wealth8, and we are empowering people with African heritage wherever they are to build wealth, do financial education, and then saving, investing in diversified portfolios to reach their financial goals. And in terms of my background, so I started my career off initially working within kind of digital consulting at KPMG, where I specialize in customer and digital proposition design for challenger and retail banks. And in addition to this, was the founder and director of the social enterprise that supports diverse founders to build and scale businesses. And my passion really is all about in this world, how do we use technology to drive social impact and economic empowerment? That technology can be used for so much, but how do we actually use this to foster the next generation? And into the second question around some ways kind of seeing fintech disrupt. So yeah, I think we've all been familiar, like the worlds of payments, remittance, or banking, how technology has really kind of opened up access. And I think what's interesting is like today you start to see a lot more interesting use cases. So I'm going to go outside of my world a little bit, because I think we'll talk about that a little bit later. But in the world of insurance, so it's great to hear Eric talk about Marshmallow. And I kind of look at it, sometimes insurance is not something that is, it could be maybe traditionally boring. Sorry for all the insurance maybe on the call, but this is obviously changing, because what you're seeing is with like InsurTech, embedded insurance, possibilities for more efficient and accessible ways. I look, for instance, in the continent of Africa, where out of 1.4 billion people, only 3% have access to insurance. And you take out South Africa, and this is 1.2%. But what you're now seeing with technology is now that the second fastest growing region after LATAM. You're seeing insurance crosses a number of industries, because it crosses health tech, prop tech, agri-tech. So it really starts to go to what are the real problems people are facing, and how do you find innovative ways to protect people? And I think you continue to see this rise in innovative ways to actually meet the needs of people using kind of financial services.
Fantastic. David, thanks very much for that. And look, lastly, a bit on myself. I run a fintech called Kikapay. We offer direct from bank payments in the UK, offering bill payment solutions to utility companies and bill payments and charities and wallet loads and money transfer companies. So, of course, I'm very interested in the panelists' opinions. Just in a bit more detail, therefore, maybe we could explore about how financial education plays a role in the democratization of wealth, and how fintechs are platforms are facilitating this, as a follow-on question for David. David Faso, maybe you could just talk a little bit more about that.
Yes, so I'm going to start. Education is one of the most fundamental building blocks for financial success. Knowledge is power, as we all know. And I think an issue is overarchingly in the society we live in, education is not prioritized well enough. And I'm going to speak from a personal point of view. I studied maths, economics at A-levels. I did business finance at university. I started my career working in financial services. And I probably knew the technical calculations of how interest is charged on a credit card before I knew really what is the rationale and the logic behind building credit and what is the purpose of it. And even though on my 18th birthday, my first student account, I was sent a letter with big CTA, here's an overdraft, here's a credit card, but I thought it was a birthday present. And I feel that in society today, and looking at the next generation, people are told consumerism, how to buy stuff. Everything you advertise from Instagram to the tube is purchase, purchase, purchase. So I think education is fundamentally key. And I think the great thing is we're seeing fintechs now really finding innovative ways to provide that education and doing it in a way that's fun and engaging. And you have platforms like Wealth8 where we kind of focus on community and content in a way that resonates with the communities we serve. But finding even more fun ways to do it, like your money personality, go introspective before you go out. And the other platforms like your Juno, who also kind of focus on kind of tailored education in a way that meets people. And I think the great thing is that people want to learn, but they want it to be in an engaging way and be able to provide those building blocks to kind of build on moving forward.
David, just extending on that, can you maybe think of a success story for Wealth8 where an individual or group was traditionally underserved and they were able to achieve their financial goals through your platform?
Great, yes. I got a perfect example. We were at the UK Black Business Show last year, great show, and we had a kind of stall there, and there was a lady that came across to kind of stall to speak to us, and what she mentioned was that she had this interest in the world of investing and had met someone a year ago that basically explained, if you give me your money, I will do the investing on your behalf in GameStop stocks. And she showed me her investment account that somebody else had access to. And she had taken for the first time all these savings out and put it into this platform. But the person was using the money to trade. And I think the interesting thing I came across was that for her, investing was the same. So trading, crypto, wealth management, it all meant the same to her. So we were able to kind of explain what we do. We work with the likes of JP Morgan, BlackRock, to what we like to call do it for me. Let the professionals who are paid a lot of money do the fund portfolio management, and able to show that based on your risk profile and your goals, you can invest your money in a platform and it's secure. You can see what's underneath, but most importantly, it's being done. You don't have to do the hard work. So it's able to kind of see individuals that, again, back to that education and knowledge, may go astray if they don't have the right kind of guidance. So that's one example.
Yeah, no, very good. Very interesting. And maybe just in terms of maybe what you see fintechs bridging the wealth gap, especially in traditional overlooked and underserved markets. Maybe Eric Collins, can you just elaborate a little bit on how you see that fintechs bridging the wealth gap, in underserved markets?
It's interesting to me that fintech, when I got into this business of being an investor, as opposed to going to investors, because I raised a great deal of capital from venture capitalists, but then becoming a venture capitalist and raising money from asset allocators was a whole different ballgame. And to get institutional investors behind our hypothesis and get them to sort of see things the same way was interesting. The thing that is necessary for all companies and all sort of people and all sorts of families is access to capital. And one of the things that causes the wealth gap to exist is the inability to access capital. Let me give you an example. In the UK, I won't even talk about developing countries, but in the UK, if you are Black in the UK, 1 in 2 Black children live below the poverty line. Only 30% of Black families own their own home. If you are a Black business person with the same type of turnover, the same history within your company, and the same performance, you are 4 times less likely to get a loan from a high street bank. All of these things are access to capital issues, because if you're poor, you don't have savings. If you don't own your home, you don't have equity that you can then borrow against. If you can't get a bank loan for your business, even though it's performing as well as any other business, you are in a position where you don't have access to capital. The point of participating in a disruptive relationship, which is venture capitalists, is in many ways at its very core seeking to disrupt the status quo by finding other solutions, we would think that would be the area where there would be a great deal of opportunity to sort of, change the dynamics and therefore move us forward. And we have found that to be the case in many different ways. Some of the things that David was talking about, in fact, when we talk about the Global South, we talk about melanated populations, there are a number of ways to talk about countries that are Black, brown, et cetera. The solutions that we're seeing are seeking to make, and the ones that are successful, and the ones that are becoming unicorns, and the ones that you hear about, Andela, PiggyVest, Flutterwave, all of these organizations are organizations that many of these organizations are seeking to make capital available, because the traditional system for doing that, if you think about everything from crypto, if you think about everything to InsurTech, all of those are saying that what we have found is there's an inefficiency. Marshmallow, which I mentioned earlier, is an organization that focuses on people who are transplants to the UK. So it's not talking about a domestic market, it's talking about expats who are coming to the UK, who are often Black and brown, and they have been able to find a market, which is an insurance market, as David was talking about, an insurance market that is underserved for auto insurance. People need their cars, they cannot, and if you're an expat coming to the UK, you're often paying 5 times in premiums what other people are paying just because his driving record is able to be found. Using artificial intelligence, the like, connecting the applicant to their driving record someplace else, we're able to then on these compare sites find very, very good insurance, and they have been able to work this niche. They've expanded now to young people below the age of 25 who also have high insurance premiums, but that is sort of what they're doing. There are all sorts of ways of then making that into something which actually bridges the gap that is a funding gap. And for me, it is so very important that capital access be made much more democratic. And that's what ImpactX does in order to try and make this more democratic. We try and decrease the importance of network and warm introductions. We try to make sure that we're looking at the merits of the organization as opposed to whom you know.
And Eric, do you think that has changed a little bit in the last 18 months? Going back to what Eric Mostanicki was saying about the sort of recalibration of valuations, Marshmallow raising a 30 million pre-money, pre-revenue, I think you mentioned. Do you think that's changed in the last 18 months?
So
and has it impacted has it impacted your sector more or less than other sectors?
So Marshmallow, actually, they were revenue generating. They had good revenue at the time. So they weren't pre-revenue, but they were, and they have been able to go from strength to strength. I would say that in a market where people are being conservative, fund managers, asset allocators are being conservative. And I think if you look at any of the press, everyone would say that it's harder for a GP, we're a general partner, to actually raise money from institutional investors. It is harder for individuals who are then raising from us. So individuals who are business owners who are trying to raise from us, that is harder to do across the board. So if you look at that and you look at the numbers that say over the last 10 years, less than 0.24% of venture capital went to Black entrepreneurs and less than 2% went to women-led teams in the UK, this is just a UK number. You can imagine that when people start to constrain their allocation of capital, one of the first places that they start to constrain are the places which they hadn't looked at traditionally. So do we find that it is a bit challenging, but it's always been challenging. It's like, it's never, over those last 13 years where money was just sloshing around the system, again, the numbers that I gave you cover a lot of that time. It's not as though these entrepreneurs were raising huge amounts of capital anyway. But what we did find, and what we are finding now, is that based on the track record of ImpactX, based on the performance of our portfolio, it means that there is a widening of people's aperture around sort of what should we look at and how is it that ImpactX has found these organizations. And we say to them, the reason we found these organizations, the reason we've been successful in our investing is because our networks look different than you. And our networks look different than your networks because our decision makers look a little bit different than yours also, because in venture capital, there are not very many decision makers who are Black who actually can allocate capital and make decisions. There might be some who are in private equity firms, but generally leading them and then being on investment committees and having allocations to be able to make, those are not the things. But those things are changing. And again, the performance of organizations like ImpactX and others is making that not only sort of easy to see and to have that track record to be sort of measured against other people's, but then it also puts a face to this opportunity and someone that people can call and ask questions to.
Yeah, no, very good. Thank you for your insight there. If we just look at the asset management and wealth sectors and how startups are impacting that particular area, particularly in terms of introducing new business models and emerging technologies, maybe I could ask Eric Mostenicki to give your views of new business models that fintechs are bringing to the wealth management sector.
We're very happy to start on that. In regards to the timeline, let's talk about the timeline. Let's take the last couple of years. What has transpired? If you think about more broadly asset management, the overarching trends were ESG and climate and focus on sustainability. The topic of access to alternatives, which I would classify as private equity, venture capital, and a bit of infrastructure and real estate. And thirdly, customizations, both on the customer side as well as on the product side. I think those were the kind of the holistic big trends that, McKinsey and Oliver Wyman were writing about in their research reports by talking to management. And I think that has been somewhat reflective also of the business models that startups have, gone after. One major topic around ESG was just enabling the data and the frameworks so that the investors can use them for portfolio construction, which, you've seen a plethora of consumer investment solutions in that space. And that is one area that has been evolving, that has been pushing also into the institutional space with a more robust capability. So a lot of, I would say, emergence of different tech solutions that are helping institutional clients manage that as well, whether that's framework standards or just data ingestion. And then on the second part that I would mention around the alternative assets, we have invested in a company called Moonfair, which is Berlin-based company that enables access to private venture capital growth equity funds. Now, it's not a true democratization to the true retail. You still have to be a qualified investor at this stage in time. It's going to change in the future. So you still have, sizable minimums, and it's not as accessible as we would like. However, regulation is coming out next year. It's called the European Long-Term Investment Fund Regulation that will enable allocation into, these type of asset classes with the right legal structures that can be then distributed also to the retail audience. Because the regulator's point of view right now is, I'm scared to give people access to these products because there's different capital flows, different liquidity requirements, different drawdowns, and hence it can create a lot of, I would say, misinformation. So we understand that this framework needs to change. It's changing, which is great. And then these companies that have started democratizing by using tech, by using access, by using their connectivity from the private equity space is actually quite an interesting area. Because if you think about what has transpired in the last 20 years, excluding the last 2 years, we had a low interest rate environment, and all the professional investors, primarily large pension funds or family offices, they had quite a significant allocation strategy towards alternative assets because the returns were quite attractive and the risk reward ratio was, in their favor. Now, you wouldn't see that in the portfolio of retail investors because how would you get access to KKR's latest flagship fund? You wouldn't unless you had a $10 million ticket. So there's quite an excitement that is happening here, and it's changing the investment portfolio construction side also, and hopefully moving into the retail side of things as well. So we're quite excited about a lot of the prospects that are changing the asset management space, and that has impact on wealth management as well. And it starts with technology, enabling, quick onboarding, good reporting, and having the structures to spread it out across a large audience. The one missing piece that I'm quite disappointed, frankly, about that didn't really transpire yet is, and I think David spoke about education, is the holistic advice delivered to the mass retail audience. Now, you have different customers with different problems. Some are unable to save because, they're not able to manage their cash flows and their outgoings. Some people have money, but they're not educated on how to invest. and everyone has a different kind of situation in their life. And there's effectively, if you have the money to pay for an advisor, they'll look at your bank accounts, your loan books, and they'll give a bit of an exercise on how to achieve what they're trying to achieve, and give them a bit of a financial health check. But this can be delivered in a digital way. However, the missing problem there is access to data on a mass market. Now, open banking is only one proportion of that is helping a lot. But other asset classes or other financial services products are not linked up. Now, in the UK, you have the pension effort around the pension dashboard consolidation. That has been going for quite some time as well. Also, it's not ready yet. So I'm hopeful that, our governments and regulators are going to be thinking more about these issues, because they're going to help the population by enabling standards and regulatory environments to make this a little bit easier. And hopefully on the back of that, we'll be finally able to see holistic advice delivered to the masses. That would be my wish, because that will have a massive impact.
And do you think it's not just education, but also enabling people to understand when they can invest? It's almost like, the investment for individuals can be once a year type of activity rather than a continuous thought process.
I mean, in theory, you shouldn't be investing just once a year. You should be saving and investing at the same time on a rolling basis, so you don't run into fluctuations, because investing is a long-term game. It's not a speculation where you just go on a short-term horizon and make some money. It should be part of your, let's call it the pension pot strategy of accumulating wealth. And in order to do that, depending again on the type of customer, you might have different situations in your life. Me, for example, invested quite early on and continued investing into a company called Moneybox in the UK, which is helping save and invest, as well as advise individuals on their financial lives. And majority of their customers were relatively affluent young professionals in London who just didn't have the saving enablement mechanism in the way they were living their lives. And this was a very engaged, I would say, business proposition, which had the customer and product in mind when designing everything. And it helped to flourish. And it's not just a London focus, of course. But, I think the answer to your question, Chris, really depends on which part of the market you're referring to. But there are some spring offshoots now that have some promises.
No, interesting. And You've mentioned Moonfair. Are there other examples of startups that you've invested in that are maybe redefining wealth asset management in a unique way?
Yes, I mean, out of the 18 companies that we currently have in portfolio, a lot of them are hitting, I would say, big thematic baskets or macro trends that we're trying to capture for. For our audience, a lot of our thinking goes also into the infrastructure space. So the more things that you don't really see when you interact with them. And if you think, for example, about the large incumbent players across financial services, number one problem, I would say, and I'm generalizing here, tends to be data and change, which is a boring topic, but quite important. And we've done quite an early investment into a brilliant team out of London. The company is called Finborn. They effectively build with newer technology a data platform that helps control, manage, and have the flexibility to ingest different types of data sets and communicate with other applications. I'm not going to go into detail because it's overbearing, but effectively, this, in comparison to other solutions in the market, haven't been able to do so. And it touches the macro trends for an asset manager that we care about. If you're a public equities investment house, it was hard for you to do structured products, or it was impossible to do product in venture capital. And a lot of these times, these business decisions are hindered by your tech and operational capabilities. And then you have these really boring infrastructure topics that can really make fundamental differences to an industry, where you have massive transformations of assets under management in which direction they're moving. And Finborn is one of these layers where we think a lot of the fundamental enablement will go so that the industry can grow in the right direction.
No, very interesting. Very good. Well, look, I'm conscious of time. We've got a few minutes left. What will be interesting is to ask each of you to respond to make any last comments, but also maybe give advice to a fintech approaching yourselves and your companies. What are the things that you look for and make a fintech appealing to you in order for you to invest in them? And maybe David Faseo, if you just in a minute or so, just give an overview of and last thoughts of what you've heard and advice to a fintech.
Right. So just very quick, I guess, and last thoughts, and I'll build on the question that Eric was answering. So in terms of emerging trends on the consumer front, there's a lot around AI at the moment. And I think if we pause in this world where everything has our data, like we have all our data to sell us what we need to, is how does that data and that information start to be used beyond budgeting and personal finance, but my goals as an individual and really using that to harvest what you should be doing when. You asked a question about when should you be saving, when should you be, but automating it, really being your personal serial ChatGPT, but for finances to reach those goals. I'm looking forward to seeing a little bit more of that. And then on the B2B side, in terms of emerging tech, it's again, removing barriers. So going offshore, emerging markets, Africa, for example, AML and KYC are still such huge barriers to like global transactions, and how this could be digitized. So again, you have someone who lives in Uganda or Nigeria as an example, can't just pick up an app and press some buttons and certain things to invest in certain markets. Again, a data issue. And it's kind of seeing technology that's really allowing that globalization, allowing money to go around properly is what excites me.
Very good. And final thoughts, Eric Collins, from yourself?
Yeah, so I actually want to pick up on points made by both Eric and David. The idea of, I think, where we should be looking for signal amongst the noise is really, I do believe in artificial intelligence. I do think that there is an opportunity there to have epoch-changing kinds of impacts, including in the fintech space. When I think about that, I'm very concerned, and so that where we're investing is in this concern that most of the data, so artificial intelligence is based, particularly generative AI and all the sorts of things you've seen recently are based on large language models. And those large language models are coming from public sources and private sources. Most of those private sources are coming from the United States. Let's be clear, most of them are coming from the United States in terms of that use of publicly available tools, everything from, any publicly available tool from Wikipedia to anything else. Just think about those. And then they're also coming mostly from populations that are other than Americans, white Brits, and sort of middle class, and some other portions of Europe. That sort of small nature of the amount of information that's actually being fed into AI engines in order to try and create what we're saying are big results and disruptive activity. I'm always concerned about that. So how do we actually expand those data sets is what we're looking at. So the fundamentals of that, and companies that are doing that and doing it well are ones that we believe are actually going to win. So we have been looking at a number of those. The other thing that we have actually been thinking about is because it's applied AI as opposed to straight AI plays. If you think about Mistral in France, just 2 weeks ago or 3 weeks ago, raised 105 million pounds for a 4-week-old company. 4 weeks old. The checks to play in that space where the fundamental and the sort of plumbing within the system are so high that it takes a vast amount of capital in order to be able to deploy against that. And that's a big bet that's being made with your LP's money. So one of the things that we've been looking at is applied AI as opposed to sort of fundamental and foundational AI. That's what I think investors should be thinking about a little bit more.
Yeah, no, interesting. And Eric Mosnicky, just final thoughts from yourself.
So if I go back to a question with Chris in regards to the comments to the founders, one of those things that investors tend to be exposed to is a lot of inbound, and sometimes that inbound isn't targeted enough. So I think the number one advice I can give is, whenever you reach out to anyone, try and understand who that individual is and their background. And if you just put in one hook that will make sure that the audience understands that you made a bit of research, I think there's a much higher chance that there's going to be a response on the back of it. So that is just one thing that I've been able to observe, that people who do very good reach out with a bit of thoughtfulness have a much higher likelihood of success, because that the other party on the receiving end will perhaps appreciate the research put into it. So that perhaps is just one comment for me.
Brilliant. Well, look, I think we've come to an end really, but just to summarize, thank you all the panelists for their input, from Eric Collins to remind us that AI has been around for 15 years, but actually applied AI is the future, and what's very interesting. And from Eric yourself is to approaching you with to make your approach of an individualization of your approach, which I think is really important. And to David as well, in terms of the growth opportunities in Africa and using education and AI to empower sort of the way wealth platforms work, I think are really interesting insights. Thank you all the panelists for your input today.
Yes, thank you.
And thank you, Chris, for your questions. Great session. Thank you.
Thanks, guys. Thanks, really.
Now we have Pointone Private Equity Fund. They are a dedicated European fund advisory and investment management company. So over to you, Ramon, to tell us a little bit more about that.
Hello, everyone. My name is Ramon Biserio. I'm the CEO of Pointone Global Investment Limited in United Kingdom and Ireland. We launched a private equity fund last year, an approved fund by Cyprus Security and Exchange Commission to invest in UK and Ireland. Now I'm going to tell you more about why we are investing in Ireland, as everyone knows more about the economy of UK. Now, Republic of Ireland has become the European hub for over 1,000 multinational companies all over the world. Companies in the pharmaceutical industry, in the information and communication technology, and in financial services have invested heavily in Ireland. And with all this investment in Ireland, it attracts a lot of foreign direct investment to the Republic of Ireland. And Ireland became the second country in the world after Singapore that have attracted the highest amount of foreign direct investment. Now, with all the companies in Ireland, multinational companies and indigenous multinational companies in Ireland as well, ranging from the global pharmaceutical companies and financial services. Now, there is an issue that has come up with all this as well. And at this point, I'd like to also mention that in 1987, Republic of Ireland created a financial service center that has also attracted more than 50 banks in the world. And in the financial service center, we have over 450 international financial service companies that operate in this international financial service center. Now, with all the multinationals in Ireland, a problem has been created because these multinational companies, the corporations, we have many small and medium-sized companies that provide services to the multinational companies. And these medium-sized companies require a lot of funding to be able to meet the demand of the corporations. This is where Pointone Private Equity Company comes in. In order to meet the demand of the corporation, the multinational company needs funding to continue to expand. And that is the solution that Pointone Private Equity Company have brought to Ireland, while we are equally investing in the United Kingdom. And to note, Why these multinational companies have invested in Ireland? One, basically because of the youth skilled labor in Ireland and the low corporation tax. Now, with the low corporation tax, this is also a benefit to the investors of Pointone private equity company, which eventually turns into more income for the fund and more returns to the investors. I'd like to give you a bit background of Pointone private equity company. Now, the fund, like I said, was approved by Cyprus Security and Exchange Commission to invest in Ireland and to invest in the United Kingdom. The manager of the fund, One World Plus Management Limited, is an alternative investment fund manager and a UCITS Manco in Cyprus. And Pointone Global Investment Limited being the fund advisory to the fund. The fund has been passported to United Kingdom and equally passported to Ireland. And that is why we're able to attract investors in this region and we're able to invest in this region. The fund invests in quoted companies. Basically, the target of the fund is to invest in growth companies and buyout. The investors of the fund are high net worth individuals, family offices, and institutional investors. And the fund has 3 share classes of 20,000, 50,000, and 80,000, class A, B, and C, with minimum investment period of 3 years, 4 years, and 5 years, respectively. The management of the fund, One World Plus Management Limited of Cyprus, the management is led by Paul Pavley, the managing director of the company. Paul, with over 30 years experience in banking and fund management in Australia and in Cyprus, someone that have managed a lot of private equity funds and other type of funds in Cyprus. And the advisory and investment management is done by Pointone Global Investment Limited, and I am the leader of the team at Pointone Global Investment Limited. My experience of 30 years has been with investment management company and many fund administration services company, which include HSBC, London Trust, State Street, Apex, BNY, and Cornerstone Investment Management, Regency Asset Management as well. Taking into the ongoing investment we are making in Ireland and in the United Kingdom, we analyze different industry, and presently we found out that a lot of opportunity in the nursing home industry. With consistent income in this industry, and with the fact that the level of debtor is hardly seen in the industry as income is being received on a weekly basis, and many of the residents of the nursing home, about 80%, 85%, are actually public clients. Their fee is being paid by the government. So this brings a consistent income to the nursing home industry. And there are a couple of nursing home industry that are put up for sale due to the fact that the owners are aged and retiring. So we have been acquiring some nursing home in Ireland and in the United Kingdom. I want you to join us in this investment to also continue to make income from the nursing home that we have been investing in. The low cost of operation and with high income in this industry, which invariably brings a lot of income to the investors. Thank you very much. I'd like you to join us to invest in Pointone Private Equity Fund. You can contact us through our phone number, through our email, and you can also get in touch with us in the deal room. Thank you very much.
So up next, we have the South African-based loan provider, Lndr. Lndr Business specializes in funding SMEs across various African countries. Their holistic approach will give you access to advice, insight, specialist knowledge, and experience. So over to yourselves to tell us a bit more.
Thank you for the opportunity to present you today with Business Lndr Credit, a company that was originally formed in 2011 but officially started trading in 2020. Our Business Lndr Credit is a new breed of fintech, following a global trend of innovative credit service organizations emerging from the fourth industrial revolution. At Lndr, we empower our clients to become integrated organizations in their own right, with the ability to enhance frictionless customer experience and new revenue streams. Currently, Lndr Business Credit is owned by two shareholders. One is Kikapay Investments, which own 51% of the company. The other portion is owned by Dave van Niekerk's home office, 49%. The product overview of Business Lndr. Product offering that Business Lndr specializes in is the funding of SMEs, concentrating primarily on purchase order loans from the public and private sectors of amounts up to 5 million and loan terms not exceeding 3 months. They also do business loans to retail services, manufacturing and construction industry companies of amounts up to 5 million rand and the terms not normally exceeding 5 years. We at Lndr are a fintech company that offers excellent credit vetting systems and innovative business assessment scorecards. We do digital applications and credit decision-making workflow processes. We have robust collection mechanisms and systems and external services to organizations in respect of credit vetting, management, and disbursement of funds. A short overview of the system that Business Lndr Credit offers can be done in the following manner. The product system can be customized to the funder's credit appetite, policies, and procedures. That includes front-end management, credit decision-making support, product management, collections, reporting, and tracking. We can also manage services on behalf of the funder with a full end-to-end management of the SME loan book, as well as a marketplace for credit-vetted customers to be matched to the funder's credit appetite. The system attributes can be discussed as follows. We provide loan origination, decision-making, and payments and collections. It uses a unique scorecard system to validate directors, businesses, PO issuers, clients, and suppliers. It has a real-time integration with various credit bureaus. Business rules can be set to determine which applications must get credit committee approvals. It provides capability for virtual credit committee meetings, tightly manages funds payout using payment requests per deal that can be sent to finance. It has a built-in electronic contract signature system, and all activities on the system is tracked and auditable. It can be rebranded to the corporate image of the client, and it allows for multiple organizations or divisions to use the same system. What are the competitive advantages of Business Lndr Credit? The competitive advantages are quick decision-making and payout times, personalized customer services that cater for all SME lending needs, end-to-end digital onboarding and contract management systems, flexible, and it can adjust to suit the customer's repayment and seasonal needs quickly. Offer several other competitive lending products, the ability to approve a much higher volume of deals compared to incumbent providers. And it provides short-term funding, whereas banks focuses on long-term asset finance. The company achievements for the past 3 years Business Lendr Credit have disbursed SME loans to the value of over 500 million rand. It has a collective collection rate of 94%, and a total number of transactions that they've funded to date is 415 transactions. They've created and maintained almost 8,000 jobs, and the spin-off effect of this has influenced almost 40,000 lives within the community in South Africa. We at Business Lendr Credit perform the front end and back end functions for various companies like Lndr, Ubank, various private equity funds, and Status Capital's Building Society in Eswatini. A financial overview of the current financials of Business Lendr. Here you can see the tremendous growth that Business Lendr Credit have experienced since its inception of July 2020, when we started with a 2 million rand revenue. Currently, we're sitting at over 66 million rand worth of revenue. We have experienced a growth in revenue of almost 200% and expecting a growth in revenue this year of 180%. The net profit before tax have increased to over 112% for this year, and the number of loans in 83% from the year 2022. The disbursement of loans is 88% up, and the number of loans that we're going to grant in the 2023 year is almost 400. The funding proposal that Business Lendr Credit is proposing today to the different investors is a funding amount of 120 million rand. The funding structure proposed is a term of 5 years with an interest rate of 15% payable per annum. The interest is paid on a monthly basis, and the full capital amount of 120 million rand will be repaid at the end of the 5-year term. The moratorium that Business Lendr Credit is presenting is a 3 months moratorium on interest payments. On the 3rd month, the full interest of the previous 3 months will be paid out. All funds will be ring-fenced within the books of Business Lendr Credit and will be secured. If we look at the projected income statement for Business Lendr Credit, we can see that the revenue will increase from 64,800,000 rand in year 2024 to over 90 million in the year 2028, with a net profit before tax ranging between 31% and 38% at the end of the year. The number of loans that will be distributed from January up till December 2024 will be 600 loans, and the total amount projected at the end of the 5-year period, almost 900. Thank you for your time and listening to our pitch today and allowing me to tell you a bit more about Business Lendr Credit. Should you be interested, please contact us through the Chris platform, and we are looking forward to discussing this amazing opportunity with yourselves. Thank you.
And presenting next is PriyoShop. PriyoShop is Bangladesh's promising B2B e-commerce marketplace. What they do is connect SMEs directly to suppliers in an attempt to fix the fragmented supply chain. So over to Asikul and Michael to tell you a little bit more.
Hello everyone, meet Rohim. Rohim lives in Dhaka, the largest city in Bangladesh. He runs a small retail shop in Green Road, which is the most populated area in Dhaka. Every day, Rohim caters 150 plus customers, but it's not easy to fulfill everyone's demand. Every day, he faces same problem, that is out of stock, and his customer move to his competing store. Restocking is not easy as it seems. When he needs inventory, he needs to shut down his store, and by losing working hour, he needs to go 30 to 50 different sources. But he don't get right price from wholesalers. He uses local transport, which actually costly and less flexible. In the meantime, Rohim's shop is closed for a day, and it's not a single day story. He needs to restock 6 times in a month because he has limited capital, limited shelf, so he would not hold inventory for long. In this inefficient process, he losing $1,000 sales per month. We are PriyoShop, a B2B marketplace for on-demand restocking. We provide a digital catalog to Rohim so he easily can access all the brand and distributor product in a single platform, can place order easily and get delivery within 24 hours. Now Rohim is super happy because he don't need to shut down his store anymore and earn 20% more than before. Before I enter my business model, I love to share the Asian economic tiger, Bangladesh, the land of possibilities with highest GDP growth 7.25%, with per capita income $2,824. You'll be surprised to know that Bangladesh is going to hit $1 trillion economy by 2040 with 170 million people, where 66% people are youth. 71% people already use 3G and 4G internet. But still, 97% retail transactions are contributed by 5 million small businesses. Market worth $191 billion. Our business model is very simple. We connect supplier and brand directly with micro merchant with the power of technology. It's in a proven business model. There are lots of global comparable in the world, but very few in Bangladesh. PriyoShop playing role in asset-light model. We don't hold inventory. We're trying to empower traditional players. On the other hand, our competitor playing role in asset-heavy model, which actually costly and less flexible. They act as a distributor. They fight with traditional players. Currently, we have 150 plus brand and supplier SKU in our platform. We already impacted 30,000 micro merchants' life. I'm proud to announce our last month GMV was $11.6 million. Here, our strong GMV growth, last 18 months, we've grown 12x. For solving this problem, we have a great team. Myself, Ashikul, I'm 3 times founder with 17 years experience in team play and strategic planning. My co-founder comes from telco background. She expert in brand marketing and customer happiness. She acts as an CMO. We also have diversified teammate with domain expertise. We already got validation from leading investors. Now we're looking for $5 million to support more micro merchants like transform their supply chain process, ensure financial inclusion. With this fund, we want to expand 47 new area by onboarding 120K new micro merchants and grow 13x from now. We also want to launch fintech solution by offering credit facilities in partnering with existing financial institute. So let's digitalize and empower millions MSMEs business jointly. Thank you so much.
Presenting next is Nebeus. They are a banking alternative for Web3. Their roadmap includes a full brokerage service, a DeFi side, and a credit line accessible on the Nebeus Visa card. So now is Michael Stroev to tell you a little bit more about that.
Hi guys, my name is Michael Stroev and I'm the COO and Head of Product at Nebeus. Nebeus is the banking alternative for the Web3 world. What that means is we are one of the only players in the market today who have successfully bridged traditional finance and cryptocurrencies in a single app. When a Nebeus user opens up an account, he gets a full-blown dedicated IBAN account, allowing him to use Nebeus just like he would any traditional bank account, but all of that being seamlessly connected to a full-blown cryptocurrency ecosystem, allowing him to buy, sell, exchange cryptocurrencies, hold his cryptocurrencies, or even use his cryptocurrencies to get loans, to earn, and even store his cryptocurrencies in insured cold storage vaults. This product is ideal for people who are new to cryptocurrencies, who want to buy cryptocurrencies and enter the Web3 space, but it's even better for people who are crypto native and crypto savvy, who want to use the product to move in and out of cryptocurrencies between crypto and fiat instantly, seamlessly in a single app. We're based in Spain, registered as the virtual asset service provider and a cryptocurrency custodian with the Bank of Spain, and we are an approved EMI outsourced service provider of modular finance, allowing us to offer our electronic money services. We have recently applied for the consumer credit license in the UK, and we plan on applying for the MiCA registration, MiCA framework, as soon as applications are open. In terms of traction, we have approximately 130,000 users today on the platform, spread out across Europe. In 2021, we did nearly 20 million euros of exchange volumes and issued approximately.
Presenting next is
Hi guys, my name is Michael Struif and I'm the COO and Head of Product at Nebeus. Nebeus is the banking alternative for the Web3 world. What that means is we are one of the only players in the market today who have successfully bridged traditional finance and cryptocurrencies in a single app. When a Nebeus user opens up an account, he gets a full-blown dedicated IBAN account, allowing him to use Nebeus just like he would any traditional bank account, but all of that being seamlessly connected to a full-blown cryptocurrency ecosystem, allowing him to buy, sell, exchange cryptocurrencies, hold his cryptocurrencies, or even use his cryptocurrencies to get loans, to earn, and even store his cryptocurrencies in insured cold storage vaults. This product is ideal for people who are new to cryptocurrencies, who want to buy cryptocurrencies and enter the Web3 space, but it's even better for people who are crypto native and crypto savvy, who want to use the product to move in and out of cryptocurrencies between crypto and fiat instantly, seamlessly in a single app. We're based in Spain, registered as the virtual asset service provider and a cryptocurrency custodian with the Bank of Spain, and we are an approved EMI outsourced service provider of modular finance, allowing us to offer our electronic money services. We have recently applied for the consumer credit license in the UK, and we plan on applying for the MiCA registration, MiCA framework, as soon as applications are open. In terms of traction, we have approximately 130,000 users today on the platform, spread out across Europe. In 2021, we did nearly 20 million euros of exchange volumes and issued approximately 7 million euros of loans. In 2022, we launched our banking product and we did 19 million euros of volumes in 4 months. We forecast stellar growth ahead with approximately 75 million euros of banking volume in 2023 and a total volume of approximately 125 million. And we are already over and above our targets. We're currently fundraising for our Series A round. We want to raise a total of 10 million euros. We're currently doing an equity crowdfunding campaign on Seedrs that's live right now. We have already raised more than 1.2 million euros. The Series A round, we plan and hope to close it in Q3 2023, for which we need your help and support. So thank you very much for listening, and see you soon.
Welcome back. Hope you enjoyed that small lunch break. Now I have the pleasure of inviting Justin Sycamore, who will be moderating the Blockchain Web 3.0 panel, Chain Reactions, How Blockchain is Shaping the Web 3.0 World. So over to Justin and our esteemed panelists.
Great, Hugo. Thank you very much. And hello and welcome to everyone tuning in for the Venture and Capital Europe Conference 2023. It's my great pleasure to welcome you to our high-tech panel discussion entitled, as Hugo mentioned, Chain Reactions, How Blockchain is Shaping the Web3 World. My name is Justin Sycamore. I'm the founder of Arcfina, a next-generation hedge fund platform for funds that specialize in credit strategies. We've built the platform on a mutable ledger, ready for the future world of capital markets that operate using tokenized securities and distributed or shared ledger. Today, the topic is truly groundbreaking and transformative. We stand at the threshold of a new digital age, Web3, where blockchain or other distributed ledger technology is poised to revolutionize our interactions and transactions on the web, shaking the very foundations of how we conceive internet, security, trust, and privacy. Imagine a world where not just information, but value, money, assets, goods, services, identity can be transferred anywhere in the world to anyone without the need for intermediaries or third-party validators. This is not a distant utopian vision of the future, but a tangible reality being built on blockchain and Web3 today. So for today's panel, we've gathered two of the brightest minds in the space to explore the future of Web3 and how blockchain technology is forging this new path. Our panel consists of industry leaders who are intimately involved in shaping this exciting frontier. So first we have Joe David, founder and managing director at Nebeus, a visionary disrupting traditional accounting with crypto-focused digital solutions. Joe has pioneered a new way forward with Nebeus, leveraging the most effective cloud-based technologies for seamless financial processes. He's also leading the fight to understand crypto on a cellular level, underscoring his belief in limitless human potential. And also we have Calvin Shen, the managing director of Hex Trust, a company at the forefront of digital asset custodianship. His work is vital in shaping the security and development of blockchain applications, providing a reliable gateway for traditional and digital finance to coexist. So throughout this panel, we'll delve into various questions, both general and personal, that explore the impacts, challenges, and possibilities of blockchain within Web 3.0. We aim to create an enriching dialogue to illuminate how this technology is changing the web and the opportunities it presents for all stakeholders. So without further ado, let's get into the discussion. As I mentioned in the introduction, we've got the opportunity today to really see Web3 from a couple of different perspectives, both from a digital custodian and also from a Web3 accounting platform. So I'd like to ask both Joe and Kelvin how their businesses are shaped and what they do, and how they really use blockchain or decentralized ledger that makes it different from the sort of traditional versions of their businesses. So Calvin, if I could perhaps start with you, could you tell us, for the benefit of the audience tuning in, what is a digital custodian? What services does it provide? And how does it differ from its counterpart in traditional financial markets?
Sure, absolutely. Well, first, thank you, Justin and Venture Capital for the time today, and certainly appreciate being on the panel. So just, as a very quick introduction on Hex Trust, who we are and what we do, and I'll certainly get into this question that Justin had asked, is that we are a digital asset custodian founded back in 2018. We're now with offices across the globe in Hong Kong, Vietnam, Singapore, Dubai, Italy, and the Bahamas, and certainly with more offices on the way. Now, we all know this digital asset is a very exciting asset class, right? That's certainly been highlighted by things like Bitcoin. But this Web3 digital asset is so much more than just Bitcoin or cryptocurrencies, and now that involves to non-fungible tokens, security tokens, central bank digital cash, and so forth and so forth. What is the common denominator here? Is that in the Web3 space, kind of the ownership is really built on blockchain technology, and this really requires a wallet to interact with value transfer or any of the kind of aforementioned digital assets. So to have an institutional grade custodial solution in this space didn't exist didn't really kind of broadly exist 5-6 years ago, right? I mean, there's definitely a couple of vendors that started in the space, a little bit before us, but there's no really real widespread institutional grade custodians, a la the State Street with B1 Mellon, who obviously been around for over 200 years. We've been around for 5, and we're actually one of the pioneers in this space. So that kind of gives you a sense of the nascent and emerging assets here. So I think the long answer here is that to build a digital asset infrastructure, starting with custody, it largely didn't exist, many years back. And so we have to build the entire tech stack from scratch. And that's really from a technology perspective, and we have to figure out kind of from a compliance perspective. And I think, if we have time to talk about a little bit later, is from a regulatory compliance perspective, right? Many years ago, there's not a lot of rules and regulations around digital assets as a class. Now we have a little bit clarity at certain parts of the world. So that's, really custody. And the reality is we basically enable institutional clients to come to this Web3 space, knowing that their investments in any digital representation value will be safely kept in a regulated counterparty.
Sounds good. Thank you, Kevin. I mean, yeah, so that's really clear there. I mean, the obviously the digital custodian is really the backbone almost of the whole of Web3, providing that sort of mechanism for the ecosystem to operate in a sort of secure and trusted way. And I noted the points you obviously made about regulatory compliance, Dan. I would love to come back to that a little bit later on in the discussion as well. I think that's key across various jurisdictions, how that works. So, Joe, perhaps I could just turn to you now to provide a bit of an introduction. So I understand, you obviously your business started on the traditional side, your accounting platform, and from what I understand, you saw an opportunity with a client or two and transitioned into a Web3 based sort of blockchain business model. So it'd be great for the listeners on this panel to really understand, how you spotted that opportunity and what really drove you to make that change and what the benefits are. Perhaps you could give a bit of background on that.
Yeah, for sure. And thank you, Justin, for the introduction and the opportunity to talk today. So for us, just for clarity from our side, we're not a platform, we're a service provider. So we provide accounting services and other professional services, but the main is accounting services to clients. And a vast majority of those are now Web3, crypto, blockchain based clients. So we, as you mentioned, we were a traditional based firm, as most have been for a long time. And the opportunity we got was more by luck than judgment, if I'm honest. We worked with a lot of tech firms, startups, founders, things like that. And we just happened to get introduced to another firm who were looking for somebody to support them, and they were in the crypto space. So we didn't actively at that point go out looking for crypto clients. I didn't really know a great deal about it. This was about 4.5-5 years ago. But we're the type of business where we like to say yes to opportunities, and we like to be able to learn new ways of doing things and things like that. So once we got that opportunity, we decided that it was a space that not only did we not know a great deal about, but actually nobody in our industry knew anything about at all, really. And the worst part about it was nobody knew anything and nobody was willing to learn. So as we're an ambitious business, as we spoke just before we came on, I've recently moved to Dubai to expand the business globally. Our ambitions at the time led us to go, well, this is a huge market opportunity for us to help support a growing, clearly kind of respectable industry that will get somewhere at some point. So that was kind of where it started, was like I say, that kind of luck in inverted commas of being introduced to a client and then actually really kind of going deep into the ecosystem. And that meant, learning, so reading, watching things, speaking to other businesses, other contacts we had, but also investing ourselves. So, taking the opportunity to try out different investment opportunities, to try out some of the DeFi stuff during 2020, and really kind of understand how they work, trying out NFTs, so really kind of, embracing the technology ourselves. And then we also decided that very early on that we would accept crypto as payment. And again, kind of eat our own dog food, as we would say in the UK as a phrase. You know, if we're saying this, then we would, you know, then we would do it ourselves. So we accepted crypto, which again allowed us to understand the mechanisms that were being used and the rails that were being used in order to transact all this stuff. So it gave us a real specialism, and yeah, now we work with a huge amount of crypto projects, some very high market cap type projects, and also some smaller up and coming ones. So yeah, it was, like I say, more by luck than judgment, but one that we've definitely grabbed with two hands as the opportunity came.
Very good. Well, it will be great to understand in a bit. Obviously you're taking on sort of crypto-based or digital clients alongside traditional clients, and it'd be interesting to understand how that kind of filters across between those two client sets, right? And how some of maybe the traditional clients are getting benefits, or maybe you're taking different approaches with them to maybe transition them as well, or to give them sort of different mechanisms of providing the service that you need to them. So what I'd like to do now is to start to go into some of the threads, that the topics that we've got lined up for today. And the first one is really quite a general one. So it's about really how sort of blockchain technology is fundamentally changing the way that we interact with the web, with Web3, and how does that sort of present opportunities for startups and investors? So Calvin, maybe I could come back to you to lead on that one.
Yeah, sure, absolutely. And I think, needless to say, right, I think this is one of the most kind of exciting new emerging technology in the space. And obviously the Web3 term is very broad. It covers a lot of different things. So from my perspective, I'll just kind of focus a little bit more on blockchain-based assets to be a little bit more precise. Coming from traditional financial services myself on the buy side, so certainly no stranger to stocks and bonds and asset allocations, from mutual funds to ETFs and so forth. So that's why when I first dabbled into really Bitcoin was kind of my first digital asset, probably like most people, and kind of really understand from a near instantaneous settlement perspective to kind of the immutability of the blockchain, really makes me kind of wonder, what this could be the future of digital finance. Now, that's not just to say Bitcoin is is a catalyst, but the blockchain element, right? The technology that underpins these type of digital assets could be truly transformative. So a few kind of very kind of often cited examples, right? Is if you look at cross-border remittance right now, especially where I'm based in Singapore, where Southeast Asia, where there's still quite a bit of people that's unbanked, and workers, they have to provide remittance back home. I mean, you have service providers that charge, on average 7%, right? So you send $100 and $7 goes to fee, and that might take multiple days. Well, look, using blockchain technology and perhaps maybe using one of the tokens, this potentially could be near instant. So you get it essentially almost right away in the wallet that you hold. And the transaction cost is a tiny fraction of that, right? Again, I'm generalizing some of the technology here. So from that perspective, it's a real world use case. It's very, very obvious, right? That, kind of disintermediate the intermediary, thereby cutting down cost, right? So that is one obviously very practical examples. And another one would be that, obviously I know there's quite a bit of investors here. Now, you can look at now Bitcoin or some asset, investable digital assets as a potential asset class. Right, so looking at correlations and obviously as there's more and more track record in the space, looking at correlation, looking at diversification, looking at some of the real world assets that could be tokenized, some could be hedged against inflation and so forth. I mean, I truly believe that this asset class will be a fundamental part of a normal asset allocation for prudent investment management. There's so much more about. I'll definitely stop here for now.
That sounds good. Yeah, I mean, so key points you're obviously mentioning there: the cost and time to settle of transactions, but actually then on top of that this is obviously it's an asset class in its own right, and that can be used for its own investment purposes, and as you alluded to, even hedging against in combination with other other investment strategies as well. So that makes a lot of sense. You mentioned inflation as well, which is obviously very topical at the moment. Joe, perhaps we could come across to you along a similar vein. You have different types of clients. You've probably got a range there of some of them who are far more traditional and some who are fully sort of digital in terms of their operations. What are the sort of differences that you're seeing in terms of your client base from the way in which they're interacting with the web and the opportunities that it presents for them?
Yeah, absolutely. And just to also kind of finish on the last question around the opportunities it presents. The other huge thing we're seeing is the opportunity for many different people that from different backgrounds that may not have had the opportunity in previous walks of life to create businesses, to build global businesses, and crypto and blockchain is a hugely global but also close-knit community, and I've never seen an industry so supportive of each other. So I think that's really important as well for the opportunities that people get now to create businesses and grow businesses from ideas. So yeah, I guess from our side, we see a total range. We see some people that are very small. They come up with a great idea, but apart from that, they don't have a great deal else of substance behind them, and they may go well, they may not. And then we see some of the real kind of top end projects where they've already got a proven business model, and actually they're kind of very traditional in the way they operate, because they're so large now that actually the mechanism of blockchain might be the product that they have, but actually the business behind it is quite traditional and corporate in its makeup. So it is a total range. I think from my side, the business, like I said, the business opportunities are now endless, and blockchain technology is allowing industries to be more transparent, to be faster, to be cheaper, as Calvin said. And I think we're going to start to see an even bigger institutional drive over the next kind of 12, 18 months around institutions. We can already see at the moment, there are large institutions with Bitcoin on their balance sheet, for example, and just last week or the week before, BlackRock, talking about an ETF. People like that don't get involved in an industry that's a scam or a fad or a Ponzi scheme or whatever the other words that are thrown about. So the biggest thing that I see, the biggest problem that I see, is that you have, whilst it's a real positive that you have a lot of individuals or businesses that can grow out of kind of nothing and really create something great, is the downside to that is they have very little business or kind of skill sets around business, finance, running a company, custody of their assets, for example, treasury management, all these things that in the TradFi world it would be normal. So all our kind of traditional clients, if you like, have all those things set up for them because there's support around there for all those different things. In crypto, they don't have that. There aren't people, or there are less people that are supporting them from a kind of business management perspective. So that's where we come in now, is to say, we've done all of this on the traditional side. Now we can do all of this on the crypto side, and we can really help those businesses perform. We can hopefully minimize the possibility of failure, which without a professional advisor around them might be much higher, which in our eyes will hopefully then reduce the amount of, what they call in the crypto industry, rug pulls, where people, lose money on a project, which half the time isn't a rug pull. It's just that the founders run a really terrible business model, and, the business went to the ground through that, not through them being necessarily fraudulent. So we're, that's our goal. In terms of integrating the two sides of the business, for us, like I say, integrating traditional business models and putting those into financial controls and things like that and putting those into crypto is essential. But also the other way, we are now starting to talk to our traditional clients about things like, can they accept crypto? Does that open them up to a wider market? Are the transaction fees less? Are they able to send money around the world much quicker? Can they pay suppliers quicker? All these different bits and pieces that we're now trying to embed that into our traditional clients. So we've gone one way, taken the traditional world and tried to help the crypto world, and now we're trying to use some of the stuff we've learned from the kind of crypto blockchain world and put that into the traditional world as well. So yeah, it's great, I think, to be able to try and marry the two together, because eventually they're gonna come much closer together. But it also can be challenging, as you can imagine.
Yeah, well, that's really interesting. That obviously sort of builds on what Calvin was saying. And I think the piece that you talked about there was transparency, right? The whole ecosystem provides greater transparency, which can provide obviously greater comfort for investors and also just general business processes and that type of thing. So that's really interesting. What I'd like to do now is just to talk a little bit about. We're just going to go into the challenges first, I think, of the technology and the ecosystem and those. Before then, we'll come back out and then we'll look at a sort of higher level around sort of regulation and those sorts of things. But in terms of technical sort of challenges. Calvin, but I'll come back to you maybe in terms of sort of just implementing blockchain technology generally into mainstream applications. What are the sort of challenges that you're seeing and or your clients are seeing, and how are they being addressed?
Yeah, absolutely. So I mean, I'll start with from an infrastructure perspective, right? So I alluded to a little bit earlier that all the infrastructure in this space really didn't exist. Right, so all of us in this world leading, a lot. That's why a lot of startups were created, is to really solve many problems, right, in this brand new asset class or this, technology, right? So a lot of different startups address, building different verticals and different things. Custom infrastructure is one of the things that we built. So basically, again, from the beginning there was nothing, and we support different, the challenge. One of the main challenges of the custodian is to support different blockchains. So the first one, most custodian will probably support is Bitcoin, right? That's kind of the biggest one and the most well-known one. Great. Now, 5-6 years, many years later, if you just look on CoinMarketCap, right? So it's one of the kind of rank listing of various tokens and cryptos. I think the latest one, there's about 26,000 tokens. It's a lot. Now, tokens, they could build on different token standards, but that means they could also build on different blockchains, right? So Bitcoin chain, Ethereum is different from the Aptos, it's different from the Ripple, it's different, and so on and so on. So as a custodian, if I want to support many blockchains, there's actually quite a bit of technology integration work involved, right? It does not just magically show up, say, oh, boom, I support this token. It doesn't work that way. And as a custodian, since we do have the relevant license, and in regulatory jurisdictions, we are a fiduciary. So, and because we're stewards, a fiduciary on behalf of our clients' assets, we cannot screw things up, right? Like literally, we have no margin of error as a custodian. So you can see that if we factor in the technology complexity, the potential operational complexity, cyber securities, physical securities, and to the compliance component, regulatory component, you can see why this is not an easy business to really build. However, why we continue to build and solve this problem is that we really view that custody is one of the gateways for traditional finance, for the Web2 world to come into the Web3 world. Right. The idea is that, okay, if I want to come into this space using blockchain-based digital assets, again, the fundamental difference is that it requires a wallet, right? A wallet requires, generally speaking, you need a private key access in order to access this wallet. And this private key is basically this long string of alphanumeric that, it's something that, traditional finance is not necessarily used to. And basically, as a custodian, is that we offer very safe ways to make sure that this alphanumeric string of numbers and text is safe, right? So you can see this is a very technical kind of process, something that traditional investors may not be used to. So we basically coming up using experience and techniques that we've learned from the Web2 space or traditional finance space to make it more user friendly, such that institutional clients will be more comfortable with coming into space, knowing that their investment's safe, right? So I think one of the biggest talking points as of late is the potential spot ETF followed by BlackRock, which was then obviously followed by Fidelity, and so on and so on and so on, right? Spot ETF application is nothing new. Actually, I think Gemini's been kind of trying to get applied for it for 10 years. But when you have literally the largest asset manager in the world in BlackRock filing, that catches people's attention, because guess what? Now it suggests that the infrastructure is in place, that this tech stack is mature enough for a potential $1 trillion asset manager to come into the space, which is very exciting for us.
Yeah, that makes a lot of sense, and that news obviously is something that's beginning to really impact the rate of acceleration, I think. A question on that, and to put you on the spot maybe a little bit, you mentioned the sort of 2,600 tokens sort of thing at the moment. What's the sort of variety of blockchain that they're on? How many different sort of blockchain infrastructures do you need to support for those if you were to have clients that traded in all 2,600?
Yeah, actually it's 26,000, so you're actually right. It is
26,000, sorry, yeah, I thought so.
That's correct.
Wow. Yeah.
So now, if you look at it, super majority token. Again, anyone can create a token, by the way, right? So it's not like, you need to kind of, go to like in the traditional world, you go to NASDAQ and kind of list your token like via an IPO, right? Actually, anyone can mint tokens. But of this 26,000, right? Super majority of them are probably going to zero, if not already, right? Some of them, it doesn't necessarily need to have a use case. It could be large cap like Bitcoin, that counts as one. It could be Ethereum, Ether, that counts as another one. Super majority of them probably do not have utility for various reasons, right? So I would say this is one of the biggest key takeaway is, yes, while I did mention that this asset class is becoming legitimized, via institutional kind of participation like BlackRock, but it is still a very nascent industry. So always do your own research before pulling money in on projects that you may or may not be aware of.
Okay, makes sense. I guess where I was going there with that is, the number of underlying sort of technologies that need to be supported. And the question was really, do you see those converging? Over time, is this going to become simpler over time? Is this problem going to naturally sort of move towards a simpler infrastructure, or do you see it can just this is the nature of the beast?
Sure. I would say there's probably towards convergence over the medium to long term. And to answer your earlier question on challenges is that, there are too many blockchains out there right now, right? Because there's, throughout the ICO boom or there's a new blockchain comes out, it seems like every other day, right? And that kind of goes back to my earlier point about infrastructure really supporting these new blockchains that may or may not have utility. It is very difficult. And it's also very difficult for the builders and startups because they also have the same question is, okay, should I build on Ethereum? Should I build on Ripple? Should I build on X, Y, and Z? Oh, okay, maybe we'll make it interoperable. It gets confusing. It's a lot of resources, a lot of sunk costs. That's why I think throughout time, the ecosystem will grow, to a point of network effect that there should just be a handful of them. So, there will be a little bit more concentration on the ones that are, more usable by the ecosystem.
Okay, makes sense. Good. Well, we're getting through our time pretty quickly, so I would like to discuss one topic that that was mentioned briefly earlier. And Joe, maybe I could turn to you on this. And this is coming really towards regulation now and the input that has, and also a little bit about different jurisdictions. You mentioned at the beginning, you just moved to Dubai from the UK. Obviously, you I'm sure have clients operating across different jurisdictions. Could you talk a little bit about the impact of jurisdiction and where your clients are based on this, and that will lead us into a conversation about regulation, I think.
Yeah, absolutely. And I think one of the biggest challenges, we just talked about how many blockchains there are. The other challenge we've also got is how many jurisdictions there are that say they're the most crypto friendly or blockchain friendly, and choosing one is a similar arduous process as to choosing the blockchain to launch your project on and whatnot, because they all have their pros and cons. So, for us, one of the things we've tried to do is be as close to the kind of which jurisdictions are actually the ones that when they say they can do it, they can actually do it. So yeah, I guess if we round them up slightly, in terms of actual regulation, Singapore I think is probably the one with the longest standing regulatory framework, and they kind of went through really positive, we're the best because we've got really cool regulation. And then after a while that they must have maybe got a bit of an influx, and then all of a sudden they started saying, well, yeah, we can do this, but we can't do that, etc. So they were, and this is kind of the thing that happens with regulation, is a country comes out and says, we can regulate you, we can do this, that, and the other. And then they get inundated, and then all of a sudden they go, well, hang on a second, we're not sure about this, and we're not sure about that. So, Singapore were one of the first, like, major ones anyway, that were, that were offering kind of full kind of regulation, if you like. Dubai came out earlier this year with VARA, which is their regulatory framework, or UAE probably, should I say, for crypto. And then we had the EU come out with MiCA, a few months ago, and as of this week, I believe the UK have passed a law which has been on the cards for a while. It came out as this big news, oh my god, the UK have passed this law, but the law's actually been part of their Financial Services and Markets Bill, which I won't bore people with the details, but that was actually kind of put to Parliament quite a while ago, maybe even the back end of last year. But it was yesterday or the day before that it received royal assent, and therefore became live, if you like, live law in the UK. So all of these jurisdictions are now starting to, if you like, bring in their own version of how you regulate this free moving, beast, if you like. And I'm not sure I could say that any of them have got it spot on just yet. And I think that's the big problem. Even now, I mentioned that there's lots of places you can go and, that will have this or have that. Even now, I've just mentioned 4 jurisdictions in UK, Europe, Singapore, and the UAE. But all of them have got a different take on how they should look. All of them have got a different view on how to regulate certain parts of it. So again, even if you go, do you know what, I'm going to go to one of those regulated jurisdictions, even when you get there, you've still got an element of clarity that you need on how they actually, see the kind of treatment of the assets and things like that. And obviously, the one thing I haven't mentioned yet is the US.
I was going to ask you. Yeah,
I've left them for a reason. And I think, if I'm totally honest, at the moment, I don't think it's clear what they're trying to achieve. It doesn't seem obvious, what approach they're taking in terms of, regulation by enforcement. But actually, I don't even know if they know what they're enforcing. So that's a market that people say to us, we would have looked at it, but it's somewhere we're not going to go anywhere near because we just have no clarity whatsoever. So yeah, look, most of our clients try and set themselves up in a more friendly place, and they tend to be British Virgin Islands, Gibraltar, places like this where they do have an element of regulation, but they're much more flexible in their policies. But I think as we get a much more mature and kind of institutional based, business around blockchain, we're going to need to have the powerhouses of the world, coming up with some clarity. And I must say that this is a good starting point. Having jurisdictions like the UK and the EU with some, a decent starting point on regulation, we shouldn't complain about that. But we do also have to be realistic that just because a country has now come up with a regime that can discuss the regulation for a particular project, it doesn't mean you're going to get the exact answers you want when you go there. So yeah, they'd be my main points on that.
Very good. Well, that's certainly interesting. Your perspective there on the US regulations, obviously, one of the biggest markets, sort of GDP perspective. So let me pass that across to you, Calvin, as well. You're based in Singapore. Did you have a sort of an angle on that, or some thoughts on jurisdiction and regulation as well?
Yeah, absolutely. I would say jurisdiction and regulation, obviously, it's something that us as a custodian looks at very, very deeply and carefully. Right, because again, we operate in a jurisdiction where it basically have some type of framework that essentially offers enhanced customer protection, right? So something that we care deeply about. So there's a strategic reason why we base in the likes of Hong Kong, Singapore, Dubai, and we have an Italy office that in anticipation for MiCA, for the EU-wide regulation. So I think that. Remember, this asset class is so new that all these regulations basically were written from scratch. This is using many years where we've already been engaging with the local regulators and really kind of teach them what are the fundamental, like what is blockchain? I mean, I still remember we started started back in, 5 years ago, this discussion was around blockchain 101. Okay. And then kind of a similar question, I said, okay, what is the private key? So I would say pretty rudimentary type of topics. Needless to say, fast forward 5 years later, man, the regulators, they are very up to speed. They know exactly what's going on, generally speaking. So in Singapore, to Joe's point, right, there's been a Payment Services Act that covers what they call digital payment tokens, or crypto for generalization. That's been around since 2019, that the draft first came out. So one of the earlier ones. And so, this really led to a mass influx of, crypto related projects that would either set up a regional headquarter or headquarter in Singapore, right? And it's a very vibrant crypto community in a smaller, city state where the community engages one another. I think it's one of the best places to be if you have an interest in Web3. Hong Kong is a very peculiar one, it's a very interesting one, right? Because remember back in, don't forget that, the likes of FTX was actually started in Hong Kong. BitMEX was, in Hong Kong. So there was a time where some of the titans and, of crypto, the OGs, the whales, or whatever you want to call them, we were all congregating in Hong Kong because it was so friendly. Various things happened, including, potential geopolitical risk, and needless to say, during the pandemic, Hong Kong was, was perhaps not the best area for various reasons. And so kind of people kind of moved away from Hong Kong. And then guess what? Just about 6 months ago, the attitude towards crypto or digital asset completely changed. The SFC now, starting effective June 1st, so literally a month ago, now even allows retail trading of cryptocurrencies. And there's actually a licensing regime to be offered to crypto exchanges. So, you can see this kind of a complete reversal of attitude and embracing new technology. And needless to say, there's now, again, an influx of potential talent and different companies to move back to Hong Kong. Okay. Yeah. So, I think, but I'll just finally touch up on the US as well. Obviously, I think, the lawsuit against Coinbase and Binance for various reasons, right? It's always kind of provide this kind of regulatory ambiguity and the whole kind of regulation by enforcement, right? That we observe from the US SEC. What that means is that it pushes people, potential, company like the Coinbase of the world. They want to do the right thing. They tailor to institutional audience. Like they want to do everything by the book, audited financial, the right certification, the right license, and so forth. But this type of ambiguity is very hard to do business. So what happens is kind of forces these companies elsewhere, outside the US. And from what I'm seeing so far, I think Asia, kind of what I just mentioned about Hong Kong, Singapore, seems to be one of the biggest beneficiaries. Dubai under VAR regime also seems to be a quite influx of kind of a new entrants. And again, with MiCA, with more clarity coming out in EU and in London, right? These to me could be the beneficiary for the regulatory ambiguity that being observed in the States right now.
Okay, that is really interesting. So thank you, both of you. I'm going to ask you in a second for a one-line sort of summary of what you think the most significant impact of Web3 will be in the sort of next 4 or 5 years or so. But to summarize, I think it's been a great discussion. We've only touched on some of these subjects. It would be great to have more time to go into some of them in more detail, which we don't. But I think, clearly coming out of the discussions we were talking about, what are the benefits of Web3 to the sort of end user experience on the web? We were talking about obviously lower cost of transaction, lower time to settle. Joe was talking about transparency. Calvin was talking about it being an asset class in its own right, with the ability to use that to hedge against other investments. And the last part of the discussion was really around the jurisdiction and the regulation. We didn't get to talk too much about comparing different regulations, but that's obviously a key factor, I think, in the whole of the sort of Web3 ecosystem. So, Joe, if I could come to you to quickly summarize where you think we're going in the next few years with Web3.
Yeah, I think for me the key is going to be institutional adoption and more mass adoption. Personally, I'm not for CBDCs in the main. I know we didn't talk about those, but central bank digital currencies, because I think they take away a lot of the actual fundamentals of blockchain. However, I do think that they will support mass adoption of kind of digital money and being able to send money around the world via wallets rather than, you know, via bank accounts and restrictions that come with those. So yeah, so for me, I think institutional adoption is huge and will be huge the more that we can get. But that comes back to what I said earlier around building good businesses that are investable, that are successful, profitable, you know, all those different bits and pieces. If we don't have those, then, you know, investors aren't going to get into it, institutions aren't going to get into it, and we're going to lose out. So yeah, they would be my takeaways.
Thank you, Joe. And Calvin, for you, just 20 seconds.
Yeah, absolutely. I think the future, I mean, this is medium to long term, is definitely going to be disintermediation to decentralized finance, ownership of your own data, you know, and yes, absolutely, this will be helped by institutional adoption, which with a more mature infrastructure, it seems like the wave is coming.
Excellent. Great. Joe, David, Calvin, Shen, thank you both very much for your time today. I hope everyone on listening into the panel has found it a productive conversation. I certainly have. Lots more to talk about at another time. Thank you very much.
Thanks, Justin.
Thank you so much.
So coming up, we have Unibeez Limited. Unibeez is the UK's leading skills-based talent platform for emerging talent. It connects students and graduates with a diverse range of flexible, real-world jobs, enabling the unseen to be seen. After you.
Hi, my name is Chris Keenan. I'm the CEO and co-founder of Unibeez. So what do? We use AI to give businesses the power to discover and connect with hard-to-reach, high-quality, diverse talent instantly. There's a growing labour and skills deficit, not just here in the UK, but globally. A digital skills shortage is costing the UK economy 12.8 billion every year. There are also 3 million UK students with digital skills, but they're invisible to these businesses. So what does that mean? It means for the students, they've got no access to flexible skilled roles, and they're not being used to further their future career. For businesses, 72% of which are suffering from digital skills shortage, it means that they're struggling to grow and to progress in an illiquid market. For service providers, they're unable to identify and target students in professional job market at scale. So we're the solution. Okay, we're an AI-driven digital marketplace, and we bring together businesses on one side and students on the other. What it means is that for small businesses, they can get access to skills now, immediately. For the larger businesses, enterprise and corporates, they can get access to a diverse liquid talent pool, and they can build a consistent talent pipeline. We also help businesses to hit their ESG targets with access to these diverse candidates. For the student, the value proposition is very straightforward. It gives them visibility in the market where they were unseen previously, allows them to earn money. They get to build their employability status, and it also allows them to work flexibly around their studies. So what's the market opportunity? Well, you know, in the UK at the moment, the size of the unrealized GDP due to the skills shortages in the UK is £68 billion. The value of student digital skills is estimated at £10.2 billion, and we believe that our reach could take 10% of that marketplace. In terms of competition, everyone will be familiar with LinkedIn, and as you will know, that really predominantly is about people's experience and also the connections they have, which our cohort generally do not have. So we offer a very different solution here based on meritocracy to do with the skill sets of the individuals. For other companies like Tempo and Fiverr, they equally look for experience, and generally speaking, you have to have been in a professional market for a number of years before landing jobs through them. Now, Handshake is prolific in the US. It has tried to break into the UK market, but has not managed to do so at this stage. So in terms of our traction, and this is really through organic growth, we've got 30,000 student signups on the platform. There's been 20,000 hours worked and over 100,000 job searches by 45,000 applicants. Students on Unibeez are diverse. There's no doubt about that. We've got 70% candidacy base are female and 42% are from a Black and minority ethnic group. We know that students have a viral coefficient. So when they're talking to each other, they really can, word of mouth can spread very quickly. And in one instance, we had somebody go onto TikTok with a single TikTok and generated 13,000 new signups in 48 hours. In terms of the companies on the platform, we've got a wide range from small one-man bands all the way up to FTSE 100 businesses. The small businesses are looking for digital skills today. They need people to help them in their companies immediately. And for the larger businesses like Savills, Just Giving, Essential and Penguin Random House, they're looking to pipeline talent and reach a more diverse, hard to reach applicant. We have a 3-year partnership with Santander, which we're very proud of. You know, as Mark Homan says here, the reason for this relationship is that we're both helping businesses to find skilled talent they need to succeed in today's competitive labor market. And their research tells them that 70% of their businesses are struggling to find emerging talent. As part of that relationship, they put us in front of their 250,000 businesses. We're also integrated into their Santander Navigator platform, which is an international platform for businesses wishing to expand globally. And Santander universities give us access to 1.2 million students. So it really is a very important partnership for us. And as part of that, they're rolling out a national campaign in order to tell the world about the relationship we have between each other, but also what Unibeez offers to businesses. In terms of our revenue model, it's split up. So transaction fees we charge on hourly rates that are booked through our platform and where we run the payroll. We've just launched our subscription fees, and those are based determined rather, should I say, on the size of the business. So it runs from one-man band up to enterprise level. And then, of course, brand partnerships will become more prolific as the size of our market network increases. In terms of go-to-market, obviously, we're now launching our new SaaS model effectively with a subscription base. We've got ambassadors, feet on the ground in universities. And we really have our eye out in terms of international growth. I'm sure you'll see that a platform like this can work extremely well in many other territories. In terms of our team, James Parson, my co-founder, has a recruitment background. He is sold out from one health recruitment business that he set up, and he currently runs the major group, which specializes in the creative industries, but also in tech. Susanna Devereaux has great experience in marketplaces. She was prolific with Zoopla and Florence. And she's also worked with BP. Sophie Lang, my colleague, has also had great SaaS experience in recruitment through Bombardier and Sourcebreaker. Claire Sutcliffe, MBE, was previously at Multiverse under Ewan Blair, and she was VP of their communities there, and she's now helping us in terms of how we mold and build our community going forward. Eric Wilkinson has a background in VC and private equity. Tamara Sword is a marketing and PR expert and is on the board of Deep Tech Labs. In terms of this investment opportunity, we're raising £1 million. It's an EIS qualifying round for UK residents. Funds raised to date in previous rounds just under £2 million, and we have £450,000 pledged in this round so far. Anyway, thank you for listening to me, and I hope to be talking to some of you soon.
Now presenting next, we have Graphogame. The world has millions of children whose learning stops in their tracks due to difficulties in reading. Graphogame is the only evidence-based literacy app and is used by over 5 million people. So I'll hand over to Vesa Parada to tell you more.
Hi, my name is Jesper. I'm the co-founder and chief operating officer of Graphogame, an early literacy app company from Finland. Illiteracy should not be a problem in the 21st century. Yet over 1 billion people in the world today are functionally illiterate. And over 700 million people suffer from some sort of dyslexia or neurodifference that makes all learning very challenging. And this is not an issue that plagues individuals or families. This is a systemic issue that nations must fix. And UNESCO estimates that countries around the world lose 1.1 trillion euros every year due to poor literacy and lost tax revenue, lost GDP, and lost opportunities for their citizens. And this is not an issue of the developing world. Actually, half of this $1 trillion number is the United States of America. And that's why Graphogame was created to fix this problem. Our apps are created for 4 to 9-year-olds. They are gamified early literacy apps that kids can play alone without adult supervision, and through academic research, we have proven their effectiveness. This can be seen in over 300 academic publications where Graphogame is used as a method, and 20 PhD or master's thesis papers where Graphogame is the core methodology. And from this, we have created 14 language versions in partnership with universities around the world. And these apps are helping kids as we speak. Graphogame is an infinitely scalable solution to illiteracy in 2 major ways. Our app has been made to be extremely cheap to distribute, and we can have 1 million users or 100,000 users, and the cost will be largely the same. Our app does not make internet connections, it's not resource heavy, and is very cheap to maintain. And this incentivizes us to get scale and get as many kids using our app as possible. And on top of that, the research proves to people around the world that they do not need an adult or a teacher in the room for the kid to get evidence-based, effective content. And this effectively allows kids to learn literacy without an adult supervising them. And this is the main solution for fighting the lack of teachers that we have around the world today. We have partnerships with universities around the world, and we have 14 different language versions of our apps that have been made and researched with these partners. Even though they have been made with those partners, we have full intellectual property rights to all the content that the researchers have made for us. And the countries here you see in dark blue are countries where we have national distribution deals, which we have 18 of. These are deals that have been made with a government or NGO or some sort of institution whereby we deliver our literacy apps as part of a wider national push for literacy. In the last few years, we've been focusing fully on user growth and growing our user base to hundreds of thousands of active users, not only to prove that there's a good product market fit, but also to prepare a bed for future conversions and upselling. And our user acquisition has been a very interesting model. Many companies go for digital marketing or marketing of some sort. We realized that to stand out from the crowd of literacy apps and edtech apps, etc., we wanted to work with national level NGOs or governments or ministries of education or the African Union to help access a market, to open a market, and to have that local famous partner do ads, to do radio ads, do interviews, etc. And this has allowed us to grow our downloads to 5 million downloads through our extremely innovative approach to market entry. A great example of us succeeding at a market entry with a national level partner was Brazil, where we worked with the President's Office of Brazil as well as the Ministry of Education to co-create a Brazilian Portuguese version of Graphogame, but also to distribute it as a free to download app across all of Brazil. Even though it was free to download for Brazilian children and parents, we at Graphogame were paid a yearly fee by the Brazilian government to keep it free as a service. And on top of that, the Brazilian government invested hundreds of thousands of dollars into TV ad campaigns, radio ads. All their politicians in the government were talking about Graphogame as talking points on TV, and that allowed us to achieve 2 million downloads in just a year or so, and have an average rating of 4.5 out of 5, which is extremely high when you have thousands of reviews. The reason why we have been building such a huge user base is that we are preparing to monetize this user base with a subscription-based SaaS product. This SaaS product is a browser-based analytics service that teachers and parents and schools can use to basically use Graphogame usage data to get predictions on which children need extra support, which students might have dyslexia, which students are getting bored of the content because they're talented, etc. So we are going to be selling this platform to our many markets for about 12 euros per user per year, and our first commercial pilot will be the city of Oslo in Norway, where will be used by thousands of kids and about 100 teachers initially. And by using this business to institution model of entering markets, we can keep our customer acquisition costs extremely low and use that huge user base to convert users to our more scalable services and products such as this platform. And all of this that I've talked about has been done with a small team of just 2 founders, myself included, and about 4 freelancers, which we use for development and customer support when needed. And with just this small team and this extremely efficient distribution model, we have managed to reach 5 million kids and parents and families around the world and have 5 million downloads, 500,000 monthly active users, and we are market leaders in 4 countries, including France, Brazil, Norway, and Finland. And this year is the year that we have started monetizing our user base, and in just the first quarter alone of this year, we have 4x revenue compared to the entire year of 2022. So now is a fantastic time to join us in this journey. And we expect to have multiple sources of income in the years to come. On top of this teacher platform, which we will be selling as a B2B subscription, we will also continue selling to governments, which is a smaller revenue stream. We will also add a mathematics game to our portfolio, which we will sell to our users. We will have B2C subscriptions, premium subscriptions, and of course normal paid downloads. So we have multiple sources of income from our apps and value-added services to basically upsell to our existing clients. And we're currently in the middle of a 3 million euro funding round, of which we have commitments for 1.4 million. And we're looking for qualified angel investors, family offices, and VCs to execute on our extremely aggressive high growth expansion strategy that we have for the years to come. So please join us on this amazing journey to make the world a more literate place. Thank you very much.
Unless you know with certainty the identity of who is accessing your assets or who is buying that item online, your business is likely exposed. Through its unique patented technology, ValidSoft, the upcoming company presenting, will tell us how they solve that problem.
We're living in a hacker's economy. Daily data breaches, network infiltrations, identity theft, and ransomware attacks show no signs of stopping. And this is costing businesses and consumers alike. Current security defenses are inadequate, and even the most advanced identity verification platforms are vulnerable. For example, the Lapsus cyber extortion attacks. ValidSoft's new voice authentication technology, CISA Trusted Identity, is poised to revolutionize the security of digital services by using the power of voice biometric authentication to guarantee the user's identity when accessing sensitive online data or conducting online transactions. Furthermore, it irrevocably and securely binds your unique voice print to cryptographically generated digits, which are spoken in real time and enclosed in a theft-proof user process, thus fully guaranteeing the user's identity and the transaction integrity. By speaking the cryptographically generated digits, which are biometrically verified, an irrevocable record is created which can be used for a multitude of use cases. This makes it virtually impossible for users to refute the transaction later, which helps prevent so-called friendly fraud in e-commerce and payment applications. It helps cut down on fraud attempts like code theft, SIM swaps, and social engineering hacks. In other words, it gives users an easier yet far more secure online experience. The underlying AI technologies used also protect against synthetic speech, deepfakes, and replay attacks, so users will always have the peace of mind that they are the only ones who can securely access their account. Now, let's see an example of how CSAE could work with financial P2P payment apps, such as Zelle. Maybe you owe money to a friend for concert tickets. Simply open your P2P app, choose their name, the amount, and authenticate yourself by holding down the button, speaking the 9-digit number. That's it, you're done. Your voice is unique, and the numbers spoken in your voice are exclusive only to you and your transaction. And this combination of your voice and numbers spoken guarantee your identity and the integrity of the payment transaction. Power your world with CSAE Trusted Identity from ValidSoft. Make voice authentication the universal means of proving identity.
Did you know that there were 625 million Indians under the age of 25, of which less than 10% of them can speak English? English Quest, our next company presenting, is a UK B2B SaaS company building the software and content that schools and tutors will use to teach this $5 billion market. So I'll hand over to CEO Jamie Martin to tell you some more.
There's 1 billion people worldwide who want to learn English, but there is a chronic shortage of good English teachers to teach them. We are English Quest, a UK company that is solving this problem by building content and software that allows anyone, anywhere, to teach international quality English for $5 per student per year. I'm Jamie Martin, the CEO of English Quest, and I've got 15 years of experience in the education industry, as a special advisor to the UK Minister for Education, as a member of Boston Consulting Group's global education practice, and as a successfully exited founder of South African edtech startup Ingenie. Now, we believe there are 3 reasons that you should invest in English Quest. We've got paid validation and fast growth traction, got a bold vision and a product roadmap in a $5 billion market that's growing over 10% per year. And we've got a strong founding team, industry experts with a track record of getting things done in education. I'll start by taking you through our traction. Starting with selling to affordable private schools in India, we have grown 9x in 6 months to serve 180 schools. Typical school buys annual software licenses from us worth about $2,500, giving us $500,000 of annualized revenue. I will now hand you to my colleague Charlotte, who will tell you in more detail about the problem we're solving and our unique solution.
Hi, I'm Charlotte McCormick and I'm the Chief Learning Officer at English Quest. I've over 15 years experience in education, including as an English teacher and as a deputy principal and founder of a school in London. The world faces a chronic shortage of English teachers and it's getting worse. Schools can't find teachers who have both the English language skills and the pedagogical training to teach English well. The few qualified teachers there are move to richer areas of major metros, while middle-class schools in tier 2 and tier 3 towns lose revenue and even go out of business because they can't meet parents' aspirations around English. Live online lessons are too expensive, and AI app-only learning is unpopular with parents and ineffective with school-age students. But we are changing that. Our teacher app allows local teachers to deliver international quality lessons, and our student app allows students to practice their spoken English at home. Schools use their existing teachers Parents get the live lessons that they're willing to pay for, and all of which is accessible to students for just $5 per student per year. I'll now hand you over to our CTO, Ravi, who will describe our product roadmap.
Hello, I'm Ravi. I'm the CTO of English Quest. I have more than 20 years of experience building technology products at scale for companies like Arcfina and Nebeus. I've also had my own startup, building a social e-commerce platform for rural, low and middle income class of India. Our vision is to build a product that lets anyone, anywhere, teach international standard English. Stage 1 is visiting and learning from schools in urban India as they use our student and teacher apps. Stage 2 is where we move the support completely online to serve schools anywhere in Asia. Stage 3 is where we automate the support so anyone, anywhere can subscribe to the app and start teaching our lessons. Stage 4 is our chatbot lessons powered by our own speech-to-text engine. Schools or families will not even need an English-speaking teacher to deliver our international quality lessons. Now, I'll hand over to Sandeep, who will take us through the product's differentiation and market size.
Hello, I'm Sandeep, COO and co-founder of English Quest. I have 15 years of experience in education as a teacher in low-income school with Teach for India, and then building products and running school and teacher operations in India for Lido, Bridge International Academies, GEMS, and Grey Matters. Only English Quest app allows local teachers that schools have to deliver the affordable, in-person, international quality lessons that parents want, using technology that everyone can access. We have three main types of competitors. First, app-only providers like Byju's and Duolingo. They are unpopular with schools because parents won't pay for them, and self-learning does not work for young, low, and middle-income students. Secondly, elite school curriculum providers like Lead and Exceed. They are expensive and require too much technology for local schools to use them. Third, international curriculum like Cambridge or British Council. They require too much skill and planning for teachers and do not cater to beginner English level of most students. We are solving a huge problem in a $5 billion market. Our initial primary focus is this Indian serviceable market of 500 million with 300,000 schools, colleges, and 100 million students. Just 10% share of this market is a 50 million revenue business. The first step in that is that by July 2025, we will be at 1,500 schools, giving us $4 million of revenue per year. Next, we see a further $500 million market in schools and colleges across South and Southeast Asia, where markets like Indonesia, Bangladesh, Vietnam, and Pakistan have the same challenges teaching English and offer the same opportunities for us as India. Now, I will hand you back to Jamie, who will talk about our business model and our rate.
We have an annual software license business model. A typical school buys around 450 licenses at a cost of around $5 per license for $2,500 of revenue per school. We have year-on-year retention of 73%. These combine to give a 5-year customer lifetime value profit of $2,800 against an acquisition cost of $544. That's a healthy lifetime value to acquisition cost ratio of over 5. We are raising $1 million to reach by July 2025 to $4 million of annualized revenue. We'll be in 8 states across India and into crucial markets in South and Southeast Asia. We will be at break even and we'll be ready to raise a Series A at a valuation of $20 million, 4x the valuation that investors will get in this round, and setting the stage for us to take our product global over the next 5 years. To remind you, there are 3 reasons to invest in English Quest: our paid validation and fast traction, the bold vision and product roadmap we have in a $5 billion market that's growing at 10% per year, and the strong founding team, industry experts with a track record of getting things done in education. Thank you for watching our presentation and for your interest in English Quest. We'd be delighted to answer any questions that you have.
Presenting now is David Baker from VideoXRM. They are a B2B media discovery platform connecting companies to the world.
Hi, this is David Baker. I'm the CEO of VideoXRM. I thought it would make sense to show you about the VideoXRM platform today, as opposed to just going through a pitch deck. So VideoXRM is a media discovery, distribution, communication, and monetization platform. You could sort of think of us like YouTube for companies. We're enabling companies to have significant visibility and distribution. So this is our homepage where we show videos of various businesses, different types, different industries, different subjects, etc. Just clicking on a video here, this is our player page. What's interesting to note here is that we show the industries in which the video is about. So you can see I've expanded the video audio subjects here as an example. And we also show the video subjects. And for many videos, we will also show the video audio participants, companies mentioned, geography of the video, etc. All that is possible because of our indexing. We also enable companies to do one-click share, do embedments, and we enable viewers and subscribers to actually contact the company, fill out a form, and start communication. Maybe they're interested as a potential customer, partner, investor, etc. And that's what this communication capability enables. You can also message a company as well. If you're a company and you're looking to message another company, you can do that on platform as well through our message center here. Additionally, we have a video audio database and arguably the most precise media discovery platform in existence today. So this is our video audio database. And you can search for companies by industry sector, subsector, etc. Really any product service group, video audio characteristics. And then as you can see here, there's a variety of different sections. Each section has its own filters. The filters enable you to find exactly the video you want that meets your specific quantitative or qualitative criteria. And I'll just show you what an industry might look like drilling through it to show you the granularity. As I do that, you'll see the videos become more and more narrowed according to the criteria you're looking for. It goes on and on. So also, in addition to being on our production homepage, our video audio database, we also have the ability for you to have analytics, have a dashboard, and I'll show you that right now as well. The dashboard is here. It's going to show you what your profile completion percentage is, trending content, your document center, content analytics, your account activity and alerts, and other information that's quite helpful and useful to you to really manage your content library on our platform. This is what a content library looks like. You can see it's got the videos, other information that's important. And then, of course, we have video audio details where we gather up to 25 different metadata video audio details, and we populate it in the database, all in the interest of media discovery. I think it's important to note from a business standpoint, how do we make money? So we make money from promotional services. Promotional services are things like VideoXRM TV here, where companies pay to stream. Featured companies, where my cursor is moving here. In the video audio database, we're soon to launch sponsored results, which will be below the filters and above the organic search results here. And then additionally, we have what we call profile boosting. So here's a profile of a company on platform and their video and audio. We boost the profile all over the site. So that's one of the business model sets of 4 different revenue streams, how we make money. We also make money from B2B premium content. We're about to launch that, and companies can sell their premium content on a pay-per-view, pay-per-download, pay-per-subscription, or pay-per-collection basis. Now, jumping back to the video audio database and how we're really unique from other companies, what we do is we have the most granular indexing that we're aware of in existence. That indexing allows your media to be found. So we index 150,000 different industry categories. We index 65 or 70 filter criteria, 1,250 dropdowns, 25 different pieces of video audio metadata. And again, it's all in the interest of precise media discovery. How do people use the platform? It's pretty simple. They just go to sign up, takes 30 seconds, and then they can drag and drop or choose a file from their computer to upload their video audio library. Jumping back to our communication center, which I showed you a minute or two ago, this is how companies can easily find other companies on platform. They just click message and they can immediately start communications. So what we're trying to do is create a network effect for companies. So there's company-to-company communication so that investors can find investments, suitors can find targets, manufacturers and distributors can find each other, et cetera, et cetera. And the use cases of the platform are many. For example, it could be a recruiter looking to find a CEO in medical device robotics. It could be an investor looking to find a private company in Texas that manufactures stealth helicopters that trades on a secondary market exchange. There's a whole host of different, arguably infinite different use cases that one can use our platform for value for you. Okay, now that I've showed you the platform, I'll talk a little bit more about the company. We started 3 years ago. We have 25 people. We're solving a major problem that exists out there, which is media discovery. We believe that we can get companies more views and more subscribers because we're a company-specific platform than other video platforms out there. We have 1 patent issued, another one about to be issued, and then 3 more pending after that. Our team consists of people with tremendous software development experience. Myself, I was a Wall Street professional and have been involved in several startups, including an exit acquired by FactSet Data Systems in 2013. The purpose of the capital we're raising, which is $5 million, is AI and machine learning specifically. We're working on automated video classification. We're not sure if anyone else is working on that in the world, and we believe we have quite a head start on that. Also, general software development as well. And then 40% of the use of proceeds is for sales and marketing to expand the platform domestically and globally. If you want to learn more about the company, please head over to the Crisp Deal Room and check out VideoXRM. You can find our materials, including our slide deck there, and happy to communicate with all of you. Thank you very much for your prospective interest in VideoXRM.
Good afternoon, everyone. It's my privilege to welcome you all back for this afternoon session of V&C Global. I'm honored to present the SaaS panel. We are live streamed on both YouTube and our conference software Crisp. Today, we're honored to have a distinguished group of panelists who have generously given their time to shed light on the SaaS effect, transforming industries and workflows. Our first panelist is Sage Nye, investor at Venture Guides with a track record of building successful businesses and an impressive history of growing unicorns. Sage brings a unique team-based approach to venture capital. She hails from a fund known for its strategically confined portfolio and its hands-on involvement in helping portfolio companies scale. Next, we have Asher Siddiqui, general partner at Sukna Ventures. Asher is a seasoned tech investor with a career spanning over 25 years in 3 separate phases. The first being an entrepreneur specifically in SaaS, then in corporate M&A and a VC since 2006. With experience as an entrepreneur, a corporate M&A leader and a VC, Asher's insights span the entire life cycle of a startup. He now focuses on backing digital transformation businesses in the MENA region through Sukna Ventures. Lastly, we are joined by Geronimo van Schendel, CEO of Buildia, an architect with a deep specialization in construction and the digital environment. Geronimo is at the helm of a company that's disrupting procurement and B2B sales for the construction and real estate development sectors. His work straddles the intersection of design, AEC, and technology, making him uniquely positioned to discuss how SaaS has transformed these traditionally hardware-intensive industries. So to begin, I'll ask maybe Sage to introduce yourself by proxy of this question. What key trends, in your opinion, are driving the growth and evolution of the SaaS market?
Thank you. I think the fascinating thing about SaaS is when you are doing it on a subscription model, it provides the companies that are using them the opportunity to sort of benefit from your product without having to manage it themselves in their own environment and things like that. So obviously we can talk about cloud, we can talk about all of that, but I think at the foundation of it, it's actually the desire for innovation and the need for fast-paced innovation, shift left, all of that. That's actually driven a lot of this desire to sort of outsource the things that we don't have to focus on. I think you'll probably hear both of my colleagues and many other investors speak all the time about, do what you do best and spend all your time on that and outsource everything else. And so when I think about drivers for this market, there's a lot. There's cloud, there's cost, there's all that. But I think the fundamental one is really the shift left and the wanting to focus on innovating our own product and providing the best service that we can in what we want to focus on, as opposed to managing everything else.
Fantastic. Maybe Asher, if you have some insights into that.
Yeah, I agree with everything that Sage said. I was mentioning this to you, Hugo, earlier. 25 years ago, when I first started as a software engineer, I kind of realized the same thing that Sage was talking about, which is, the customers need to focus on what they're working on, and they all, a lot of customers saw the benefit of using software, but the problem is they didn't have the capabilities to manage that software. And so what I did in those days is I came up with a pay-as-you-use model, but the reality is it was a subscription-based model. And so what's interesting for me is that 25 years later, it's actually still relevant business model. If anything, it's growing because more and more people, especially over the last couple of years, have started to recognize that they need to use tech in pretty much all facets of their all functions, but they can't spend their time sort of hold back and held ransom by their IT departments. So it's a great way to scale and accelerate and focus on what you do best. So, can't say it better than what Sage said.
Great. And maybe Geronimo, from the other point of view, maybe as a current founder, how are you seeing the evolution of the SaaS market?
Yeah, thank you. Well, I believe that first of all, it's being on an industry that is quite heavy in terms of operations and quite technical. And I think there are a lot of industries that are very relevant in that position. It's pretty important that not only the connectivity and the general infrastructure of internet has been evolving and facilitating much more vertical tools, make it way more easy to implement, to get kickstarted, to structure the data and so on for operations that are quite complex, like is the case of construction. So I think we're seeing already for a few years, but I think there's a lot of potential in the next years to come, a tendency to see very specialized SaaS applications that are the real ones that really go into adding a lot of value in specific industries that are huge and that are very incumbent industries in many ways, like logistics, like construction, like energy, and many others, right? So I think it's a great moment for SaaS, and particularly for SaaS that is in verticalized. Yeah.
Great. Geronimo, I just want to say that you were frozen for like 2 minutes, but you're all good now.
Oh, sorry. Can you hear me correctly?
Yeah, but you're frozen again. Like your video freezes in and out. Just thought I'd let you know. So I guess while Geronimo's fixing that.
Okay, I'll switch my connection in a moment. Sorry about that. I'll switch my connection.
No problem. So I guess Sage, coming to you. How has the adoption of SaaS solutions, in your opinion, transformed industries and business operations? And what have you seen at your time at Venture Guides?
Yeah, it's a great question. And it's one that I really love thinking about. I think, we talk as investors and as founders and companies and all of that about being customer centric and providing the best customer experience. And I think, building on exactly what Asher said a minute ago, when you don't have to be held hostage by IT or by anything else, you can leverage the greatest technologies and really build the best, customer experience. I think the adoption of the cloud and the opportunity it's provided there to infinitely scale, essentially, means that your customers don't have to get the loading symbol anymore.
That's true.
Or you can protect them at levels we've never been able to, or all of that, and it's opened up all of this capacity and bandwidth and opportunity to provide a really nuanced experience. If I were to think the challenges of that is that now there's a lot of competition to provide the best experience, and you want to really leverage these new products and the newest innovation and technology to be the fastest, the most performant, the best, the most pleasing, best UI, all of that. But the innovation in the market is huge, and we're getting faster and faster and faster. I still think about when I was trying to get onto websites, years ago, it feels like, but I would try to get on, and if it wasn't loading, I just sort of knew, like, okay, I'll turn off my computer and come back later. And we don't have a tolerance for that anymore.
No.
Amazing how much that has changed.
I was watching, and this might not be the best representation, but I was watching the playlist on Spotify's up and coming rise on Netflix, and it was exactly that, right? Daniel Ek was annoyed when it was not 0.2 loading time, but actually 0.4, and he threw a fit. So yeah, it's definitely like that. When you click something, you want it to load, or you actually just close it. So no, definitely.
You think about these amazing services like eBay and all of that obviously we've evolved from as well, but eBay used to crash. And like that's an auction site, and it used to crash, and we all accepted that as normal. And then you think about all the innovations that we've had since then in application resourcing management, in the cloud, in APM, in cybersecurity, and all of that. I mean, if Amazon crashed these days, or at the very few times that it does, I'm pissed.
Yeah. And it's worldwide news.
And it's crazy to see how much innovation is, but it's also really fun.
Yeah. So sometimes I think when Facebook has gone down, the Facebook service has gone down, and the Meta service has gone down, you're just like, what do I do with my life? So I've seen some people post that on Twitter, but no, that's definitely true, that it's advancing very quickly. But staying on the same question, maybe for you, Geronimo, because your SaaS solution is transforming the construction, procurement, and B2B sales industry. So maybe if you can give us a bit of insight into Buildia and what you guys do.
Yeah, thanks for that. I hope that the interference in the Wi-Fi now is not going to turn tricky. Basically, what we do, we are an ecosystem, a SaaS-enabled marketplace or SaaS-enabled B2B e-commerce ecosystem that adds a layer that automates processes, helps companies to structure in real time their databases that are quite specific to construction, and adding security and efficiency in their collaboration both with subcontractors and large ecosystems of B2B clients. So we basically have a model that has two layers: one SaaS that connects to the operations of general contractors, developers, and on the other side, manufacturers, resellers, and as a third segment to subcontractors. And then they can operate through that SaaS with any other company in the market, be it on or not on Buildia, but channeling all the operations, channeling all the data, and putting it to work in real time, or on what we call the Buildia network, which is our B2B collaboration platform, where they can enable, they can leverage as well those the power of their software and start transacting between companies that are within the same ecosystem, which is highly specialized. That's what we do.
Fantastic. It feels like you've said that a million times. It just came rolled off your tongue.
A bit, yeah.
And then Asher, I think from a MENA perspective, are you seeing maybe industries that are being revolutionized by SaaS that might be perhaps overlooked in Europe or the US, or is it really following similar trends?
So thank you for the question. And so, just to weave this back to what Sage was saying and what Geronimo were saying. So what's interesting is that, if you go back 5 years, so I've been an enterprise software investor for 25 years, right? And maybe a SaaS investor for maybe a dozen. But what's interesting is, when I thought about SaaS or enterprise software, I thought about the US and maybe a little bit about Europe and other pockets. What's interesting is, during the pandemic, there were all these CEOs, C-suite people that had massive budgets and P&Ls, and they were all skeptic. And I'm talking globally. All of these people were skeptical about, digital transformation. They were skeptical about using digital tools because they were worried about what would happen to their business if they were to open up. And then what happened is during the pandemic is that every single one of these people, whether they were in the Middle East, whether they were in Argentina or Chile or Spain, everyone had to somehow figure out how they could move their business forward, continue to operate. And I think what's cool there is that, the digital transformation is not just a MENA thing. It is, I'm excited that it's happening in the MENA region, but it's a global thing. And I would say one of the reasons why it's been so easy to it was such a fast adoption was because of business models such as SaaS, where there was very limited amount of time, even with enterprise software with, say, large language models or whatever. Even those could, within 4 to 6 weeks of training, based on your training data, you could actually go from soup to to live in like, say, 4 to 6 weeks, as opposed to go and talk to your CTO and or CIO, and then 3 years later they're building something that is irrelevant for you in the market. So I guess what I'm trying to say is that digital transformation, is a global phenomenon, and it's actually being driven by this. I don't want to overplay it, but I do think that the SaaS business model is driving a significant driver of that growth and adoption.
Okay.
I don't know if I answered your question there, but
Yeah, no, I think the question was if there's an overlooked kind of segment of SaaS in Europe that is actually being looked at more heavily in the MENA region. So that was the question.
So I guess the short answer is every single sector is now having to look at, and there are some sectors, like, for example, construction, that were really difficult to sort of implement, especially on-site solutions. But the reality is, pretty much most people will carry one of these, and so I actually think that across sectors you'll find sort of technology solutions being used. So I don't really see overlooked sectors. I think I see a lot of growth sectors. That's actually what I'm excited about. It's not that there's anything overlooked. It's just like, it just depends on what flavor are you looking for. What flavor do you know, and what flavor do you want to go for? Because the opportunity is massive. Like, you can financial services is kind of like an obvious one, and it's we're in the process there. But when you look at every single sector across the board, from construction, real estate, and into like security, across any sector that you can think of, gaming.
Yeah,
they're all opening up. So it really is. I guess what I'm trying to say is that the bottleneck for the MENA region is not the opportunity set. It's the lack of lack of number of VCs that have special. So I'm specialized in a specific area. I'm actually pretty excited about helping more VCs come to the region, because we actually need more investors, more sector focused investors who have specific, unique insights into specific sectors, which, for example, I have no idea about.
Yeah, that sounds good. I mean, that makes complete sense. I read a report the other day where AI investors who have been in the AI space for a very long time do not want to co-invest with general investors who have no clue about AI and just jumping on the AI hype train because they don't have a CTO or someone experienced enough in the AI space. Just because they say a generative AI, they jump on board. So yeah, when you talk about specialist investors, I think that's where they can provide value, right, to the teams. I think that's extremely important. And I think that comes to my next question for you, Sage. Venture Guides has a unique team-based approach. Can you elaborate on how this contributes to your portfolio success?
Yeah. Well, so you mentioned this at the beginning, but the two things that we really do is we confine our portfolio. We do 15 core investments in a fund, and we have 6 partners. So the idea there is to really keep the number of portfolio companies to partner ratio small. And then another benefit of that is that we can keep the full team informed. When there's only 15 companies that you have to know about in a fund, then you can stay on top of all 15 at a high level, right? Like I'm not the point person for every single one of the 15, but I know what's going on in every single one. And the reason that we do that is because if you look at the background of every single person at our firm, we've had experiences in all different areas of company building. I actually think this builds off what Asher was saying earlier and what you were saying, Hugo, nicely. We've had some people be CFOs, CEOs, COOs, publicly traded companies, writing the Delaware Incorporation papers, all of the range of sizes and everything. And as the founding team, you want someone, when you're asking for help, you want someone that's hopefully been in somewhat of a similar position answering the question. And so we believe that if we keep the full team informed on what's going on within every single company, then we can pull in the right person based on the problem set. The idea is no one person's going to have the perfect answer every single time. And actually, no one will ever have a perfect answer. This is a building and learning, right? But let's bring the most informed person who's had at least similar experiences and knows the company for the question.
Great.
So yeah, building a strong foundation with the right people to answer the right questions.
Fantastic. Thank you. And I guess, Geronimo, maybe flipping that on its head, right? So Sage has come in from the investor's point of view, but as a founder in today's landscape, especially in what you're doing, right? What would you be looking for from an investor to come on board, apart from money?
Yeah, of course. Well, smart money is obvious, but I think that sometimes when you see startups that are in whatever industry, they tend to think that the only smart money is industry-focused investors. In their case, I don't know if you're in energy and an industry-focused investor in energy, right? And I think having a pool of investors that is relevant in multiple aspects of your business is important. For instance, if you're a SaaS business, it's very important to have, or an enterprise SaaS business even more, it's very important to have, in my opinion, an investor that knows about B2B SaaS. How do you implement? How do you grow? How do you upscale? How do you sell to companies based on the type of ticket you have, based on the industry you have, and so on and so forth. It's also very important, of course, to have industry specific, because of course they can help you with reaching out to potential clients, potential partners, but also understanding some of the dynamics of the industry, being ahead of regulation, and in the end, giving you, helping you in, kind of managing or foreseeing what might be the next thing, or what you really can do to leverage the power of your business. This being said, I think there's also another aspect that for us is important, is having investors that are both in your beachhead market, but also international investors that are in the markets where you want to expand, where you see that there's power, or where there's financially very interesting opportunities. I mean, of course, the US is a big reference for investing, and not necessarily it has to be, you know, a B2B SaaS construction investor that goes there. That would be absolutely perfect, but there are other. So I think the good part is creating an ecosystem of relevant and pertinent investors for the different aspects and the structure of your company. I think that's what really makes sense.
Great, thank you. Thank you. I guess coming to you, Asher, as the world is increasingly digital, how do you see SaaS solutions adapting to new emerging technologies, or new emerging technologies such as AI, Web3, blockchain, maybe the next version of IoT? How do you see those adapting?
So, I guess, you know, an interesting question. So, you know, I guess SaaS is a business model, and then you're seeing these technology shifts that Sage was talking about, for example, earlier, you know, like AIML, you know, a distributed, you know, sort of Web3 distributed technologies. So these are technological shifts that are happening. What's interesting about today is that, you know, while the business model is fairly well understood, it's being buffeted by like a triple whammy or a multiple whammy of impacts. So you've got, you know, this AIML, and there's a lot of hype there, but there's also some interesting stuff that's been going on for many years. There's all these technological shifts that are going on. And then there's this other thing that is kind of interesting, which is, you know, access to, you know, connected data. So data that is actually networked, and networked maybe even at closer to the user than it was. And then you've got high-speed connectivity, and then you've got high-speed computing. And so you've got all of these things coming together. So it's actually, I mean, it's interesting, obviously, and it's a great opportunity for you know, SaaS-based solutions, because now they can do more. But the interesting thing, and I guess the thing that I kind of, you know, not worry about but like, you know, think a bit about is how those business models are going to change now. So, you know, well, before you would have a simple service and you would, you know, price that service and you would offer that service. Today, you've got much more complex solutions that, you know, driven by, you know, sort of like edge computing. So, you know, if you've got data that's distributed across different layers in different sort of places which need to be accessed, and the pricing of that data access is different depending on when and where you're accessing it. So that actually becomes quite complicated. And so now we're going to have this scenario that I see where you're going to have subscription plus usage based. Maybe that's just one of the things but that actually makes it complicated and more challenging for people like me, right? Because one of the reasons why I like SaaS was because it was sort of reliable, easy to forecast, you know, sort of revenues. And now my life is a little bit more complicated, but obviously there's fun in that. I'm not really answering your question, but I'm hoping that, you know, I saw Geronimo, you know, sort of nodding his head there. So I'm hoping we'll spur some debate there.
No, absolutely. I think I have a very similar question for Geronimo, who can probably add to that. But before we get to Geronimo, I think, you know, what you said about the cost plus usage, where I'm already seeing that at my level, which is, you know, I'm not an investor, I'm not a founder. But for example, you know, using the OpenAI API, you embed it into like Google Sheets. That's how I use it. Every use you pay per usage, plus you pay the original fee, right? And you're seeing this across a lot more, at least what I'm seeing in terms of generative AI. Every time you use it, you pay for it. And I'm guessing, I'm wondering whether that's because it's now and because the server costs are ridiculous at the minute for them to keep up, and if it's going to stay that way, or if longer term it will come back to a base price. But I guess we'll probably have to see, right?
I mean, so like the short answer is, you know, of course, the cost of compute is going to come down over time. I mean, you know, right, we're at the, and I guess this is why, so I've been investing in sort of AML space. I mean, actually, it's big data 15 years ago, but which is, you know, not a sexy term anymore. But, you know, like AML, this space is, you know, I guess the point that I was making was that, it's hyped up right now, and the cost of compute is very high right now, but this cost will come down at some point. I'm actually not so excited about the all this money that's being poured into sort of large language models, because these are commoditized. I mean, great that OpenAI did what they did, but it wasn't like nobody else had a large language model. I've invested in a company 4 years ago that had spent 6 years training their model on a verticalized, for a specific vertical. So I think that what's interesting, and maybe what I'm hoping to see more of, is as the cost of compute comes down, we're going to start to see more and more verticalized models. That's going to be interesting, because that's answering specific questions. There's a space for. I'm actually going to shut up now and pass on, because I can go on.
No, I'd love to build off that a little bit. I think one of the things, you're going to hear me say this a million times, one of our core tenets is customer, team, self, in that order of priority. And that was the beauty of SaaS, right? Is that you could provide the best service to the customer, and then charge it based on the value that they're getting, or that's the idea. And I do think there's all sorts of challenges that come with the high cost of compute, doing this either in-memory database or Snowflake or whatever you're going to be using. There's so many challenges that we're facing right now, and I think SaaS is really going to have some sort of a reckoning on the pricing model. But if we really do focus on, what value are we giving to the customer, and how can we think about structuring our pricing, our offering, all of that around the value, then hopefully that'll be the way forward, and it'll make Asher's and my life a little bit easier on the modeling perspective, but also just really provide the best customer experience all around. And sometimes it's not the most obvious thing. Sometimes you have to really think about what is the underlying value and how do I provide that and structure it. Sometimes it's very clear, but I absolutely agree with everything you're saying, Asher. We are going to see a change in pricing models. I just hope that we are changing around customer perspective and customer value.
Yeah.
Right. Thank you both for that. I guess, Geronimo, staying in line with those principles, as a fellow at the IDEO collab focusing on data, AI, blockchain innovation, how do you foresee these technologies influencing the SaaS landscape, particularly in the AEC industry? And are there any plans to incorporate more of these advancements within Buildia's future roadmap?
Yeah, thank you. Well, there's a lot of potential, especially in this case in an industry that is, as I said, heavy in operations, heavy in assets, and where the types of operations are also very, very diverse. When I was working at that time, and keeping in the research for a IoT, blockchain, and so on, there was like a limited connectivity. It's interesting that I speak about that with the problems we're having, but it's getting faster and faster and faster, right? And the amount of devices, the cost per to digitalize, basically to connect every device, is just going down, right? So a lot of use cases that were sounded completely ridiculous, like for instance having a hammer connected to an IoT, now make total sense, or make sense in the short to medium term, right? So that allows you to think in much larger ways of like networks of assets, for instance, networks of tools, networks of vehicles, networks of many other things that you could really, and I mean small vehicles in a construction site, for instance, right? That you could really start using. Same happens, and I think not only in construction. I mean, we see that in renewables, we see that in oil and gas, in infrastructure like water, railroad, and so on. The data of the operations, for instance, of procurement and sales, but also of other types of operations of these core businesses, is absolutely scattered, unbelievably scattered. Even in very, very large companies, they really take, in some cases, months to get to a data piece that should be right now figured out in real time, basically. So I think as you progress on connecting all of these devices and getting into more specific SaaS operations, all these data just becomes indexed and, more importantly, structured in a way that makes sense for the nature of the industry. And so it's not something that you put, for instance, on a classical ERP, where then you have to put a lot of effort to extract that and put it to work. But it just becomes structured for the nature of the industry by definition and in real time. And then it's way easier to consult. So for instance, things we're doing right now already with a bit of natural language, but a bit of predictive models as well, based on the databases that we have, is understanding how, based on the previous, but also present and future projects of a company that is doing procurement or sales on Buildia, we can extrapolate the model and the patterns of procurement, the patterns of supply, and model new projects. And instead of, for instance, entering a tender, being an effort of like 1 month for a general contractor to estimate the cost of that, and then of course having a lot of uncertainty as to whether they are benchmarking that price of the contract in the correct point or not, and what that risk entails for their business model. Now they can just base their decisions and their modeling for that tender on their previous data that has been mined and input on the system, and on the operations that their different users in their company are doing on Buildia, right? So that saves a ton of time, but more importantly, it impacts directly the core capacity to generate value for this company, right? And it improves their competitiveness in the end of a whole industry. So that's the kind of usage we see for Buildia.
Great. Very in-depth. Thank you very much, Geronimo. I guess moving away from the AI machine learning, moving on to more environmental issues, right? So as the world grapples with environmental issues, how can SaaS companies contribute to sustainability? And what are some innovative examples of green SaaS solutions or practices you have seen? And maybe, Asher, you can give us your thoughts on that first.
Yeah, so I guess sustainability is not is maybe something that you either are focused on or aren't focused on, and so it's not just like entire businesses, it's actually how they operate. So I guess the way I would put it is, we kind of need to we're building sustainable businesses. I'm in the business of working with founders to help them build sustainable businesses. If they're going to be sustainable businesses, their environments need to be sustainable, and therefore they need to be thinking about their customers, and they need to be thinking about their stakeholders, and they need to be thinking about working with people that are sort of values aligned with them in terms of building a sustainable ecosystem. And obviously there's an environmental sort of like impact that you can think about there. To me, it's not something that is like a core focus, because that's just PR, CS, that kind of stuff. I don't think that actually drives impact, from an environmental, sustainable sort of point of view. I think it has to be built into everything that you do. And so I guess from that, that will lead to greater levels of digitization within, workflows and whatever, and that's just going to lead to greater demand for the types of tools that you would normally, use, that would then be, subscription based, and therefore, that there will be, I guess, kind of bringing it back to the business model, which kind of enables itself or lends itself easily to be able to accelerate anything. And I think that that's kind of what is cool about the whole SaaS space, which is that, you don't have to think about what you're going to do in this space and how you're going to make your business more sustainable. It's like, it's the most sustainable thing that you can do is like not replicate activity that's already been done by someone else and better.
Great.
I don't know if I answered your question there. But...
Yeah, you did. Sage, do you have anything to add to that?
I mean, I think I agree with a lot of what Asher just said. I mean, I talk about the cloud a lot. It's hard not to. The cloud is everything these days. But you think about that, and you think about the fact that you can pay for instances that you need only when you need them, and that's huge. And you can turn that. We don't have to have our own data centers anymore that are taking up a lot of energy. Like, there's a lot of things, if you really think about the underlying infrastructure that runs a lot of what we interact with and what SaaS is. The cool thing is you can see where there's overlap between environmental sustainability, all of that, and these SaaS environments. I think about a startup I used to work at that did resource management. And the whole thing was, make sure that you have exactly the amount of resources that you need for the applications you're running to run performantly for the end user, but only exactly what you need. And when you do that, you maximize efficiency, both for the resource perspective, but then also sustainability. You're literally not running things that you don't need anymore. And so we're seeing with these again, coming back to pricing models, but coming back to innovations, all of this is interconnected now in a way that I think could, if we put the customer first and we think about all of that, could actually positively impact our environment and the sustainability message and all of that. But it really is about driving customer experience. And I don't love the word efficiency because it's performance. It should really drive it. But I guess performantly running efficiently.
It's a good one. Just to add to what Sage is saying, that just to bring it to the like the point, I think where maybe there's a bit of a challenge is like accurately for founders or SaaS companies to understand how how usage drives efficiency or drives sustainable efficiency. So like I was talking about something earlier, which is where your data is housed and how often it is accessed. So that is consumption. So if you are and the thing is, there's a direct correlation between cost and sustainability. So actually by reducing your costs, by housing the data that you need to be accessed more frequently versus data that you sort of access infrequently, if you house them in the right places, your costs go down, and that is actually sustainable because you're not pinging the server. You're not pinging the server for which is expensive versus the server that is not. So I don't know if I'm making sense there, but like it does actually, sustainable makes it cheaper and better, of course, faster as well. So.
And it also, all these new innovations we've been talking about, I mean, thinking about what Geronimo is building, like you're letting technology figure out the best path forward. And Geronimo, I've loved hearing about Buildia. I hope you'll jump in now, but yeah. So I guess I'll hand it off to you, but there's so much room for opportunity here as we think about sustainability and efficiency.
Yeah, absolutely. I was going to say, I first of all, I totally agree with what you were saying. Actually, us, for instance, quite recently, we just changed the way that our databases are pinged just to improve that. And in this case, it's definitely about sustainability, but there are also a lot of values in that effort as well, like speed, for instance. For us, it was a drastic thing, changing the way that's consulted, right? But of course, making your own business more efficient is, I would say, more than it's an obligation we all have, I think, and more everyone is aware of the impact that technology has in itself, like data storage and so on and so forth, electricity consumption and so on. But I think, of course, there is another part, and I think coming from construction, I should speak as well as about what your technology can really do for its clients. And one of the problems we see with complex problems in sustainability in companies is that it generally is an aftermath. And I'm going to put an example. So we are in an industry that produces 36 to 40% of CO2 emissions, direct and indirect. Only cement is between 5 and 8, depending on how you measure that. And out of a building, 50% of the energy is operating it, so aircon, electricity, and so on over its life cycle. 50 to 100 years, depending on the country. And then the rest, which is 50%, 20% of the world's CO2 emissions is embodied carbon, which is the carbon you produce by extracting materials from the source, transforming them, transporting them, building them, demolishing them, and getting them down to, wasteland or whatever. Nobody knows really what to do with that. And the problem with companies is that as regulations start to ask that, you need to say how much embodied carbon you're generating, they start doing an aftermath. So they do the project and then they start accounting. But what's the sense of that, right? When a project takes 3 years to build or 5 years to build, and then you start calculating the carbon, first of all, the harm is already done. Second, you're investing a ton of money in something that really goes nowhere, actually. And that creates a lot of frustration, especially on the businesses themselves, because it's like an additional cost, an additional responsibility. They don't have the tools, and it feels really bad, right? So I think thinking in a way strategically, putting that kind of core value at the center of where you lead your technology is super important. In our case, for instance, it's always been one of our dreams. Where some of our backgrounds come as well in construction, passive construction architecture. So we were really aligned with that. But one of the things we're doing is, where is the embodied carbon generated in the supply chain? When you take the decisions of procurement, it's where you are deciding about one supplier or another one, whether that supplier comes from 10,000 miles away or 200 miles away, and how you build everything in the building, right? So helping, as you have the data of the procurement, estimation, supply chain, helping them to analyze in real time what is the embodied carbon that is implicit in their decisions, and being able to account that at the same speed as you account the cost, or as you account the type of suppliers and the patterns of supply, right? So that's something we're doing now in an R&D project of our own, and also with a large company that is on a goal that basically for working with them alongside a Spanish company, but with global market. So that's what really excites us about the power of transforming an industry that has so much impact. And I think, yeah, it's part of every company in a way to think that way. Whether you achieve it or not, sometimes the challenges are very, very large. But I think putting that also, it drives competitive advantage for you as well, especially when regulation is on your side as well. Yeah.
I think one of the things that stands out so strongly about the way that Geronimo talks about what he's building and stuff is his real maniacal focus on the customer and then improving his customers' experience and work and all of that. I think we've talked a lot about innovation and things like that, and particularly when you have all of the new technologies evolving like they are right now, there's a tendency to just try to use the technology for something, and that's great. A lot of times things come out of that, but I think that the really special and new technologies are the ones that say, okay, I see an industry that's ripe for innovation, but let me really think about how can I improve the customer's experience the same way that Geronimo has. So that then I can create something that's really, really desired and becomes a standard and necessity in the industry, as opposed to a fun tool that some people really like using, but maybe won't be as widely adopted. So Geronimo, it's really cool to hear you really centering this on the experience you're providing for the customers you're serving.
Thank you. Yeah, I'm gonna just quickly say that sometimes that's harder. That's a conversation we have with many investors. Like, we are on a core part of the industry, and it's harder to get in because the product needs to be very robust. The data needs to be treated with a lot of care regarding privacy, regarding precision, regarding, a lot of things. But then when you get in, you are relevant, and that's important. And there's no, like, you're not a trend that is going to go away in like 6 months, right, or a year. You're there to stay and to grow, and it's a bet. It's a hard bet, but in our opinion, it does make sense. Yeah.
Great, guys. I would love to keep this conversation going, but it's already been, the time has elapsed. So just one more question, which I like to ask at the end of every panel or anyone I'm speaking to, just because there's a lot of founders watching it. And I know, Geronimo, you're a founder, but it'd be great to get your insight. I think you have a lot of insights there, especially with your customer centric. But what is one tip you would give to an aspiring SaaS entrepreneur, and just assume that they have an idea and that's it? Maybe Sage, you can start.
Absolutely. I think this has been a sort of theme of all my points today, but focus on the customer's perspective as you build your business. They will have incredible insights for you, and also ultimately, quite obviously, be your customer. And so, and your revenue machine and all of that. And so if you really put them first and think about how am I improving their lives and how am I improving the offering that I'm giving to the customer, that'll help you as you think about all the questions we've discussed around pricing, around innovation, around new technologies, all of that. Focus on the customer first, the same way, like I just said, that Geronimo has, and then build from there.
Fantastic. Maybe Asher?
Sure. So Sage stole my thunder there. So I'm gonna re-articulate it. So I spend a lot of time with founders talking about empathy, about putting yourself in the shoes of your customers, putting yourself in the shoes of your stakeholders. So, it's not enough to identify a problem and build a solution. What you need to do is develop empathy, because the environment is dynamic, and your customer's environment is changing continuously, and your stakeholders, your partners, their environments are changing constantly. So I would say developing empathy and creating a muscle memory for like being focused on understanding your stakeholders and their environments and their perspectives, your customers, their perspectives, their environments, and then building a solution that solves the problems, not just for today, but also positions them for success. So like, I guess tying back to something that Geronimo was saying, which was that, they understand that their customers cannot continue by basically post-mortem figuring out how much CO2 emissions they had. They kind of need to get ahead of that problem. And so him trying to figure out, A, understand that, and B, then trying to solve that, that's what I would say you should focus on.
And Geronimo?
Yeah, I'm going to use a graphic image. Not sure how many people might have seen this, but there are some videos on YouTube where this chemical reaction between an acid and a base, and then both liquids are transparent. You put one drop of liquid from one base to the other one, and then 9 drops, both liquids are transparent. Then you put the 10th, and it suddenly becomes very dark black automatically. And I think part of the great businesses are that it's just like working like a clock behind the idea to make all the tweaks on the tiny things that really make the business run and more hard to copy, and there are many things, but just one thing that for us has been two things that have been really important is like understanding really how you need to sell on B2B to your own segment. And there are a lot of resites, a lot of frameworks, but then when you understand exactly who's behind, how do they take decisions, how is their budget allocated, what are the reasons behind, and so all of that, you are able to make a more scalable and more, in the end, efficient sales machine. That's one. The other thing is relationships, and also I think this not only happens to founders, but also to some more generalist investors. They see what you do and they say, "Oh, it's a marketplace." Well, it's not exactly only that, because the value can be put on the relationships, or the value can be put on the operations first and then on the relationships, or on both. And then what exactly do you do for each, and what are the intermediaries playing, what is the motivation for all the players into that might be different for one marketplace and the other one. So I think understanding really that and not taking that for granted, and understanding what really makes sense makes a difference. And it does sometimes take time. It takes time in some industries. So it's not just like have the idea and within 1 year you're boosting, but it takes effort, I think.
Great. Well, thank you very much, the three of you, for joining us today. And if any of the people out there have any questions, I'm sure you can find them on social, LinkedIn. But yeah, thanks for joining us today. I am going to have to move ahead, but yeah. Thanks, guys.
Thank you.
Thank you. A real pleasure.
Thanks. Bye.
Next presenting is a company that builds massively multiplayer live games, coined as the next generation of cross-media experience. So over to Nathan Moore, the CEO of LiveTech Games.
Hello, everyone. My name's Nathan, and this is my co-founder Samuel, and together we run LiveTech Games. Thanks for taking the time to listen to our pitch.
LiveTech Games is creating the next generation of cross-media experiences through the power of mobile gaming. And we have the traction to prove that we will lead this new and emerging market.
We're pitching to you to raise a £1.25 million bridging round, as we've signed a contract with one of the top 3 YouTube influencers on the planet. And this bridging capital ensures that we can return the significant upside that this deal brings to LiveTech Games later this year.
So, as for that traction, well, we have built a first-of-its-kind technology platform backed and supported by C-level executives at Microsoft. We have built 4 games to date, and all of them have been ranked in the top 10 by the Apple App Store, including one of our games being the #1 game in the App Store last quarter. Our games have double the user retention of the average mobile game, meaning they stick around for twice as long, so we know that our players love what we build. And our commercial sponsors receive on average 5.7 times better click-through than their equivalent campaigns on social media, such as Facebook and Instagram. And this is due to the non-intrusive nature of our ad inventory. We have an incredible and diverse team of 17 employees that have been building the fantastic products that our community loves. And finally, we've already partnered with household name ITV and we're now working with one of the biggest YouTube groups on the planet. From the technology to the product metrics, or the commercial gains to the people making it happen, LiveTech Games is ready to deliver on the next exciting growth stage. Because this deal with the enormous YouTubers puts us on the cusp of profitability, we're not raising a full funding round. Instead, we're seeking a £1.25 million bridging round that allows us to deliver our deal with these influencers and secure the tens of millions of pounds of revenue that comes with it. This deal will generate revenue from about mid-October this year and make us cash flow positive by Christmas, meaning that LiveTech Games should actually close out this financial year EBIT positive. So now that you've got the background as to why we're raising, let's dive into the details of what we do. We build massively multiplayer games like you've never seen before. Imagine millions of people all in one game in one moment. It's an exhilarating, social, and captivating experience, simple enough that anyone can take part in it and anyone can win. Our games are only available live, so they're driven by a push notification sent to all users simultaneously. And the adverts in our games enhance the experience. We run deeply integrated brand sponsorships that never get in the way of our games, and have an electric pre-game countdown that delivers meaningful brand messages to all players in one moment.
Our exciting style of games solves some fundamental problems for the interactive entertainment and gaming industries. Firstly, there's way too much choice. With such high volumes of content, people are wasting their time assessing their options. Secondly, the hyper-casual category is now hyper-similar. There are endless new games released each year, yet we see the same styles again and again and again. And finally, gamers hate intrusive ads. Pop-ups, annoying. Pre-roll ads, annoying. Brands have never enhanced the player experience until live games.
We are building something totally new and unique, and that genuinely solves problems faced by the industry. But the biggest driver of our success is the timing. The market is shifting away from the usual on-demand, always-on, 24/7 access products, and we are the first ones to react in gaming. On-demand is old news. You know, today's culture-defining apps all make you wait for your next interaction. Think about Be Real, Thursday, Wordle, and even Netflix now releases their shows weekly rather than all in one go. And short is sweet. With attention spans declining, there's no wonder that the most used apps on our phones require only short bursts of engagement. And last but not least, we're in the integration revolution. Integrated in-game advertising is the fastest growing form of mobile ads. And the world's biggest brands are now collaborating with the world's best games.
We're best placed in the market to take advantage of this market shift because we've built our first of its kind platform. Live games with millions of players creates a vast technical complexity and a massive barrier to entry. Think about on Black Friday when everybody tries to buy a discounted product, or Glastonbury tickets. Everyone's doing the same thing. It's they log in at the same time and the website crashes. We've got the same problem, but in gaming, but now we've cracked it. LiveTech Games has a proprietary mass concurrency gaming system, scalable and customizable. On top of that, we're also the right people to take this forward. Sam and I are both ex-Microsoft. Having worked at the tech giant for a combined 5 years, we've leveraged that network to unlock access to unmatched compute power on Azure, and that's not ordinarily available to the public. We've also been named in the prestigious Forbes 30 Under 30 list, and we've won Entrepreneur of the Year and Digital Startup of the Year for 2 years running. We're backed by industry heavyweights and strategic investors.
And on the commercial side, we generate revenue through sponsorships, in-app purchases, and subscriptions. We've delivered hundreds of thousands of pounds in sponsorship revenue through our unique and premium sponsorship packages. As our ads don't get in the way of what players actually want to do, we're able to drive much higher click-through rates than the whole of the digital advertising industry. Where Instagram or YouTube measure their time with brands or impressions in seconds, at LiveTech Games, we measure it in minutes.
So to summarize, We're looking for investors who want to support live tech games by bridging the gap between our current runway and receiving millions of pounds in revenue in Q4 thanks to our deal with one of the most prominent YouTube creators in the world. This multi-year influencer deal alone is set to carry the business to profitability. And that's before we consider all of the other clients, contracts, games, and our platform that Live Tech Games already has and will continue to grow and monetize.
We've built a best-in-class tech platform. We've proven that our style of gaming is loved by our players, and we've demonstrated that we can charge a premium for our advertising space. And now the market has verified that the timing is right, and we're ready to move quickly and take Live Tech Games profitable. And we hope that you can join us on this funding round and on this journey.
Thank you very much.
Thank you very much.
Up next, we have Steve Robinson presenting for Hyperglance. They are a powerful cloud management platform designed for cloud professionals. The platform streamlines architectural diagramming, security and compliance management, cost management, and automation. The floor's all yours, Steve.
Good afternoon. My name is Steve Robinson, CEO of Hyperglance. I'm honored to brief you on the exciting high growth opportunity Hyperglance is driving in the cloud market segment. Hyperglance is dedicated to delivering cutting-edge multi-cloud management. Our vision is to become the go-to tool for cloud engineers, architects, and InfoSec teams within every large enterprise and governmental body. Enterprise and governmental cloud adoption has never been higher. However, cloud customers are experiencing significant pain points in managing their cloud across security, compliance, and cost optimization. 75% of organizations use multiple clouds, whether it's Amazon AWS, Microsoft Azure, or Google Cloud, only compounding the complexity. Security and compliance posture management is very time-consuming and requires expensive engineering skills. Maintaining an optimal cloud spend profile over time is not practical if not automated with clear insights to cloud billing. Lastly, documenting this complexity, whether for internal controls or third-party audits, is expensive and not the optimal use of expensive engineering time. There's a better way. Hyperglance is the solution. Our solution monitors and automates visual insights and remedial actions to ensure security, compliance, and cloud spend optimized. Hyperglance creates push-button easiness in creating cloud architectural diagrams, security and compliance charts, and cost trending visuals down to the second. If left done manually, engineering staff consume thousands of unnecessary hours and expose enterprises to significant operational risk due to human error. Hyperglance ROI is achieved within 6 months on average, delivering 30 to 60% cost savings annually. Lastly, Forrester estimates the market for cloud management software, like Hyperglance, will grow to 56 billion by 2030. What are our unique selling points? Hyperglance is used across enterprise and government market segments. Our 3 primary differentiators include our local deployment model, ensuring customer data never leaves our customer's cloud, granularity and customizability, not locking our customers into one-size-fits-all, and the scalability of our AI-enabled solution in terms of anomaly detection and remediations. The competitive landscape in the cloud management market fall primarily into fixed point solutions deployed as SaaS, exposing their customers to data risks. None of our competitors create multi-cloud visualizations at the level of granularity that we do. And very few competitors offer the full suite of capabilities Hyperglance provides in a unified dashboard. Due to these unique feature sets, Hyperglance has bid and won business against several larger competitors over the last 12 months. Hyperglance marquee customers include Fortune 500 customers, Disney, US Air Force, L'Oreal, Gigamon, Owens & Minor, and US DoD customers, United States Air Force, FBI, and General Dynamics, to name a few. Growth highlights include 1.4 million in ARR run rate, 90% gross margins due to the fact that we do not bear any hosting costs, 84% year-on-year revenue growth, and 110% net dollar retention factoring renewals and upgrades. Significant pipeline growth and new demo volume has also been realized. 60% of our sales volume are sold on annual contracts. Lastly, Hyperglance was recently recognized as a Cybertech 100 global company. The Hyperglance leadership team comes with 50 years of combined experience selling marketing, developing, scaling cloud solutions. Our R&D development team is located in London, with sales and marketing headquartered in the US. The intention is to expand the team internationally. Our ask is $5 million in equity for growth capital. Over the next 2 years, our executable plan calls for hyper growth to 10 million in sales globally. This growth will require investment in 4 primary areas: onboarding Google Cloud to our portfolio, expansion of the sales team and hiring a dynamic marketing leader with appropriate budget, driving the next generation of Hyperglance with further investments in R&D and a focus on A&I, and lastly, scaling the company with expansion of the customer success and cloud ops teams. I appreciate your time and consideration today for investment in Hyperglance. I'd like to close with a product video delivered by our world-class CTO, David Gill. Thank you, and please reach out for deeper insights into our growth story and Chris.
Cloud professionals live under constant pressure and escalating demands. They live in a constantly shifting landscape. Cloud technology offers unprecedented power. It's elastic, it's scalable, it's easy to deploy. The downside, it's easy to lose track of what you have and what it costs. The cloud is an opaque environment where risks like to hide. Hyperglance changes all that. Hyperglance continuously scans your environment, creates an interactive visualization of every resource and every relationship in your cloud architecture. From AWS to Azure to Kubernetes, Hyperglance delivers insights and solutions in real time. Hyperglance is built from the ground up at the intersection of DevOps, FinOps, and InfoSec, giving cloud professionals critical insights at speed. Hyperglance is the only tool you need to instantly visualize and manage your cloud architecture, no matter how complex, with the most powerful, user-friendly dashboard anywhere. Hyperglance creates a complete cloud infrastructure diagram. You can see all your assets, all your connections, all their dependencies, all at once. Clients come to us because they have no idea where their costs are coming from or what to do about it. And when they're using more than one cloud, the complexity compounds. Hyperglance gives you multiple, actionable cost insights, misconfigured resources, VMs left running 24/7, unused snapshots, and unassigned public IP addresses all cost you money. Hyperglance Cost Explorer takes a deep dive into your consolidated billing account, focusing on your spending trends. Hyperglance uncovers underutilized and idle resources, making recommendations about which VMs or instances need right-sizing, or how reserved instances might be more cost-effective. It's not just about cutting costs. Our sophisticated rules engine shines light on your security and compliance risk, like IAM access controls and ill-defined security boundaries, unsecured S3 buckets, or VMs left public. That's critical because most successful attacks on cloud services come from unforced errors and internal blind spots. So we set out to solve that. Hyperglance automations immediately quarantine and lock down insecure configurations. No-code solutions automatically enforce your cost, security, and compliance policies, averting potential disaster. Continuous monitoring using hundreds of built-in checks based on key compliance and cybersecurity frameworks, like NIST 853, PCI DSS, FedRAMP, HIPAA, and many others. Hyperglance users include many of the world's marquee companies. Hyperglance isn't SaaS, it's 100% self-hosted, running inside your environment. Your data stays where it belongs, with you. We don't see or touch your data ever. What risks and opportunities are hiding in your cloud? Book a Hyperglance demo and see cloud insights visualized into action.
We have SentioCX. SentioCX integrates with conversational AI vendors to provide a seamless handoff from bots to live agents through intent-based intelligent routing for a frictionless customer experience.
SentioCX is a company headquartered in Amsterdam. We offer a solution to provide a seamless handoff from a bot to a live agent. So what we do is to take the friction out of the bot dialogue in order to improve the customer experience. In recent years, conversational AI and bot technology has been incorporated in many enterprises. The technology that exists today is effective, but it lacks a proactive human connection when people get stuck in the bot dialogue or when they have a complex inquiry. So that's why at SentioCX we invented a solution which we refer to as AI-powered intent-based triage for conversational orchestration. Now let's look at what the problems are today.
We've all experienced the pain of trying to get hold of our bank, energy provider, or online store to solve an inquiry around our account. Over the last 2 years, wait times have increased by more than 50%. And when we finally get connected to an agent, 1 out of 3 agents are not able to help, which ends with the issue being no closer to being resolved than when the conversation began. To optimize operational efficiency and to reduce hold times, there has been a huge shift towards companies using chatbots to handle inquiries. In 2022, more than 75% of health and banking queries were handled by chatbots. But there is still a huge amount of customer dissatisfaction. For complex issues, customers expect to be transferred to a human agent immediately. More than 60% of customers report frequent disappointment with their chatbot experiences, including not receiving accurate answers from the bot or getting routed to the wrong agent. Wait times to live agents are also unpredictable. On the other side, agents have increasingly experienced symptoms of fatigue and burnout. In fact, a Salesforce report revealed that a whopping 71% of service agents have considered quitting in the past 6 months. Customer service managers lose $1.6 billion a year due to customer churn. Out of all the customers leaving, 70% is due to poor customer service. Today, companies are having to deal with trade-offs between the quality of the customer experience and the costs of providing it. Many companies are heavily focused on reducing costs, improving operational efficiencies, and implementing self-service tools such as bots. Yet 59% of customers feel companies have lost touch with the human element of customer experience. In particular, when customers are dealing with complex issues, they expect empathy from live agents who are able to intervene instantly to resolve their issues. Companies need to be able to use conversational AI technology, ChatGPT, and bots to benefit from cost savings, while at the same time improving customer retention and satisfaction by detecting friction in a bot dialogue. In addition, companies don't want to lose revenue opportunities by having the bot simply recognizing a need for a live agent to intervene and providing a seamless transfer from a bot to a live agent. In an ideal world, chatbots and live agents should be able to work in harmony to provide the best possible service to customers. At SentioCX, we enable organizations to create extraordinary experiences for their customers, while benefiting from operational efficiencies. Sentio is a Latin word for I experience or I feel. SentioCX provides a seamless handoff from bots and conversational AI applications to live agents through intent-based intelligent routing. Rather than placing chats in a queue based on first in, first out, we use AI and machine learning to determine the best match between the customer and the agent. When a customer begins a chat session on an energy provider's website and indicates that they want to switch over to another provider, SentioCX detects the customer's intent and proactively routes the chat with the highest priority to an agent with a special skill on customer retention. The result is an optimal match between the customer and the agent. We call this conversation orchestration. In addition to this, there are 3 things worth mentioning. Firstly, we ensure that customers experience shorter wait times to get connected to the right person. In the event that agents are busy, we inform customers about a predictive waiting time. Secondly, when this predictive waiting time exceeds service levels, reserve agents or knowledge workers can be notified to make themselves available, not just within the contact center, but across the entire enterprise. If reserve agents and knowledge workers remain insufficient, SentioCX can temporarily declassify low priority intents to keep these related chats in the bot to make room for high priority conversations. And lastly, we enable customers and agents to switch from chat and voice to video at the push of a button during the chat dialogue. The agent and management software is fully embedded into customer engagement software such as Zendesk, Salesforce, or contact center vendors such as Genesys. Through SentioCX, we ensure a seamless experience for customers and improve agent retention by taking the friction and frustration out of the customer service process. SentioCX plays at the intersection of two growing markets: the conversational AI market, which is growing at a rate of almost 25% year over year, and the CRM customer engagement center market with players such as Zendesk, Salesforce.com, Pegasystems, which is growing at a rate of almost 11% year over year. We launched our MVP last year and have since then formed partnerships with Zendesk, Rulai, Microsoft, Cognigy, and Genesys. From April 2023 onwards, we will have our first paying customers on our cloud platform. We have received positive feedback from conversational AI providers, CEC vendors such as Zendesk, and large enterprise customers such as banks, insurance companies, energy providers.
And when we started this company, we started to build the algorithm first. So we patented it in the US, and then we started to develop the product. And we do that with a team of international developers from all around the world. So what is our ask and user funds? Well, first of all, we're raising 1.5 million euros as CLA, or pre-Series A equity round. And that's going to be used to scale out the team, scale out the operations, but definitely to build the organization, such as the go-to-market team, to build a customer success team, establish our presence in key markets. For sure, markets such as the US, but also the UK are important markets where we anticipate a lot of growth, but also expand our partnerships with bot vendors, conversational AI vendors, and customer engagement center vendors. And then we'd like to focus on a bit more on product development. We have a very good working product as we speak, but we'd like to enhance it with additional capabilities, but also the support for bot vendors and CEC vendors. And then, of course, last but not least, a technical operations team to maintain the platform to make sure we can meet the service levels with our customers.
Today, we believe that with the advent of technology and our work at SentioCX, we will build the future of customer experience, where chatbots and live agents work together in harmony to provide the best possible experience to customers.
Presenting next is COPYTRACK. COPYTRACK's AI image matching enables the global monitoring of images and products for agencies and brands to monetize them. So over to yourselves, tell us a bit more.
Hi, my name is Markus. I'm founder and CEO of COPYTRACK based in Berlin. I'd like to share our presentation. So at COPYTRACK, it's all about image monitoring. And the problem that we face is that brands, e-commerce, publishers, photographers, and agencies, whoever owns images, actually has no clue where their images are used, or where the brands and products are abused, counterfeit, or sold in the internet. Fact is that 85% of all images used in the internet are unlicensed, and this leads to a loss of $900 billion per year. In the area of product piracy, 15% of all branded goods face product piracy, which again leads to a loss of more than $600 billion per year. So how do we solve that? We have developed a technology in order to crawl the internet. We find about 90% of all stolen or used images worldwide. Attached to that, we have an image matching AI that has an accuracy of 97%, no matter whether the image is cropped, flipped, color changed, etc., or part of a collage. We have attached to that a fully automated settlement portal for opponents where they can look at their case, provide license proof, or settle the whole case and post-license or pay compensation. The evidence is preserved fully automatically, and currently we search about 15 million images per month and compare about 500 million images per month. Connected to that, we have a global automated settle and enforcement. Currently we process about 33,000 cases per month, and 50% of those cases we accept. Then we have 100% automated settlement, as I just explained. If this is not working out, then we have legal partners around the world for commercial collection as well as legal enforcement at court. So the market opportunity is immense in the area of copyright infringement. It's more than $900 billion, and in the area of piracy and gray markets, it's $600 billion per year of losses. Competition-wise, there is a handful of competition. However, these are just local players in certain countries. We are the only one that really offers a global service. Also, when it comes to accuracy of the technology and the service level and scope, then we have several advantages. Traction and performance-wise, I already told you about our technology. So I would say that's cutting edge, and we offer loads of helpful features and labels and filters to our clients that make their life easier. We have about 50,000 clients. We consider 10% at least active clients from 120 countries. We process 30,000 cases, accept 50%, and the success rate is about 10 to 15%. Business model wise, we have a transaction, a commission-based model, and we have a claim volume of 30 million per year, and a revenue, a cash in of 2.3 million per year currently. Team wise, as I said, I'm the founder, and I already had a successful exit with Frightride before, so I'm an entrepreneur for many years. We have Fabian as our COO with us for more than 5 years, and Justus, the CTO, is a very experienced developer and runs our IT department. So the opportunity here is not only scaling the existing business, as I explained it, but with our existing technology, we want to create a new SaaS product in the area of brand and product monitoring. Same base technology, just another front end and a reporting tool. So we have less than 6 months time to market after investment, and use all of the existing core technology. Already have successful first clients, like we had Sennheiser and a producer and e-commerce company in the area of drills. We had very successful projects with them. Also, the SaaS model will most probably outperform the existing business model already after 2 years, due to the fact that it's much more profitable. So the first case is scaling the current business. We have already done that in the past 3 months, very successful, and doubled our revenue with that. So if we add staff here, then we have a ratio of 1 to 5. 1 euro invested returns 5 euros after 3 months. So that's a no-brainer, and we want to scale once again and double the business here. The second one is the new SaaS product. As I said, after 2 years, we already have a return of the invest, and from then on, it's a typical SaaS development, so the returns are very attractive. Altogether, we are looking for 2 to 3 million, and so we would go for the scaling of the current business as well as the new SaaS business. However, we think that from 2025 on, SaaS business will, as long as profitability is concerned, take over the lead here. A few insights into our key figures. So we are represented around the world. As I said, core market is still Europe, Japan, and the US. The recent June 2023 numbers, 33,000 claims processed, almost 16,000 claims accepted and processed. And cash-wise, we reached again an all-time high in June of almost 200,000 euros. So we are on a run rate of about 2.3 million yearly revenue here. Thank you very much. And if you want to contact me, it's markus.schmidt@copytrack.com. Looking forward to hear from you. Thank you very much.
Now, with billions spent annually on data and research, the question is how to improve the return on investment of that information. KiteEdge develops search and content management software designed for asset management to free up time and improve decision making. So over to you guys.
Hi, so my name's James Flavin. I'm the Chief Exec of KiteEdge. KiteEdge is a knowledge and analytics business, and we're tackling a very big problem, which is that there is just too much information out there, too much knowledge. So this is a chart by IBM. It says that human knowledge is now doubling every 12 hours, which of course is a big problem because the haystack's getting larger and the ability for individuals to extract insight from that haystack is getting increasingly difficult. Indeed, with our most recent client, they calculated that a 5% time saving can lead to around about a 10.8% improvement in enterprise operating profit. And this is a problem which is very well understood. So 30% of an employee's time is spent looking for information, and 60% of enterprises acknowledge that employees are hindered by time constraints and a lack of understanding. So I said it's a well understood problem. We're all familiar with Google. Google's a big advertising business and a popularity engine. And of course, within the average enterprise, your job is not to find the most popular content, but the most relevant. And this is a problem people have been trying to address for a long time. So there's a giant tech muddle in most organizations, and there's these many platforms. People don't know where to look. When they do get to the correct platform, they're confronted with a different search system that's probably not changed since the late 90s. And all these platforms require manual curation of content. We now have large language models. They're great. I use one every day. But they're kind of like going down the pub to have a drink with your friends, which is lots of interesting stuff was said, but you still need to fact check everything. So there's a lack of explainability, control, data privacy and security risks. And then a lot of knowledge is actually hidden in people's heads. So it's not really practical to go office to office, asking people questions. If you had a system that can better highlight the people you should speak to about a given problem, then that's a far better way of working. So that's what we do. We centralize access to all of an enterprise's content. So that could be content internally generated, whether it's sales documents, contracts, research from particular teams, data, or it could be the external environment. So that could be SEC filings, premium research from Goldman Sachs or other providers, videos, audio, large PDF documents. It doesn't matter. If it's knowledge that can add value to your enterprise, we centralize access. And then the job becomes, well, it's complex for us, but we need to make it as easy as possible for the end user to get to the insight that's most relevant to them. And that might be insight that they've not explicitly set out to look for. So in short, we unify all content from any source. We then harmonize that content. We have ontologies, and our secret sauce is a graph database, which I'd love to take some questions on. And then we make it as easy as possible for the individuals to get to that insight in a secure way by protecting licensing and making sure that only the correct people can see particular content. Now, that means you might have two people sat side by side effectively running the same search but getting different results because one person is licensed to see a certain body of content or it's within their pay grade and the other person is not. Now, this is just a quick explanation that in making it simple, we don't want to change the way people are used to searching, especially if the team has spent many years putting in place certain methodologies or categories and so on. So people can either use natural language search, they can use existing metadata that they're familiar with, or of course we actually use our graph to expose visually relationships between content. So if you're learning about a new topic where you're not aware of all the relationships, this is a great way of going. And then of course we highlight the people that you might want to have a conversation with, because 10 minutes could save you several weeks worth of work. And this is just a quick glimpse of the way the platform looks with our AI assistant alongside the search results. Now, this is a SaaS business model, so we're priced at $2,500 per head. We've benchmarked that against many other services, and there's also a consulting element here as well, which is most organizations realize they have a problem. Bringing in a third party like ourselves to objectively create reports on how they can best improve knowledge flow, where's the low-hanging fruit, that adds a lot of value. We've been very successful so far, so we're lucky enough to be backed by the UK's Investment Association. They represent over 10 trillion of assets, so we were selected by 35 asset managers. We've just finished working with a large asset manager. We did a proof of concept with them. We have a 5-year MSA in place with them, and we have over 100 hours worth of recordings and reports on how they can improve knowledge flow. That culminated in them wanting to invest in our business, which is an ongoing discussion. And we had over 50 people sign up to our ontology project. So happy to talk people through that if needs be. And of course, there's a large sales pipeline here, which is predominantly in capital markets on the buy side, because that's where our relationships are. We're going to be launching in a matter of weeks. This is our first production version of the platform. Very excited. And that will enable us to start scaling at that point. Now, what's exciting here is that we only actually need 1.5 clients to break even. So, for example, with our most recent client, the spend for them is about 1.4 million per year in licensing fees, and that would make a 4 million saving for them. This is their calculation. So our forecasts are based upon capital markets, the buy side predominantly. But what's special about our technology here is it's all data driven, which means we can tackle defense, the pharma industry, any other sector, and the technology is able to keep up without needing any recoding of the platform itself. We're backed by a great team here. So a few people to point out: Amar Rajani used to head research aggregation at Bloomberg for 17 years. Dane Rook's one of the 2 Stanford professors that have backed us and have been writing about this need for the last 5 years. The research is a good read, so happy to point that out to people if of interest. So in summary, our vision is to transform how enterprises leverage all the knowledge they have access to, allowing them to better take advantage of the IP that they've carefully built up. We do so by empowering their workers to find insight. We store the content in a graph, which is our source of truth, but we also use large language models and other technologies to make it easy to get to the insight from that source of truth. And we call this collective intelligence. So what's our ask? Well, our ask is 1.5 million. We won't need more after this. As I mentioned, 1.5 clients means we can scale and we're profitable. That will enable us to bring on our first clients, extend the team to support them, and then we have 12 months worth of further product work to do to add features to the platform, which are features that have been requested. So happy to take any questions, and thanks for having me. Cheers.
So good afternoon, everyone. I'm delighted to welcome you all to today's AI panel session, part of V&C Global Series. It will be our last panel session for the day, followed by 2 more pitches and then a keynote session. Our session today is titled Transforming Industries, AI's Innovative Leap forward. We're extremely privileged today to have 3 esteemed panelists with us, all of whom are distinguished leaders and innovators in the field of AI. They bring a wealth of knowledge, experience, and perspectives that will undoubtedly make for a thought-provoking discussion. Our first panelist is Dr. Daniel Hulme, CEO of Satalia and Chief AI Officer at WPP, an authority on AI and a key player in the field of emerging technologies. Dr. Hulme is also an entrepreneur, a sought-after speaker, who we're very lucky to have, and an active promoter of purposeful entrepreneurship and tech innovation globally. Next, we have Mr. Ernest Sanchez, co-founder and managing partner at Nucleo. With a 20-year track record in tech startups and investments, Ernest brings extensive experience and invaluable insights to the table. His work at Nucleo has made a significant impact on the tech ecosystem in Southern Europe, and he's an active board member in several tech companies. And last but certainly not least, we have Mr. John Spindler, general partner at Twin Path Ventures. John is on a mission to nurture entrepreneurship in London and beyond, particularly through the application of AI. As CEO of Capital Enterprise and co-founder of AI Seed and the London Co-Investment Fund, his contributions to the London tech and entrepreneurship scene have been invaluable. Today, we'll be exploring a range of topics related to AI and its transformative impact on various industries. We will start with some general questions. The panelists will introduce themselves. The session is set to run for 40 minutes, and we encourage everyone to network with other attendees and the speakers via the networking zone. So without further ado, let's get started. Once again, a warm welcome to our panelists and to all of you joining us this afternoon. So maybe we can start with John.
Hello.
How are advancements in AI transforming industries and creating new opportunities from your perspective?
Okay, well, I've been investing in AI now since 2014. I did my first investment, and I've invested in 73 over the last 8 to 9 years. And in that period, we've had pretty big revolutions in AI, from the advances in computer vision as a classifier to basically the emergence of initially small language models, to the big kind of moment that happened to many, probably for the general public, in October last year when ChatGPT 3.5 was basically released, and people started to realize the power of a large language model to generate content, text, code, etc., and to make basically predictions in language. And since then, basically, I suspect every CEO and every investor in the whole of the world has been kind of saying, oh my God, how do we get into AI? Well, some of us have been in it for a while and seeing how AI has transformed industries across the board. Our big tech companies would not be able to function without AI. I think that's apparent to everyone, whether that is Alphabet, whether that is Facebook, whether that is Amazon. Nvidia, as everyone knows now, is part of the the big five, all because of the power and the requirements of AI. And AI has been become essential to our way of life. And some of the big developments are still to come, whether there be autonomous vehicles, whether there'll be basically the ability, quite frankly, of large language models to take over many of the mundane and basically time-consuming jobs that basically absorb far too much of the talent in basic Western democracies and further afield. In areas, for instance, such as medicine, we're seeing a whole gamut of new therapies being developed by AI. We're seeing new diagnostics led and fed by AI. The whole kind of thing comes to me to sense that what isn't the impact of AI would be easier. Where is AI not impacting would be an easier question. And I'm not quite sure. Maybe Daniel can help me out here and tell me where he feels that AI won't enter. So the question comes back to a probably more pertinent one, which is, where are the opportunities for investors, and where are the opportunities over the next 3 to 5 years for AI to basically make returns? And I think that's an interesting thing that we're all grappling with at the moment. I've just launched my new fund in the June the 15th. This is my 4th fund, 2 you mentioned before. This will exclusively invest in AI. And I can tell you, sitting in London as I am, I'm sitting on this enormous fire hose of opportunities emerging everywhere across Europe and further afield. And this is, I feel I'm a very lucky person to basically have the opportunities that is presented to myself at this moment.
Fantastic. Maybe Ernest, coming to you, right? In Southern Europe, what is the AI hype like, or trends, or anything like that? Is it different? Is it similar? Yeah, any insights would be great.
Well, thank you very much. So as John was mentioning, to me and what we're seeing in Southern Europe, this is becoming a global impact, I think. So it's not there's no boundaries on AI to expand, its ability and the capacity to impact in changes, particularly on time-consuming jobs in different routines that they can be deployed. But of course, I mean, from the investment perspective, there is different hubs where or in more advanced tech clusters where the impact is becoming more visual. So I think since ChatGPT was it democratized and it shows up what the AI could do to everyone and to every single person, it makes a difference, because everyone was just realizing that this is a reality. It's nothing that was just on the high level or high tech industry is a use case, but I would say that indeed, it's something that it's changing the way that people plan and execute. I've been investor in different funds for more than 10 years, and now we're focusing on the creation of companies. So we have Nucleus, a venture studio, is a venture builder that we started doing companies in the Web 2.0 space, and then we switched more into 3.0 as well. And so the point is that every single company that we plan to execute, it has to get this kind of component of AI, and you find it that every single founder just put this in the table, no matter the industry. And I don't know, it is going to be a hype that all the investors will be just flying around, and now it's the only one of the few sectors that they are attracting a lot of investments. But I don't know how long it's gonna take to get some, just a few winners like everywhere, and then see how the rest can differentiate from each other.
Great, thank you. And I guess Daniel, I think John asked the question. Ernest has said that every company now has some form or should have some form of AI. Do you think there's going to be a certain sector that might be less affected, or less affected by it? Or do you think all sectors across will have a very big AI will have a very big impact?
So I've been building AI solutions for companies for the past 15 years, and the kind of two criteria that I look at for an industry attractiveness is, are they willing and are they able? Are they willing to embrace these technologies because they understand the impact, and do they have the infrastructure in place to enable them to embrace these technologies? And whilst most industries don't tick both of those boxes, they realize it is important to make themselves both willing and able. So I think all industries will be impacted. Ironically, I would expect my job, doing all these talks all around the world and panels, to be the first thing to be replaced. But so far, not. I could be replaced by a tape recorder, but maybe with the last bastion of AI taking our jobs. But I think that but every single industry will be impacted, and I think that there's two mindsets. There's a mindset which is we need to use these technologies to alleviate inefficiencies, to improve and make things more effective. But I think there's a more superior mindset that I'm inspired by, where organizations realize they need to architect themselves for adaptation. The world is going to be rapidly changing over the next several decades, and those organizations that are going to survive are the ones that can adapt very, very quickly. So it's not where can we just apply these technologies to alleviate frictions. It's how can we change how our organization essentially operates and reacts to a rapidly changing world.
Right, great. And I think, this kind of leads to my next question. You said the rapid development and pace, and I think just sticking to you for the time being, Daniel, what impact do you see then AI having on the workforce and societal structures?
I did a TEDx talk a few years ago on the impact, the macro impact that these technologies will have. In fact, actually, I'm in the UK Parliament here today with terrible Wi-Fi, so sorry, to talk to Parliament about the impact that these technologies will have and how to put the right regulation in place to mitigate that, but also enable organizations to innovate and do what they do. Job loss is a key concern. These technologies are amazing at removing frictions, which usually means human labor. Historically, we've been able to free people up to go and do more interesting things. The concern is that we will eventually be able to replace whole jobs, and lots of organizations will do that very quickly, and our economies are not ready to be able to deal with mass technological employment. I've got a few controversial views about actually accelerating that. We should be accelerating automation, but there are other things as well we need to be thinking about, which is, creating post-truth worlds. We'll be able to create content very rapidly. Everybody will be able to create content. How can we authenticate content? How do we ensure that we mitigate surveillance capitalism, surveillance states? So using AI to understand people, manipulate their behavior. How do we mitigate the risk of creating a superintelligence? I think that there are a handful of futures that these technologies could create. I think we need to segment them, and we need to figure out how do we mitigate the risks. Job losses are a risk, but I think the next 10 years is going to be a Cambrian explosion of innovations, new ideas. It's going to be an amazing decade to be alive.
Fantastic. John or Ernest, do you guys have anything to add to that in terms of
I'll go to a very practical case which is impacting today. Is of the teams I've invested in quite considerably, most are now laying off engineers because they no longer need the same number of software engineers. CodePilot and similar basically kind of code generation tools, and there's more coming, will mean that you'll need less soldiers. You'll still need generals to overview and edit. There'll still be a human at the beginning and the end of the evaluation. Actually the code in itself, the kind of generation, and that's going to be revolutionary, because vast majority of these investors in this call would have invested in tech companies. The vast majority of those at the earliest stage would have invested in engineering talent. We're about to have an engineer as able, we're just giving him a superpower, the ability to generate enormous amounts of content from a single engineer that knows what it's doing. They're not going to go away. They're going to produce more and more. Software is going to be created at speed everywhere, but actually in terms of investors, you will need less money to build product to get into market. And that will be basically, the winners will be looking at different spaces and different parts. So I think that's today. I mean, interestingly, the industry that will be affected most is the industry that created it initially. And I think Daniel's point of view is going to spread everywhere. And we do need guardrails to kind of look at what societies we're going to create with this.
Right. Yeah. So with that being said, what does the outlook, maybe the next 5 to 10 years look like? I know Daniel, you said it's very exciting, but do you think it's going to create some consolidation, or will it create a lot more competition in the AI space? Like, as in, for example, I'm just thinking, for example, from a SaaS perspective, a SaaS platform that specializes in MailChimp, right? But now MailChimp can probably do some AI copywriting embedded. So everything's going to become consolidated. What's your take on that? Do you think it's going to become consolidated, or is it going to be more competitive?
I guess what we're seeing with large language models is that there's no, and I guess I quote somebody from Google, which is there's no moat around these technologies. Ultimately, I suspect many of them will become open source, and that power of having a graduate in your pocket or a master's level student in your pocket will become available to everybody. Now, if you've got a graduate in your pocket, we're going to be able to, as John said, create amazing new innovations. I hope that most people who start companies don't start companies because they're motivated by money. They start companies because they want to make a positive impact on society. What I hope will happen is that more and more innovations will be created at an exponential rate. We'll be able to help achieve the purpose of those companies, and the purpose of those companies will essentially unlock more and more people from economic constraints, and we get this self-fulfilling positive virtuous circle where more and more people are freed up because these technologies are commoditized, abundant, giving them the freedom to be able to use these technologies to free more and more people up. So my hope is that in the next 10 years, we continue to open source, democratize, rather than keep things closed. And I think that's the trend that we're going to see happen.
I mean, there are limiting factors on using large language models. They are expensive to build. They're expensive on inferences to use them. They have high problems of latency, i.e. it takes a long time. They will change behaviors, actually. It's interesting. We've got very used to instant responses as opposed to waiting for a GPT-4 or a Claude for a minute or two to come up with a more detailed contextual response. They are getting better. I will say a little bit about coming back about your SaaS plays. There's going to be two big functions. One, there's going to be a lot of technical debt. I built this basically product to do X and Y, and no longer do you need to build it that way, or you don't longer to build it at all. And then secondly, you're right, competitive advantages will basically emerge and fall. I don't think it's all going to be about incumbents. They have form factors that limit their ability to innovate quickly, and they have brands to protect. So it means that their tolerance of anything that fails is very, very low. So I do think the future will be in startups initially, but it's fair to say who has made the most money in the last 9 months out of large language models, and it's a company called Nvidia. And compute and the cost of compute is still a big limiting factor.
Yeah. Yeah, in my opinion, I would like to add as well that all those innovations will create a huge impact in the next and in the following years. But we have to bear in mind that who's going to own the technology? Who's going to make the money out of that? Because right now, so getting back to the SaaS models, so there is a lot of small applications that they just came up, using AI, etc. But in the end, how do you think this is going to be consolidated? So there's going to be a few winners, or it's going to be those big techs like Microsoft, Google, etc. So they will own everything and they will expand everything. Like every single technology, we used to pay a lot for internet years ago, and now it's very cheap, or it's almost free somewhere, and you can use a lot of technologies that they became as they're becoming open source and they're expanding and they're democratizing. I mean, it's more and more easy to get into these technologies. So the next level just appears. But in the end, who's going to be the big winner of the AI? There is room for those small companies to make money ahead of 2 years or 3 years, or this is moving too fast, and then technologies will be broad-based, speeded, and then used by everyone, and dominated by the big companies. So
I think it's fair to say no one really knows what's going to happen.
Yeah, of course.
But I think you can say that one or two things that's definitely there. One is that who can afford to lose? Who can afford to lose their position? So I predict quite strongly a massive amount of merger and acquisition activity. Yeah. Because one of the biggest shortages is talent and people knowing how to do things. And I think that basically, can you wait a year, 2 years, while your competitors, whether even from left of field, are building this capability up? I don't think so. And this will be harder for Europeans in particular, who have not necessarily always done the M&A activity Americans have done, to be not even go further behind in this, what we think is a revolution. And then the other aspect, and I will say this as an early stage investor, I think we'll win. I think anyone doing early stage and investing at the right stage at the right time will basically find at this stage, and the right people will also be able to make money for the reasons I just mentioned, but also some big companies in some garage somewhere, possibly not London or Silicon Valley or New York or Singapore, but maybe somewhere out in the back streets of Naples, I have no idea, is building something that could be basically, and building a company based on this new architecture that could basically, create new worlds, destroy existing.
Right.
Maybe I could give some examples. Sorry. So I think that, there is something to be said about the generic models and who owns them, and having to use them. But if you're an organization that's sitting on an interesting defensible data set, or if you're a company that is able to create an interesting defensible data set, you can tune those language models to be very specialized. And so going back to what John said, I think that the value will be in the talent, but it will also be in the tuning or the tuned language models that have been trained on specific data. So for example, in WPP, we create a lot of the world's content, but one of the things that we're using large language models for is to understand how audiences perceive content. Now, you can only understand how audiences perceive content if you've got lots of data on how audiences perceive content, which we have, and which Microsoft and Google actually don't have. So one of the differentiators in the future is actually your ability to get access to valuable data.
Great.
Agreed. 100%.
Yeah, so I guess moving forward, and I think coming back to you, John, first, is we've observed American VC funds integrating, or have integrated in the past already, AI experts at the partner level post GPT 3.5. What's the potential advantage of such a strategy, and do you see this trend eventually permeating to European funds as well?
I've been amazed how quick they've moved. Actually, I was speaking to an American VC this morning. And they asked me, do you want to speak to their large language model partner, or their kind of basically kind of standard kind of deep learning machine learning partner? And I was thinking, you have both already. Yes, and I think the issue is that there's one of the big VC strategies has always been a strategy called wave, which is the idea that there's a normal kind of tsunami wave that's going to wipe every incumbent and wipe everyone out, and you don't want to be on the beach when that wave crashes. You want to be on top of the wave surfing the board. I think I recall it was a famous AZ16 image from 2010 or 11 or whatever, and they were talking about the mobile wave and the cloud wave hitting in 2008, 9, 10, etc. So I think what all VCs are trying to do is get ahead of the game. And kind of like we've been many ways, and I've been at fault of this as well, thinking it's a kind of simple, predictable SaaS world of annual recurring revenues and free times growth for 3 years, etc., etc. We can all build these wonderful prediction models, and nothing's going to be that disruptive. Well, this is a very disruptive technology. And this basically means I do believe that VCs here everywhere are going to have to, if they don't have it, to partner with firms that do have it, to get a clearer understanding and to be there, because the great thing about my vision, I'm learning every day from the startups and the founders that keep making all these amazing leaps forward, also mistakes and challenges. This is the best petri dishes you can have is to be seeing others, being with others as they basically embark on these journeys.
Ernest, do you have anything to add in regards to that, having the expertise at the trickle down level?
Well, so no, I think what John was saying about the wave is the reality. So no one wants to miss an opportunity like that. So new roles are appearing, and you can name it whatever you want to call them. The deep learning partner, or they just want to be on, and we need to be on this spot. Because in the end, it's a very disruptive technology. It's a very difficult technology to understand because no one knows completely, what is the extent that it can reach this, the capacity. Because you can replace the first layer of engineers, and then, as every technology is doing, you replace the coding is the easiest way. But then, what about the ones who supervise the coding? So why AI cannot supervise the coding made by another AI? And then why where is the end of everything? So we don't know, and I think there's a lot of opportunities, and there's a lot of attentions to pay from the VC perspective be aware of what is happening. And of course, always there is a hype in every industry, and now it's the AI turn. But there is something, of course. I mean, it's a huge technology. So I don't know if the AI itself is enough to be an investment criteria, or it has to be a company with a huge AI component, which or we will normalize that AI is just a technology that everyone is using at some point, and then we will just pay attention at the business model itself.
Yeah. Great. And Daniel, do you have anything to add to that? And before Daniel answers to that, and this comes from my level, I have not an expert in AI whatsoever, but what you just said, Ernest, kind of, with the internet at the start, the people that use the internet got out quickly. But then once the internet was across all companies, then a new moat, a new competitive advantage had to come out of those companies. So I guess, Daniel, when it comes to that, do you see the same thing happening with AI in that regard?
Yeah, no, absolutely. I draw parallels with the birth of the internet, and we can kind of criticize what happened around the .com boom, but I think there are winners and losers, and these technologies are not going away. It's not like the metaverse last year. There was no real business model, business case that could have been easily identified for the metaverse. It was very, wishful thinking. I could ream off 40 business cases right now of where AI is going to add value. And, I think there's going to be, 100 companies, 10 companies, whatever, that are going to be going into those markets. And the challenge is, how do you bet on the right ones? And that goes back to, your investment criteria and philosophy and all that good stuff. But AI is real. It has a massive impact on business. I think the only thing I would caution everybody is, don't get excited about new shiny technologies. Make sure that you're applying the right technologies to solving the right problems, and don't try and apply generative AI to everything, because that won't necessarily be successful.
Great. And I guess you mentioned you had 40 use cases that you could spew out. Do you wanna give us one of those?
We're using generative AI, or do you want me to any type of AI? With generative AI, I guess we're going back to this idea of audience brains. Historically, you would try and correlate pixels, text, with activation from a marketing perspective, and now what we can do is we can use large language models to reconstruct how people perceive content, and that perception we can correlate with clicks. Another use of large language models actually are, this is going to sound really creepy, but we train large language models on each of the employees of one of the biggest brands in the world, using all of their data, the digital footprint, and we use that digital representation of that employee to ask it, if I put you on this project, will you work well? If I put you on this team, will you thrive? So I can actually create digital representations of employees and use that for better decision making about how I allocate employees across the organization.
Great. And I think you mentioned that first use case. Actually, we actually just had a company this morning pitch that was exactly that. It's called Pulse.io, and the CEO runs big marketing agency that he's taken to 1,300 people now, and he's developed just that. And it's really interesting that you mention it, because it's pretty much word for word, I think, if his executive summary.
I should have a chat, but historically, and going back to what I think John alluded to, historically is like a year ago. We would use machine learning to identify very specific behaviors of our audiences, and then try to activate them based on 70 different machine learning models. What we can do now is build one brain that represents all of the insights of an audience in its entirety, and that's a completely different architecture. It's a completely different model, and so those organizations that I guess have legacy old machine learning type models, they need to rapidly move to these new models.
Yeah,
and to be said, they're going to be foundations for virtually all technology. I mean, we've got basically we're using these in obviously in genomic and biologic research to generate new therapeutics, new drug solutions. We've got people generating new advanced materials, new advanced energy processes, nuclear fusion. The big nuclear fusion only enabled because of what's broken through in AI. We've got people redesigning. Last year, I invested in a company that's developing vaccines based on AI for cancer. So we are kind of like, this is a foundational technology that will filter everywhere, basically, and make some amazing. We've got too much of the press fearing the Terminator, but we're probably going to have the biggest medical advances in the next 10 years we've had since the 1920s and 30s. And that's because of our ability to use data, not, etc. Genomic data, biologic data, chemistry, etc. And this is fundamental. We are, living in amazing times. And any company, any society that can really basically use and utilize this will have a great advantage.
Great. Okay. So now moving on maybe to the more safeguarding, or not regulatory, but how can AI be used to promote equality and fairness in society, and what safeguards should be in place to prevent its misuse? And I guess, Daniel, you're at the House of Parliament today, so I think it might be good for you to start off with this one.
Yeah, that's my topic of conversation today. I think the first thing is understanding what AI is, and we've tried to refer to AI as technologies or definitions, and actually I think that's the wrong way of thinking about AI. What's happened over the past few decades is new algorithms, data, cloud, compute has converged that allow us to do really interesting things in our organizations, whether it's rapidly creating content, whether it's task automation, whether it's complex decision making, whether it's augmenting humans with exoskeletons and things like that. I actually believe there are 6 categories of applications, and those applications can have positive consequences, but they can also have negative consequences. A lot of the negative consequences actually are only associated with how opaque some AI is. The only difference between software and some AIs is that some AIs are difficult to understand how they're making their decisions, and there's a lot of hoo-ha. There's a lot of focus at the moment on bias and all this kind of stuff. Actually, as far as I'm concerned, it's way too much focus. Really, the challenge is, how do you make sure that when you build an AI, you can make sure that it's explainable? If you can make it explainable, then it becomes transparent, auditable, and governable. And there are well-established mechanisms. So there are immediate challenges associated with deploying solutions in production that you don't know how they're making the decisions. That's a technological problem, easy to solve, semi-easy to solve. But then there are macro consequences that these technologies will have around post-truth worlds, super intelligence, job losses. And what my advice is to Parliament is, you need to segment what the concerns are, what the problems are, and then work backwards and figure out how do we mitigate mass technological employment, surveillance capitalism. So I think that if the first part is educating business leaders, decision makers, what these technologies are and what impact they can actually have.
Great.
I'll also tell to you that basically the world's greatest black box is what's between your ears. No one knows. Even the individual probably can't read Daniel's mind. Even Daniel can't probably read it.
I can't.
Etc. And most decisions and measures are made behind closed doors, so we don't have ideas. And actually, AI often actually produces some form of transparency to old-fashioned rules-based decision making on, for instance, who gets a bank account or who gets insurance, or why basically you get X or Y tariff on your electricity. These decisions are made now by rules based, and you and I and no one probably knows why. I have a good example. We invested in a company called Blue Zone Insurance that took massive amounts of data from people who basically that had type 2 diabetes and able to reclassify their risk. At the moment before then, type 2 diabetes, you want a mortgage, you wanted life insurance. No way. Now you can, because they've worked out the actual data using machine learning of what the risk of you to die in the next 20, 30 years before your mortgage is paid off, and allowed created and realizes a whole new market of underserved people who can now potentially get insurance. The way we do things at the moment is so crude. It's so basic and rules-based, whether you're diagnosing cancer, whether you're allocating a resource to X or Y. But basic AI will reduce bias, will reduce inequalities. Those are the things that should be, and are not people who are running these black box systems who are trying to defend their own old systems. Don't listen to incumbents. Listen to yourself. Is it done well now? Can AI make it better? That's what I would say.
Fantastic. No, that's absolutely great and very inspiring from everyone here. I guess, Ernest, just moving on to you, as someone who has been who has driven innovation and implemented strategy in various businesses, right? How have you integrated AI in these processes, or have you seen these businesses use AI or integrate AI, and what were the tangible results?
Well, so primarily what we've done, so we have an edge on an investment that is more on the genetics and repro side, that we have an angle that is working with, and so we've been a lot of advancements that in this field, and how the AI can improve, the investigations and everything. So there is tangible results that actually right now it's time. It's time, it's how long it's taken to get a result and how fast we can do it. From the perspective of the tech companies, they're implementing this at a scale that is more, from the perspective that we can make things better, we can improve it. So we have an angle of education companies, and those at tech companies, they've seen a lot of improvements when teaching people and just trying to measure and track, how is this class, how is the interaction going on so far, and just making us at the end just short resumes of how was it, etc. So trying to improve, and we did realize that the alums improve the qualifications just by being more effective when attending classes and when seeing, which is the contrary, that everyone can think that students are using AI by just to take advantage of and having access to a lot of exercises and just keeping the line, which is completely different, because you can applicate it in the education side just with the proper way that you can improve and give the right messages and giving access to the right information to a student, and making sure that he's performing much better. And when an assessment is taking place, we tracking that the scores are much higher because of that. And that surprised me, because it's a common statement that everyone says, that okay, from the student perspective, everyone is using AI to take advantage out of it, and I think it's not. I mean, it could improve a lot the way we can learn as well.
Yeah, thank you for that. I'm being conscious of time. We have 2 minutes, so one question for the three of you. One answer. What would be your biggest tip for someone starting an AI company today? Maybe John, you can go first.
Biggest tip for someone that kind of an AI company. Well, I do think there's still a barrier of competence and knowledge. So I would say to them, don't do it unless you have basically, have done your homework, or you can partner with someone who has the ability and competencies to do it. The great thing about startups at the moment, we're all learning. And startups learn on their own time, using their own blood, sweat, and tears. In many ways, they're more motivated, as opposed to be doing it in 2 or 3 hours between classes, or 2 or 3 hours, basically, when they're not trying to keep their present stack alive in the company they work for. So, so it is a great learning experience being a startup. But you do need to have the core. It's not going to be for everything. And actually, I would say not everything requires a data or AI solution. And some of the things that we want AI to do are bloody miracles that basically society needs to determine, and not some AI prediction model about whether they want to prioritize X or Y. So I will come back on the startups. If you are interested and you have got the capabilities, or you can form this team, never better time to be a startup doing AI.
Great. Ernest?
Well, so I've been an entrepreneur all my life, so I have no advice to entrepreneurs. Actually, just if they want to do it, they have to to make sure that everything is aligned and they have the right knowledge to afford it. And well, it's a very good timing for this technology. So just make sure that what you're doing is creating an impact and a positive impact. Don't look just right at after the money you can make, because you can probably fail.
Great, thank you. And finally, Daniel.
It's the same advice I give any startup, whether it's AI or not, which is surround yourself by people who know what they're doing. Surround yourself by advisors who can help you not make mistakes that we all make when we're starting companies.
Yeah, I think I heard that advice multiple times today. It's hire better than you. No, hire better than you. Look, guys, it's been an absolute pleasure. I wish we had more time. I know, Daniel, you have to run. We have to continue the day, but it's been a pleasure. Thank you very much. And yeah, hopefully we can do this another time. But yeah.
Brilliant.
Thank you very much.
Look forward.
Thanks,
Bye-bye.
guys.
Bye-bye.
Bye-bye.
What if creating an AI was as easy as composing an email? That is what Manish and the team at Jiva.ai are developing with their no-code machine learning platform that makes all the complexity of building, testing, and deploying AI solutions easy.
Hi, my name is Manish and I'm CEO and co-founder of Jiva.ai. Now, I've been in the AI game for almost 25 years in and around healthcare as well as fintech. And there's a few fundamental problems in all the products I've ever been in that always come up. So resources are difficult to find. They're expensive when you do find them, and it takes you a very long time to actually create an AI solution and deploy it. All of these things cost a lot of money and a lot of resource. Up to $380,000, in fact, for your average startup, and up to 3 years to actually productionize an AI for a med tech company, for example. So what if I told you that I could make AI as easy as composing an email? That is Jiva. Create, validate, test and deploy AI solutions all under the same roof. And as you are going along, our own AI learns how you are doing data science, how you are doing AI, and therefore gets better and better at actually predicting what works best for you. So what have we done at Jiva then? We've made AI super easy to use. We've saved you vast sums of money, and we can do it really, really fast. In that journey, our customers retain 100% of their IP and save up to 90% of costs along that time. And this isn't some kind of pre-MVP pipe dream. We've been there and done it. I'll take the liver disease example that we did with Roche Diagnostics, GE Healthcare, and Manchester University, where we were given some data to create a medical diagnostic from some primary care and secondary care information sources. In that project, we actually went about to prove that we could do things better than the incumbent way. So the incumbent way being coding in Python. We actually took 9 months to create, test, and deploy a model, which is actually used in the Manchester clinic to diagnose liver disease. So 9 months of coding, of unit testing and deployment, switched over to our platform. We did the same work in 3 days and actually created a better model. So that's the level of compression in efficiency that we can provide in creating AI solutions. Now imagine if we could do that for every healthcare and life science company on the planet. Imagine the impact that could have. Now, we are by no means the only no-code AI solution out there, but as you go down this list, it becomes more and more difficult to actually use those products. The combination of multimodality, so that's our ability to merge different AI models together over time, and the no-codeness of the platform places us very uniquely in the marketplace, especially for healthcare. Moreover, the success of these companies, so again, as you go down this list, the market cap goes higher and higher. The success of these companies is great validation for us in terms of market fit. As a business model, we operate a binary plan. So in our B2B SaaS model, our customers pay a monthly fee on a minimum 12-month contract. This is a fully self-service way of creating AI, though we do offer consultancy service as well on top if the customer requires it. In this journey, again, the customer retains all of their IP. In our platform as a service, we're actually using fundamentally the same technology as the SaaS, but we are co-building those companies together with our investment partners. Jiva creates almost the entire tech stack from back to front with AI sandwiched in between. And Jiva takes a licensing fee for this, as well as an equity stake or a warrant in the company. This puts an incredible amount of value into our book for Jiva, which is realizable as the companies grow. So we incorporated in 2019 and have had great traction in that time despite COVID. We've developed some incredibly active partnerships with some very big names such as Microsoft and Roche Diagnostics. Also in that time, we've become revenue generating. We have over £1.3 million in the current pipeline. In that pipeline, we have companies as big as, for example, EMIS, one of the largest software providers to healthcare in the UK, and some really small startups as well who just need help going along building their technology. We've been on some incredible accelerator programs, validated our pricing, have some semblance of product market fit. 2 medical diagnostics that we created. One I mentioned before, which is the liver disease diagnostic. Another is a prostate cancer diagnostic, are well on the way of being spun out. And we've won more than 700K worth of funding in grant money, as well as equity funding. So that's why we are so incredibly ambitious about our growth plans and where we think we can go in a market that's growing at 40% annually. Currently sits at 126 billion in terms of AI uptake across the world. Revenues are split between SaaS and platform income here. And as we get liquidity from the companies that we support on the platform, so that's our venture building business, we're able to pump prime marketing and other scaling channels to ensure healthy growth on the SaaS product as well. In terms of investment, to get to that target, we need a minimum of £2.5 million. That buys us 24 months of runway. With that money, we are aiming to build a team, but crucially, we want to be able to unlock that sales pipeline that we've developed over the last year or so. In that pipeline, like I say, we've got companies large and small, and our largest bottleneck is actually development team to be able to go through it, as well as a sales team to execute early stage leads. We have a term sheet on the table from a cornerstone investor already, so more than 50% of that 2.5 minimum is actually already covered with pre-existing investors. And none of this would be possible without an absolutely stellar team. In this team, we have years and years of experience in AI, SaaS, technology platforms, sales, finance, and so on. We have multiple exiters on both the board as well as the core team. And so we have all the experience it takes to create a scalable, highly profitable business. And so collectively, we are Jiva. We are dreaming big, and we'd love to have you join us on our journey. Thank you for listening, and thanks for the opportunity to present today virtually.
But not least, we have Make Good, Give Back. Make Good and Give Back are changing the value of personal data for good by redefining trust between people and large organizations. They're helping individuals, families, and small business owners control and get paid for their data to help everyone lead healthier, wealthier, and happier lives. So over to yourselves to tell us a little bit more.
Great, thank you very much, Hugo. Make Good, Give Back is our platform, and we create industrial strength, health, wealth, and happiness for everyone. And that means that we help you get a hold of your personal data, then help you get savvy with it, get paid, and if you choose, to help others along the way and to give back. Our purpose is your data for good, which is a bit of a clue to who we are and what we do. So as a business, we are a social impact, early stage, pre-seed, Web 5 startup. And if you're Jack Dorsey, Web 5 means a combination, a hybrid of Web 2 and Web 3 technologies. And we bring those together, but our main focus is really we're helping to tackle the cost of living crisis head on. And we're helping Julie improve her financial and mental well-being. And we do that in 4 easy steps by helping make that data, your personal data, making it yours, helping you make your data work for you. And 3, if you choose, we're going to help you make your data pay you. And again, as we said earlier, that if you want to make it count, you can help others along the way and maybe give back some of that money that you can make for yourself from your data. You might see there that there's Julie in the middle, and we've also got a proof of concept already underway in various forms, including mobile apps. So who is Julie, you may be asking? Well, for us as a business, she's our most valuable person. That's right. She's our MVP. But she's also the financially squeezed mum, and you may know Julie. In fact, she could have been your mum, she might be your wife, your partner, your sister, maybe even your daughter. And to us, she's really important because she's 1 in a million. And just in case you don't know much about Julie, she's 25 to 34, she's intelligent, has a degree, relationship, kids, full-time job, mortgage, and she's an early adopter of mobile and digital technologies. Also, really importantly, she manages the financial well-being of her family. She is very charitable and she gets financial well-being, but she's got no time. So each day, what she's doing is these things. She's got a job, she's buying, consuming, all of those things. And for her, her sense of financial well-being is to be secure, to be resilient, and to be in control and getting on with life. But she'll be doing that today, and she'll do that tomorrow, and she'll be doing that mostly for the rest of her life. So what she will also tell you, though, as a financially squeezed person, that she's not in crisis, but she feels stalled, if not trapped by money. And just in case you're wondering, you can see that she's not one of, sadly, the many vulnerable people in society. She's actually well in the mainstream. And to be more accurate, she's not just one, she's 1 in 940,000 such women in the UK. So why is she so important? Well, a couple of things here. One is she's key to unlocking financial well-being for the rest of us. And just to give you some idea of what that means, there are a number of national financial well-being strategies across a number of countries in the North and South Hemisphere. In the UK, we have perhaps the most well-known or successful of the national financial well-being strategies. And what that research will tell you is that the financially squeezed mum is really important to us, not only because she's the least understood person in the well-being strategy, but actually that by understanding her better than we do, she can teach us things about how everyone else can engage with their financial circumstances a lot more effectively, and to actually improve the way we all do manage our financial well-being. So what is the problem that we're tackling as a business? Well, it is a difficult problem. There's no doubt about that. And if you want to implement a national well-being strategy, which we believe we can help, then really that's a difficult problem. We've broken that down into 3 simpler parts. And there are 3 groups of people here that are really important. One is Julie and the rest of the population. And we've got to help people self-engage more easily with, and using their own data is a way to do that. We've got to help large organizations engage with this challenge. It's very clear in the research that they need a business case to commit, whereas people are too busy earning a living to really engage at the moment. And we need, really importantly, to embed system-wide change at scale. We need to help the helper communities, and they're starved of funds and insights, as you may be well aware. Some massive challenges here, including the cost of inflation, cost of living, and inflation, which is not going down, stubbornly high in the UK and increasing in other countries. Companies spend an enormous amount of money on first and third party and second party data and advertising. But the problem is they still don't know Julie, or anyone else for that matter. Whereas Julie, on the other hand, is seeing her data flow to lots of places, but it's really going to waste, and it doesn't improve her health, wealth, and happiness. So that's the challenge. Is it a big problem? Well, it really is. All of this data is sloshing across to organizations, and they're in search of the CRM Holy Grail, and they're spending $1 trillion per annum on this challenge. But none of that is going back to Julie or the rest of the population. As I mentioned, she's 1 in a million such mums in the UK, but she's part of a group of 9 million people in the UK who pay for their food with credit card and other bills through their credit card. In Australia, I can tell you that's a massive issue around food security, and the same is true in most countries. And that 9 million group is part of 2/3 of the population of the UK who are financially squeezed or financially struggling. Meanwhile, you can see a lot of that data, the third-party data, is really an addiction. That's 20 billion is being spent on that each year, and at least 900 billion is being spent on advertising. So what does our platform do? It helps bring these 3 different groups together. It brings Julie and the rest of the population together with big organizations and the impact groups, and it simplifies ownership and control of your data, and it turns that data into actionable well-being insights for you. For companies, that data can eliminate spend on third-party data. That's an enormous saving. Goodbye to cookies and wasteful adverts. It will help de-risk your privacy compliance, and it will reduce the cost and complexity of your analytics. For the impact groups, that's going to help provide funds and insights to help them help others. So does it pay? We think it does. Julie gets free use of this platform. It doesn't cost her anything, and she'll get £50 per annum from each subscribing organization. So the more organizations we can get on board, the more money goes to Julie and for her to share if that's how she chooses. For the company, we don't charge Julie any money at all. In fact, we ask organizations to pay us access to our platform and also some data rental subs. So we can make money to help Julie and lots of other people improve their financial well-being. So can we do it? We need your help. There's no doubt about that. We want you to help us, help Julie and millions like her. And we want you to help us start that next phase in our pre-seed investment drive where we can help improve early adoption engagement. We've got a great team. I've got a background in AI, which is pretty important these days. And we've got some very strong capabilities in data and privacy and a lot of other things to help us implement this program. We're happy to talk about our investment idea and our go-to-market budgets just in outline there. We'd love to talk to you about. So thank you very much for your time. I hope that gives you a little bit of an insight into what we're doing, and happy to talk. Thank you very much.
Good evening, afternoon, morning, wherever you guys are tuning in from. It is with immense pleasure that I introduce you to our keynote speaker for today, Matthew Stotts. Matthew is a prominent figure in the realm of global technology with his focus aimed at the most pertinent issues of our time: climate change, environmental regeneration, and sustainable communities. As a general partner at Cerulean Ventures, Matthew brings his wealth of knowledge, experience, and unyielding passion to every project he embarks on, pushing boundaries in tech and sustainability alike. This passion extends far beyond Cerulean Ventures. Previously, Matthew has been a general partner at Keynote, a blockchain hedge fund and venture capital firm. His versatility and vision can also be seen in his role as co-founder of an open source NFT infrastructure project on the Solana blockchain. Once again, blending cutting-edge technology with innovative concepts. Matthew's commitment to education shines through as a frequent lecturer at UC Santa Barbara's Technology Management Program, fostering the next generation of tech enthusiasts and leaders. Today, Matthew will share his insights and experiences, providing us with a glimpse into the intersection of technology, sustainability, and investment. Ladies and gentlemen, without further ado, I present to you Matthew Stotts.
Thank you, Hugo. And thank you, everyone, the V&C Global event. Really excited to be a part of all of this today. It's really a pleasure to be with you and the innovators and the investors who are building our future together. So again, just want to share a bit about what we do here at Cerulean Ventures. We invest in climate tech solutions with the potential for local impact at a global scale. We do that by investing in software that scales proven climate solutions such as renewable energy, reforestation, regenerative agriculture, as well as profit-driving sustainability software in industry and manufacturing, transportation, and construction. Our investments in climate-positive companies like Regen Network, Thallo, Silta, Jasmine Energy, and Earthbank are aimed at lowering the cost and complexity of climate finance and accelerating the formation and distribution of capital to fund climate positive projects at a global scale. And our investments in blockchain infrastructure projects like Kive, Stride, Masa, Quicksilver, and Nibiru codify the trust, transparency, and transactional efficiency we feel is needed to unlock massive amounts of capital for climate action. So with that context, today I'm talking to the investors and innovators here in the audience who know that the climate crisis can be solved by scaling proven local solutions because you've seen them, and by connecting global finance and a global economy to the innovators who have demonstrated that success and their ability to make positive change. Let me start by saying a little bit more about myself, and I'll pull that, let me see if I can pull that slide up for you right now. There we go. So there we are. So I founded Cerulean Ventures, co-founded it with my partner, Jahed Momand, 2 years ago. After working 20 years in traditional venture capital myself, I realized that there was a massive blind spot for the unique type of technologies and innovators that work beyond the status quo. So we know that from our investing experience that we can't consume our way out of decarbonization or finger wag society into changing its ways. We have to seek out innovators who understand that the world as it is and reimagine a path to growth that isn't dependent upon an exit to an oil and gas major or being acquired by a multinational consumer packaged goods company, only to become a PR story and one of 100 products in their portfolio. We are backing system level thinkers operating at Earth scale, innovators who see a massive opportunity and impact by connecting economic growth and prosperity to the natural world. So today we're going to talk about those themes, a concept we call regenerative finance, and how by valuing nature and the inputs it provides to our economy, including those values in our account, if you will, on our balance sheet, and understanding that in its fullness and complexity, how we can both have sustainability and productive growth while addressing the climate challenge. So in the next few minutes, I'll cover why the status quo economy won't finance the climate positive future we need, but it is a hopeful talk. I'll present some of the possible solutions from the climate fintech software innovations that we're seeing in the market. So we know we're in a climate crisis, but carbon is a major part of that. And it's because the human economic activity puts so much carbon into the air, it must be reduced and removed. We count this carbon in tons of carbon dioxide equivalent, but it comes from CO2, methane, nitrous oxide, other emissions. And it's a negative externality, a cost to humanity that we're just now learning how to price and pay for. But it's not just greenhouse gases in the atmosphere that are causing the climate crisis. And it's fundamental to understand what's happening in natural systems and the impacts economic activity are having in order to find economic solutions to address this change. A changing climate ultimately changes everything, where water will flow and where food will grow. And if by looking at the watershed phenomena here, using an analysis of the U.S. where I reside, we see that greenhouse gas emissions will move 50% of the watershed and impact the ability to grow or to sustain economies and communities that have been based on those watersheds historically. Other human economic activity beyond direct carbon emissions is also going to have a significant cost to our future. The lack of sustainability in agriculture is putting enormous stress on soil, a harbinger of potential collapse in food production. The alarmist claims that we only have 60 harvests left. It's overstated by a UN study from 2014. But that same study looked at a subset of 16% of the soils in global agriculture with rapid erosion that had less than 100 years of topsoil remaining. So the problem is real. And ocean health is also impacted. Over a third of all the additional carbon we emit through human economic activity is absorbed by the ocean. And the ocean, as you can see in this chart, is a major carbon sink for all of the carbon in the natural system of Earth. By increasing the amount of carbon in the ocean, we cause the temperature to rise, starts to move ocean currents, as we're seeing around the South Pole, and weather patterns make changes to food supply like fishery and shellfish, as well as the ocean's long-term ability to continue to trap carbon the way it has been. And finally, clean air is another public good that is threatened globally by climate change. It used to be said that if you lived in a state such as Colorado in the US, that are subject to seasonal wildfires, air quality would only get worse with climate change. But we're seeing massive fires in Canada and the American Pacific Northwest, which are impacting communities from Chicago to New York. We've seen similar tragedies in Australia just a few years ago. And with the smoke, we know deaths from low air quality will rise. In addition, many of the institutions responsible for stewarding natural resources have failed to act decisively. I had the good fortune to travel with my partner to Egypt last year for COP27. This is the UN's climate conference. This is the 27th time they've met. And so it's not an exaggeration to say that our institutions and multilateralism is not going to be able to drive the entirety of the solution on climate change. We're currently on track for the worst warming scenarios. This headline, 10 years to save the planet, is a bit of an exaggeration, but it drives home an important point. Public trust in institutions is declining, and a result of this, and it's really in a near historic lows. People need an opportunity to make economic headway and address climate change. So it sounds grim, but sorry, it all sounds rather grim, but it's only been difficult to act because the systems haven't been in place to act upon. What's ultimately been missing are incentives. So incentives can be financial, and we're all familiar with how those work. These are the estimated values of some of the ecosystem services that the planet provides to the economy. Nearly 5 trillion in forest ecosystem, 1.5 in ocean ecosystems, and then a cost to economic output annually of over $1 trillion from air pollution. Ultimately, as a whole, Earth's ecosystem provides services to humanity and human economic activity valued in a range from 16 to 54 trillion every year. But these values aren't accounted for. They're not part of the economic system today. And the reason is they're hard to measure. Take forests, for example. They're easy to measure from the perspective of timber production. They're cut down a tree, you can mill it and sell it for lumber or make wood pellets for supposedly green fuel. But their carbon sequestration qualities, the biodiversity that exists in intact old growth forests, which are incredibly important, are also hard to measure. The contribution to biodiversity, watershed health, and water quality are only now becoming measurable in a way that we can actually understand the economic value. And then there's this lack of measurement incentivizes ultimately greenwashing, where corporations make claims that they've done something that ultimately they can't prove, and it allows people to write off their environmental impact with not actually showing much in terms of the impact on global climate change. It's also hard to measure because there's a clear disincentive for good measurement, but that is changing. Another challenge in the in being able to understand the value of natural assets is that it's very difficult to price. Efficient markets are actually a disincentive for many of the centralized entities that make a market in this space today. These are brokers and consultants who benefit from controlling the process and providing creating opacity around price. But it's difficult to build a market with little liquidity. And if you don't know how much the activity you're pursuing costs or what the value is, how do you determine its value to another party? It's also very difficult to verify the impact. There's an entire NGO supply chain built around natural assets, such as carbon offsets. There are no trustless third parties here. And getting to trustlessness is going to be a difficult path. I'm not here to tell you that these organizations are necessarily bad. They're simply doing their best with the incentives that they have in front of them. Again, we need to build systems that changes those incentives. And here's where the investable opportunity is. So thank you for bearing with me of kind of framing the challenge and the difficulty. But remember, those ecosystem services, that's a significant amount of pent-up value. We see an investable opportunity here by taking pent-up demand and mispriced supply and bringing a global market together with coordination, measurement, and liquidity that doesn't yet exist in full. It's common for markets like this to be brokered by middlemen, but we have proven technology to solve these market failures. Let's take a quick look at how the stage is set. So the stage is set for a global free market movement to invest in digital eco-credits. At Cerulean, we see a massive opportunity in the combination of digital assets and the natural assets markets. The chart on the left shows the rise in cryptocurrency and stablecoin volume. These are examples of digital assets that are being adopted globally. On the right, the demand over the last decade for voluntary carbon credits as an example of a nature-backed asset. But we need scale in order to unlock this potential, in order to drive proper finance into these markets. How much scale? Actually, an incredible amount of scale. We need to remove 10 gigatons of carbon by 2050, according to the IPCC, UN's International Council on Climate Change. That amount of carbon, it needs to be removed. If it were just based on nature-based projects, that would be like planting trees, protecting forests, and employing sustainable agriculture practices in an area that is 35 times the size of the UK. It's a massive scale. So this is part of the reason why we look to software systems and networks for the solution. By digitizing, by tokenizing assets or creating digital assets from nature, we get the transparency that's necessary to understand the value of the asset. We get instant access to global markets. We have price discovery through all the actors and investors on a market. We have third-party verification that can be put on blockchain to identify the quality of the asset, and software to reduce the ultimately the cost of doing this work. And then finally, decentralization, or another way to think about this is global economic markets for these assets. So properly tokenizing real-world assets on blockchain can make them tradable, transparent, and auditable, leading to price discovery and new mechanisms which bring liquidity. It's ultimately about making the local scale globally. Ultimately, this requires coordination. A coordination driven by free markets are the most powerful tool to address climate change. Innovative entrepreneurs and investors that back them can create global accessible coordination tools, mostly driven entirely by software, that power an efficient climate market. Let's take a look at how tokenization and coordination can work together. Tokenization, or creating digital representations of real-world assets, it's really nothing new, but it's not enough. We need the new ways of owning and governing these assets. Today, we're learning to rapidly innovate on adaptive governance. In some applications, decentralized autonomous organizations, or DAOs, can function as programmable institutions and improve asset governance. We see this in a project that we're very close to called Regen Network. In a regenerative economy, we see the coordination functions operating at scale in blockchain ecosystems that are worth billions, tens of billions, or even hundreds of billions, such as Ethereum, Cosmos, and Solana. The application of blockchain to climate assets, finance, and information networks is called regenerative finance, and it's the key to building a regenerative economy that has sovereignty, interoperability, composability, and institutional innovation that moves us from the status quo. So what are some of the pillars of this regenerative finance, or refi? Fundamentally, monitoring technology, or what's commonly called MRV, monitoring, reporting, and verification. The ability to use technology to understand the state of a natural asset. The ability to validate and verify that data of an ecological state, the quality of a forest, the sustainability of an agricultural practice, and then producing assets based on that change. So improving soil sequestration through regenerative agricultural practices, increasing biodiversity in a preserved forest, and ultimately providing a layer of governance or coordination around that asset. And the exciting thing is this future is already happening. So I've described to you a world and an economy of natural assets that is actually beginning to take hold. So trusted brands and proven teams at companies like Earthbank have decades of experience working with impact NGOs and in the banking sector and doing effective impact measurement. But they're working together to create new software for project finance by giving a risk-adjusted forward contract for carbon that can provide project finance to fund carbon sequestration at scale. An ideal project coming out of Earthbank today is a blue carbon mangroves project, millions of hectares in the Bay of Bengal in Sundarbans, India. There's also technology projects like Kive Network, which is providing an oracle for Earth state data. And the fundamental ideal here with Kive is that they're able to provide a validated set of data for the state of nature as it is, whether that's a forest that's been clear-cut and is undergoing restoration, whether that's an intact old growth forest, or a smallhold farmer's shade-grown coffee plantation. By being able to put that data in a blockchain verified oracle, investors are able to go back and see what the state of that asset was prior to an investment and actually have verifiable fact that a positive change has been made. This makes assets more investable. So Kive is a critical part to that solution. But what's also fundamental here is that Kive provides this service for other data, not necessarily only environmental data. So the Kive network as a fundamental technology is widely used and is on a clear path to compete with large projects like the Graph, valued at $850 million today, and Chainlink, valued at $2.5 billion or more. Similarly, projects like Stride Network are providing fundamental blockchain technology that has a key application to climate change and nature markets. So Stride provides liquidity for assets. So two different assets can be shared in a pool, providing the opportunity to trade between them. You can control the governance mechanism of an asset while also being able to use it on a network for other investing purposes. And this liquidity is key to being able to create price discovery and increase trading among assets. So Stride is a much needed solution for securing assets while allowing active trading in these markets. Ultimately, why does all of this matter? We at Cerulean are focused on establishing a bottom-up market for ecological regeneration and providing incentives that are owned by protocols. That means that the software itself that's being used, whether that's the examples of Kive or Stride, have built-in incentives for their use, and that drives ultimately their global adoption. So refi or regenerative finance values nature to fight climate change. We're in a climate emergency. There is hope. We're focused on leveraging blockchain and climate fintech innovations to develop a true regenerative financial economy. And I'll pause now for any questions.
Thanks. Thanks for that, Matthew. That was really insightful into what you guys do at Cerulean Ventures. I guess, I have a couple questions in regards to the urgency of the climate change and environmental issues. You mentioned that in your address. How do you balance the need for rapid innovation with maybe the potential risk and uncertainties associated with new technologies, right?
Well, I mean, look, there is risk. There's no doubt about it. And I think that, we're not averse to that, but we've seen the application of these blockchain technologies create effective markets time and again. And so I think when we think about the potential risk, one, we have a portfolio approach. So we have over 20 companies now in the portfolio and a path to diversify across many opportunities. So I think, as fundamental investors, we function in that way. And then if you actually step into the larger question around asset risk, many of the financial products that are being created and brought to market are addressing that risk. Future forward contracts that allow for the trading of futures, perpetual contracts. So we're starting to see a maturing of the financial markets around eco credits and around various climate positive investments that allow investors to hedge risk, to understand if they're purchasing carbon credits or renewable energy credits, for example, that they have the tools available to them to trade out of that position or hedge that risk in the future. So yes, this is a rapidly maturing asset market.
Great, thanks for that. I think it'd be great to maybe understand a bit more about your journey. How did you get into this global technology space for climate change and environmental regeneration?
Thank you. Well, I started investing in the blockchain opportunity about 5 years ago, and also co-founded a company in the space as well. So we made about 20 investments outside of the climate thesis. And what we saw in those investments was the ability to actually create value far earlier than in traditional software, to engage both developers in terms of folks who would be building onto your software platform, and users, again, far earlier in the process. So what we would view as kind of a traditional, I think, seed stage venture capital opportunity is almost the last stage of funding in a blockchain. Right. Very little capital is needed to actually develop. And this is true across all software categories, right? We're seeing even with the introduction of AI coding capabilities, kind of superpowering teams that can develop software even faster. We're seeing the cost of capital required. The amount of capital required coming down in these opportunities. We also just see a much faster path to exit liquidity. So in that period, when I was investing broadly and not entirely focused on climate change, we would work with a project early on. In 2 to 3 years, you'd see liquidity of that asset. And so as an investor who's recycling capital and trying to back more and more teams and bring about faster change, that was fundamentally an interesting opportunity. So bringing that to the climate arena, the same dynamics apply.
Okay, great. Thank you. I think we have time for one more question. So I think, what advice would you give to startups or entrepreneurs who want to contribute to climate change solutions and build sustainable communities through technology?
I think, number one, think globally and look for local impact. So, and it's our belief that this is the next significant asset creation category, the full climate-based assets, whether they are renewable energy credits, carbon credits, things related to biodiversity and the like. This is going to be a global commodities market, all traded and connected worldwide. So think globally about what your opportunity is, how you can connect your place on the planet with the overall climate.
Great, fantastic. Well, I'd like to take the time to thank you very much. I'm sure the attendees have learned a lot from you. But yeah, it's been a pleasure to have you on board. And for everyone watching us, we will be back on early tomorrow morning with day 2. But thank you very much, Matthew,
Thanks
for that address.
Great to be part of V&C Global. Thank you.
Thank you very much.
Ladies and gentlemen, as we draw to the close of the first day of our V&C Global conference, I must express my immense gratitude for your active participation and enthusiasm. Our gathering today has been a testament to the power of shared insights, diverse perspectives, and the global spirit of innovation. We've journeyed through the landscapes of SaaS, Fintech, blockchain, AI, delving into the intricacies and potentials of these dynamic industries. We've heard from visionary leaders and engaged in enriching discussions, illuminating the pathways of innovation that are shaping our global investment ecosystem. Our heartfelt appreciation goes out to our distinguished speakers for their invaluable insights and inspiring keynotes. Each speaker brought a unique wealth of experience and wisdom, enhancing our collective understanding of the myriad opportunities that lie ahead. As we wrap up for today, let us recall the words of the visionary leader Steve Jobs, who once said, "Innovation distinguishes between a leader and a follower." These words remind us of the inherent power and potential that innovation holds. The power to transform ideas into realities and elevate leaders in the process. And remember, we are only halfway through our journey. Tomorrow promises to be equally, if not more, enlightening. We will continue to explore emerging investment trends, delve deeper into the role of climate tech and sustainability, and understand the potential of circular economies. Tonight, as you take a well-deserved rest, I encourage you to reflect on today's insights and anticipate the knowledge that awaits us tomorrow. And remember, our networking zone remains open for continued conversations, networking, and exchange of ideas. So rest well, my fellow attendees, for tomorrow we embark on another day of exploration and growth. We look forward to welcoming you back for day 2 of our V&C Global Conference. Thank you once again for your time and engagement. Enjoy your evening and see you bright and early tomorrow. Thank you.